even by the bond side. We don't know how much is the tax discussion, how much are we losing, how much are we gaining. So in India, this discussion is all, nobody knows anything. So anything can be justified, but it is not right.
Samir, it's always obviously hazardous to call in the near term in the market, but just your overall sense, are we looking a little toppish here, or what's the overall kind of sense you get?
So because there are this budget and all in between, and you have to satisfy the expectations in many of these sectors, which it looks very difficult. That how do you satisfy somebody's expectation on how many aircraft carriers we'll make, and for how many years it takes to make a carrier, and how many does India plan to make when China has only 3 or 4, and I read in some Kotak report that US has only 10 or 11. So some of these expectations are so unreasonable that you have a good budget, bad budget, no budget. It is beyond normal realm of speculation. And then there is that whether we do a few small self goals only because we feel that, oh, India is the only growth country in the world and all that. So we should just have a balance as a country and as a system. Because everybody's needed, FIs are needed, PE is needed, FDI is needed, domestic investors are needed, but it cannot be only that, oh, because mutual fund flows are there, everything else is taken as granted.
Samir, morning. Any changes in the way you're approaching India now in stocks, themes? You've trimmed, added to any of your positions?
Many positions we must have trimmed or added, but in the big picture sense, my net exposure, my long short fund used to be 74-75% going into the polls and exit poll and all that. And I want to reduce it, and have reduced it quite a bit to in the high 60s.
Okay. And where is it that you, in a big picture, where is it that you've trimmed your positions, and have you reallocated part of the money? Any new interesting ideas or trends that you've observed or you're watching?
So right now we have trimmed from the stocks which normally we don't like, but they have gone to those stages of 70p and 65p and 80p, whatever be the growth rate. Because in the end, we think that those growth rates cannot be satisfied so easily. And at a slightest bump, you will lose 10-15%. And by the way, we did lose on some of them for a few days on that June, whatever, that 4th, or what was it, the day when the actual results came. And most of them came back, but now we don't want to see that kind of a day again at least in the short term. So you can then, the rest of that conclude which are these. They are, some of them are in the state-owned group and some of them are in the consumer group.
Hi Samir, good morning. I'm wondering whether people want to see that sort of a day again, because we saw a lot of retail money coming in there and some of them are dancing to the bank, if you compare with those levels on June 4th. But let's focus on one of the larger names that you've been positive on, HDFC Bank. There's been some technical news flow with regard to their MSCI rejig. There's been the fundamentals with regard to the operational update as well. And there's some chatter that maybe there could be some rejig at the top. What's your view on the current management with regard to HDFC Bank?
You must have seen Djokovic interview with the BBC. And he said, how many times you want to ask the same kind of questions? So I'm not answering only from your point of view, not from my point of view, because my interviews become too boring if I keep talking about HDFC Bank and Zomato all my life. So ask me a third question and I will answer.
No, but I wanted to ask you.
It's boring for everybody else who's watching, that as if we are a one-stock wonder or a one-stock portfolio. I have, so I will not answer just for the heck of it, because I can't keep answering on one stock all my life. I have it.
Okay, so give us another one then. If not HDFC, Zomato, we have spoken about that. What else? What else are you?
Djokovic didn't ask BBC, that I will tell you the question. I follow the big boys of the world.
Okay, let's talk about the paint space. Yesterday we got a price increase coming out of nowhere, and you have been quite positive as well on Asian Paints. I think we have mentioned that as well. The stock actually has been.
For 2 years. We are not positive, and I can't speak on this because I'm interested in a different direction for last 1 year, because it was so obvious that there is so much pressure, and we had these PMS fund managers and all who made it look like some God's gift to mankind. So the thing is, now we'll see how it goes in the end. But a 0.75% hike, or this is more to show to the world, is as much signaling, but it doesn't mean much in real numbers. So it is also in the high P average growth zone.
Yeah.
But
Samir,
I cannot talk much about it.
I like the comparison with Djokovic. I know I can see where you're going.
You have to benchmark with the best.
Let me circle back to the market, because everything is done so well, right? So I think we should talk a little bit more about overall, where we are at. So we just had the management of Gulf Oil Lubricants. I don't know if you watched that conversation. And there was this buzz, and someone sent me a one-pager about how lubricant companies they have this big new opportunities with data centers. And I got very curious. And I said, well, what is the size of data centers in India? And, you've got to put all those, you've got to cool and it's a real thing. And I read up, etc. And the management came on, they said, well, it's some 0.00 something percent. So there are so many narratives which are flying, and stocks are up 15-20% before you can verify.
That's what I'm saying. Some of this is becoming wild. If you see this, as I was talking about this aircraft carrier, that you have added so much market cap to these companies, and how many aircraft carriers will India make, and each, I assume, will take, 10, 15 years to deliver. And so these profits, even if you get one order, two orders, will take 15 and 10 or 10 and 15 years, and you give them the market cap today. So most probably that cannot end well. The issue is that whether these stories, which are quite a few, not very few, but quite a few, if they deflate, are they enough to bring down the rest of the market? And my thinking on that is that it might slow down the returns, but it won't make it go against the world. For example, if the world is okay, then we may underperform for a few months and things like that. But it is still going to be better than what other choices you may have in India. And relative to the world also, it will be adequate, if not the number one market for the next, say, 1 year. And if they increase taxes, then that will really, really make India on a post-tax basis not very different from a normal any other market where the taxes for most of these investors is zero. We were, these pension funds and endowments and funds based in Singapore, Hong Kong, Dubai, which is where the money centers are, and the pension fund, sovereign fund endowments who are anyway tax exempt. Then if we are outperforming on a pre-tax basis by maybe say 100, 200 basis points a year, that means Indian market goes up, say 12% per annum in dollar terms, and the other markets go up, say 9, 10% even. Then post-tax, you'll also become similar to them. Then what is the big story?
No, got that. Although on a philosophical level, the pushback to that is governments around the world have realized that you've got to keep markets strong, right? Because you can always...
No, not pushback. You mean that it may not happen?
It may not happen. The reason it should not happen.
Pushback means that no, they should increase.
No.
Yeah, I agree. No, I'm also hoping. I'm looking at the clock. It's Thursday 11th. I think you have 1 or 2 days before these things get frozen in the budget, I assume, and then they go for it. It'll be too late to give these interviews then. Better to say now that please don't do it. It's not worth it. You are getting a lot of money on STT. Yet STT you are not putting in that same pool, and therefore we keep saying that, oh, the equity guys are getting lower tax relative to the bond guys or the debt guys. But let me say one thing, that if it comes through, then in theory, the biggest beneficiaries will be the banks. Relatively, of course, everything might go badly those days, but relatively, it would mean that you are making it easier for the public to, not easier, but you're making the two a little bit more this thing in terms of tax preference and what is the interest of the government, which it must be then that the asset allocation is getting influenced by tax considerations, although they are not transparently counting STT on the equity side and taking that as an aside and then saying the tax rate is low. So actually, it's not that different, I think.
One more thing, again, this is, we don't know if it'll happen or not, is on the debt side now, everything is taxed at the marginal rate, except arbitrage.
Yeah.
Arbitrage, and that may also get corrected. I don't know. I mean...
that's possible. But right now, I don't go so deep. I'm just doing big picture that this is wrong to have, remove STT, remove anything which is giving tax and say, no, but excluding that, the tax is low.
So suppose we do get some sort of a tinkering, right? Increase in holding period or increase in the amount, the rate, markets will fall. Will that fall be a buying opportunity according to you, or do you think this will really unsettle the markets for a longer period of time?
It will fall, according to me, very simply about the same as the tax hike. Because let's say going in, you have a pre-budget expectation that you should make X% return. And so if you take 5%, it will fall broadly similar to compensate for the current holders. Then the new holders know that this is the new rate and all that, and then they change. So I think lifelong flows will moderate. As I said, it's a big picture thing. It doesn't mean it's bad or you'll have negative returns. But obviously, why should new allocation come in the same way if the expected returns from the market, instead of being 12%, are 11.4% or whatever, cut whatever. How can it be? I mean, that means these numbers have no meaning. That you can, whether your expected returns are 12 or expected returns are 11, it doesn't matter, because the models work like that, the thinking works like that, and the differences are only this much. It's not that 12% will become 5% return expected for long term. So obviously it matters when these big guys do their allocations, and you can see what happened in 2018, which was after a good rally. There was a tax hike of 10% effectively, because the long term was 0 before that and became 10. Now we can keep saying it is because of COVID, this, that, but if you see the cumulative flows of FIs in India, although they are good, they are not of the same scale as we used to have when we were a much smaller market. And I can tell you direct conversations, of course, these guys being, don't come on TV and tell you directly, but they are most bothered by the tax. Because there is no set-off, because they are tax exempt. For our investors or investors in ETF, there is no set-off. They have to pay tax a second time in the US. Because if a guy comes into an ETF for 2 months and goes away, how to link the tax that the ETF paid with that underlying guy? What certificate to give him that this much tax has been deducted on your behalf? That is why the world doesn't take tax from foreign investors, for example. But here we are not saying that there should be a different tax rate for foreign and Indian. You please increase STT a little bit. It'll solve all your problems. You still get the same pool of money. You will also discourage short term. You will also discourage F&O indirectly by increasing that cost. You will get whatever amount you want. Just change the structure of how you collect it. You increase it as much as you want. I don't think any foreigner cares. It is just this, it goes into a, basically it's gone without having any, this thing, because you might book and, like for example, first quarter is good. So you have accrued a tax, the NAV has become like that. Somebody has come in, somebody has gone out, and then there's a fall in the market. Now there's no tax to be paid, but somebody has redeemed at a low price, high price, all those things are the...
Yeah. Got it. No, I think very convincing arguments, Samir, and I hope that you're being heard in the North Block.
That depends on whether they are watching your channel or not.
They are. Thank you very much for joining us. Always great speaking with you.
But I just didn't want to answer the same question again.
No worries, Samir. I think I've got, I got the point. So let's see. We'll keep HDFC Bank out, but let's see. All right, Samir, thanks a lot for joining in and filling us in with all of those views. Well, let's focus on the railway sector now. Railway stocks have had a strong run this year. And one such stock that's on our radar is Texmaco Rail as well as engineering. Now, with the union budget around the corner, what is the industry expectations and how is momentum shaping up? We have Sudipta Mukherjee, the managing director of the company, who joins us on the show. Hi, good morning, Mr. Mukherjee, and thanks a lot for joining in. Well, before we get to your budget expectations, give us a quick update. What's your order book right now? And if you could just break it up for us.
Good morning. Thanks for having me. The order book, if you say it's around 8,000 crore and 5,500 crore is related to the freight rolling stock and balance spread over to the steel castings and component, and of course up to our EPC division.
All right, so that's not much change. The last time you joined us as well, it was around 8,000 crores odd. But you were talking about a large tender opening up for around 29,000 wagons. When does that happen?
It's difficult for me to tell because we are sitting on the other side of the table. But as far we know that it is due soon, and the numbers may be even more, not even 29,000.
Okay. What about the budget expectations then? What are the crucial numbers you're looking forward to in comparison to the last budget? Expectations from an industry perspective?
Look, as per the interim budget, whatever be the outlay was planned, which was significantly in line with the expenditure which Railway did. So we as a stakeholder look at it from a little long-term perspective rather than a year-to-year thing, because we all have seen there is a shift based on a plan in last couple of years. So I will not be astonished if it is being increased a bit in terms of as an impetus to the infrastructure. But even if it is the same, it is good enough to, to fructify the plan what government has in the near horizon for 5 to 7 years time. And it gives enough room for us to play and to grow the way the industry is doing in the last couple of years.
Okay. Sir, getting to your wagons business, I believe the wagon dispatch surged from 1,600 in FY22 to 7,000 in FY24, and you anticipate it to increase to 1,000 wagons per month. That's 12,000 in a whole year from last year's 7,000. How soon might we hit that run rate?
I will not prefer to be too specific in terms of the 1,000 number, because you know that it depends on the various combinations of rolling stock. In Texmaco, if you see that we are the only company out of the existing lot that we have the most versatile portfolio, and our customer base expands beyond even beyond the country to all other continents. So it depends on the design and the number, but I can give you an indication that over and above whatever we have performed, we strongly feel that we will be still able to further grow around 40 to 45% this year, if not more.
Okay, so 40-45% top line growth this year, right?
Yes.
Okay, and what will export contribute? Because you are targeting the export opportunity.
So we continue to export freight rolling stock and of course the components of it. We do castings also, steel castings we manufacture, and we have a strong customer base in US. And other than that, of course, we do some brake frictional items through one of our JV, and we export to America, Australia, and all this part.
Okay, all right. Well, there was a demerger that was announced as well. Could you give us the timelines? By when do we see this taking shape?
So it's a process, it's in process, and very soon you will get to know. The company is keenly, have complied with all the relevant requirements of it, and we have received some communications also. And of course, while that goes on, and I would just like to give you a picture of the thing that Texmaco is evenly poised and in a very benefiting position. Because if you see that in the proposed demerge entity, we have our portfolio for signaling, overhead electrification, track laying. So all of these are buzzwords now, and government expenditure is also very high. So either way, it's not affecting, but we are only waiting for the process to get completed.
But sometime, I think the last time you suggested that maybe in the middle of this fiscal year is what it could, we could see some kind of movement. Do you expect it in the second, third quarter of this year?
I think, yes, it's a fair guess.
Okay, and the demerged entity, both those two verticals together, the energy, green energy as well as rail, what could the potential turnover of both these two businesses look like? You could give it to us on a quarterly run rate or maybe on an annual run rate as well.
So I would not be able to be too specific, but one thing I can tell you very clearly that we have a very clear vision in terms of, or a clear task and a focus in terms of the existing business line and the product portfolio of the companies. If I may take 1 minute more from you.
Yes.
So the existing businesses, if you see, is the freight rolling stock, the component business, and the casting business, as well as till it is demerged, the overhead electrification, signaling, and the EPC part of it. We have a clear task in mind to grow these businesses irrespective of the situation, because if you see, the customer has a long-term plan and a huge expenditure outlay is being already, consistently we can see. And with our kind of credential, as I say, in the domestic as well as in Europe or in other continents, we have the credential and we have all the certifications to cater to. So we do not want to sit idle. We want to significantly grow all these businesses coming from this financial year. And of course, our focus will remain, we are trying to put Texmaco as a brand with a focus to people, the research and innovation, and to be a technology partner, technology company. While I say so, if you see in the EPC and all other segment, there are significant expenditure by the government on the safety of the railway infrastructure. So this could be a possible avenue for growth, although maybe today it is too early to comment, but to give you a figure that what will happen in the coming year or what would be the turnover, I will refrain from. But I can say that you can expect a significant growth and many good developments around whatever we do. It will be exciting.
Point taken, sir. Mr. Mukherjee, thank you very much for joining us. It's good speaking with you and getting a perspective. And hope you're able to join us after the budget. And I think we'll have more to talk about then once we have allocation numbers, etc., right? And any new announcements in that sense. So thank you very much. I just want to point out a few names here in the broader market. Look at BSE, Bombay Stock Exchange. It had fallen from a high of 3,500 recently to about 2,300 yesterday. It's got a 5% move going for it, about 23.76 right now. And that's an interesting move because, it's right in the center of everything which is happening on the regulatory front, in the only listed equity exchange. So that's a large move. HPL Electric, there was that 2,100 crore order that we saw. It's up 12% now, 523. It's a pretty large one. HBL Power, maybe we could sort of look at as well and see what's happening on that one. There is, of course, that's about 2% pop. Zaggle is another company, interesting name, 5% on that one, 307 on Zaggle. Atul Auto has had a very nice move, 5% higher on Atul Auto, 791. And you got, of course, this Mishra Dhatu is a PSU defense name, Midhani, 532 on that one, going for it. And of course, all these sort of shipping companies, SCI and Cochin Shipyard and Garden Reach, they're up. SCI is the big one with a 12%. The other two are up 4% each right now. So this is essentially the bulk of the big volume-led gainers that you have right now. Nifty itself, and this is something we said in the morning as well, it got a good start, but would you want to chase it? Probably no. It's more defense, and it's come off from about being 70 points higher. We're up about 10 points or so. So we are at about 24,330. We slip into a break and we'll come right back in a bit from now. But just a quick programming note here. And this is the important one from a central bank perspective. Will the RBI cut rates this year? And is the RBI worried about a bubble in stock markets? And is India poised for a GDP upgrade? That's all of that, of course, answers to those coming up with the definitive RBI Governor interview later today right here on CNBC-TV18.
Welcome back. Well, the markets are holding with very, very slim gains as we speak. The problem is the Nifty Bank that I think did see some bit of selling pressure, and that's the one that's relatively underperforming. But let's move on then. With a population of over 1 billion people, India generates a massive amount of data, but the capacity to store this data has been lacking, implying that most of the data generated in the country gets stored overseas. Now, with the government keen on storing domestic data in India itself for multiple reasons, and with factors like power cost in favor of setting up infrastructure, a huge opportunity is opening up for the data center space. Take a look.
India generates about 20% of the global data but has only 3% of the world's data center capacity. This means that a significant portion of India's data is stored overseas. However, this is set to change as India emerges as a significant player in the global data center market. India is attracting huge investments for data centers, and here's why. Number one, Capex cost for setting up a data center in India is about 45% lower versus the world average as per CareEdge. Second is power costs, which account for nearly 80% of operational costs for data centers.
Each of our clicks from our mobiles or laptops or desktop or our smart TV is actually going into a data center, where that data is stored, where it is getting processed, computed and stored and given back to us. 3% of the worldwide energy today is actually being consumed in a couple of thousands of buildings in the world which are data centers. And this, by the way, is a number higher than the total energy consumed by the entire airline industry of the world.
And guess what? As per former Power Minister R.K. Singh, India has one of the lowest power tariffs in the world. Number 3 is the support from the Indian government. Data centers have been granted infrastructure status by the government during the Union Budget FY23, making it easier to access credit and secure foreign funding.
Data centers and energy storage systems, including dense charging infrastructure and grid-scale battery systems, will be included in the harmonized list of infrastructure. This will facilitate credit availability for digital infrastructure and clean energy storage.
The government's push for data localization through Digital Personal Data Protection Act 2023, RBI guidelines for storage of payment system data also is a major growth driver. Draft data center policy dated November 2020 is also another enabler. Recently, India topped major APAC countries with the highest data center capacity in the Asia-Pacific region, excluding China. According to a CBRE report, as of May 2024, India has 152 data centers with an operational capacity of 1,074 megawatt. This capacity is set to double with an additional 1,000 megawatts to come up by 2026. The per megawatt cost for setting up data center in India, which was close to 40 to 45 crores, has now risen to 60 to 70 crores per megawatt due to incremental land, equipment and other soft costs. This means an outlay of 60 to 70,000 crores would be needed to set up 1,000 megawatts, out of which 60 to 65% of the cost would be towards mechanical and electrical equipment. This opens up a huge domestic opportunity of 36 to 46,000 crores for suppliers to this ecosystem.
In data consumption, you have data centers where India is one of the hottest market in the Asia Pacific region.
What is the asset owners? The companies which provide the land, and they are the real estate companies which are exposed in there. And second are the companies which kind of provide some nuts and bolts to data centers, which could be gensets, which could be power supply or some specific type of maybe transformers and areas like that. So these are the few parts of the supply chain of the data center business which taking exposure to, particularly over the next 3-5 years, could add to good amount of maybe kind of growth or earnings momentum to the portfolio.
Let's look at it on a granular level. Gensets, which ensure that data centers remain operational during power failures, present an opportunity of 3,400 to 4,300 crores. Cummins India and Kirloskar oil engines are the likely beneficiaries. Motors, which are essential for operating various mechanical systems within data centers, would require 7,300 to 9,200 crores of investments, which will drive demand for products from Siemens, ABB, Crompton and Bharat Bijli.
It has emerged as one of the fastest growing segment, and in our assessment, I think it is going to be a multi-year, if not longer, in terms of how this segment is going to play out.
Switchgears, crucial for ensuring efficient and safe power distribution in data centers, presents an opportunity worth 7,700 to 9,800 crores, beneficial for manufacturers like ABB, Siemens, CG Power, Hitachi Energy and Schneider Electric. 2,100 to 2,700 crores worth of investments for transformers and GIS substations will boost order books for Schneider, Bharat Bijli, Voltamp and Transformers and Rectifiers India. HVAC systems essential for preventing overheating in data centers present an opportunity worth 7,700 to 9,750 crore. This bodes well for players like Voltas, Blue Star and Johnson Hitachi. And that's not all. There is a huge runway for growth beyond 2026 as well. Jefferies expects data center capacity to reach 17,000 megawatt by FY30. And this in turn implies a long runway for capital good companies as well.
Okay, the rise of AI, the data revolution, the government push could all drive a decadal opportunity in India's domestic data center business. To talk more about it, we have Sunil Gupta, co-founder, MD, CEO at Yota Infrastructure, and we also have the analyst of Arora with us, Harshit Kapadia. Thank you, gentlemen, both of you, for joining in. Let me take off from the last point that my colleague Vamakshi left it at. Jefferies believes the data center capacity in India will hit 17,000 megawatt by FY23. So the first question is, if you could just tell us, Mr. Gupta, what is the current size right now and how much is already in the work? 17,000 may be the opportunity, but right now the plans are in place to hit what by which year?
So yeah, good morning, everybody. So Indian data center industry, which was just about 200 to 300 megawatt till about 2013-14, got a big fillip when hyperscalers came into India, and suddenly all the other tailwinds like growth of e-commerce, growth of mobile penetration, fiber penetration, everything started growing big time. Cloud adoption became a very, very big thing at that time. From that time to now, the current Indian data center size has already become about 1,200 megawatt. It is expected to become double based on announced capacities and the capacities which are under construction. It is expected to become about 2,000 megawatt by 2027. And based on the projections by 2030, this capacity is expected to become about 3,000 megawatt. Now, there is a delta between this 3,000 megawatt and 17,000, and that delta is coming because of the artificial intelligence, generative artificial intelligence push, which is coming on the top of this 3,000 megawatt, which was supposed to be based on enterprise workloads and cloud services.
Right, Sunil, hi, morning. Harshit, morning. What is the sort of operational capacity at your company, at Yota?
So we have operational capacity which is about more than 100 megawatt right now, spread across our campuses in Delhi and Mumbai. And the way we did it is we sort of anticipated this growth which is going to come up in the next couple of years for hyperscalers or otherwise. And we took a campus approach so that the same campus which today possibly have 50 megawatt can be scaled to, let's say, 700 megawatt in future, just by keeping on adding up more data centers in the same campus.
So when you say, in terms of tenancy of these data centers, is this, when you say hyperscalers, you mean for cloud providers, right?
Yes.
Or is it more co-location where, a company builds a data center and then kind of sort of, rents out the space? So in India, which segment will grow, and how do you see that going? Yeah.
So essentially, both the segments are growing. The way we divide as the industry, the market is one is co-location and second is the cloud and managed services on the top of that. The industry which is growing very, very big in the last couple of years is co-location market, where
you are building up large capacities, and lease out the space with power and cooling, and somebody else like a hyperscale cloud operator or large enterprises or let's say GCCs, they will come and they will put their hardware and software and essentially the IT in your data center. Essentially, data center operators acting as co-location. However, some of the legacy players who have been operating for last 20 years or so, as well as my own company, Yota, we adopted a model where besides giving wholesale and retail co-location, we also build our own sovereign clouds. We are delivering a whole lot of managed services, and recent foray, which is known by Yota, is on GPUs to give GPU on as a service model. Now that is something which is coming on the top of co-location. So in the same building, if you want to adopt that hybrid model, you can offer wholesale co-location to hyperscale cloud operators. You can give retail co-location to enterprise customers, and you can also have a capacity reserve which can be used to deliver your sovereign cloud, AI GPUs, and other managed services.
Okay, all right. Hi, Sunil. Good morning, and thanks a lot for joining in. Give us, a couple of reference points then. The cost, I believe, to set up a data center is around 60 to 70 crores per megawatt. Would that be a decent number to work with?
Yes. In case we take data center at a co-location level, that is the right number, right?
Okay, all right. So what is then the payback period? What kind of returns do you expect? And, by when will it break even if you're going to be spending 60 to 70 crores odd per megawatt?
So essentially, it's so much depends on the fill factor also. So many times, if you're lucky, you are able to get an anchor customer even before your data center goes live. So your paybacks become as early as 2.5 to 3 years also. But in case you are making a speculative bid and you want to have enterprise customers who will be coming in only after the building has gone live, and they'll be giving you retail business and not really a very wholesale business, the payback period can extend to 4 or 5 years. On this investment around 60 to 70 crore per megawatt of IT load, the returns typically are around, I'm talking in dollar terms, around $80 to $100 per kilowatt per month. So if we just do the math, this is something which can give you a reasonable return of around 12 to 18%.
Harshit, come in on the discussion, right? Vamakshi told us that there are many ways to play this entire boom. There are genset manufacturer, transformers, capital goods. Which companies, according to you, are best placed to take advantage?
Morning. So on the capital goods side, which is largely related to do with electrical systems, we have Siemens, we have ABB. So every product has a different company to play with. So if I want to play gensets, probably Cummins is the best play on the genset side, followed by Kirloskar engines. And there are some unlisted players as well. On the switchgear side or substation side, we have ABB, Siemens, Schneider, but part of the Schneider is also unlisted. The listed entity is largely into medium voltage switchgears. That's how, and Hitachi Energy in terms of substation related work. So these are the companies that one could benefit. On transformers specifically, we have Voltam transformers on the distribution side, followed by Crompton, ABB, and Siemens. So these are largely MNCs who dominate the space on the gensets, on the data center side.
Sunil, just one sort of question. For example, I was listening to this interview by the NVIDIA CEO, Jensen Huang, right? And he was talking about how their next chip, right, is going to essentially replace data centers. I mean, all of the processors in a data center, because it's going to be so powerful. And when we talk a chip, we usually imagine like a small little thing. It's not. I mean, it's a big thing. It costs, I think he said about $200 million. But he said it is going to be so cost efficient that it's going to over his lifetime, just the cost of copper wires in the data center will be more than this. I mean, what the chip will do for you over the life of its operation. Technologically, is it all settled, or will we see a revolution, or is it only evolution? Just wanted to get a quick sense.
I think the market is changing dynamically. Right now, we can clearly see that the traditional workloads which were there in our professional and I would say personal life till date, the ERPs or the e-commerce applications, websites, email servers, for majority of the use cases which we have in our lives till date are getting served by CPU-based servers before the advent of AI and more specifically generative AI. Now, in case of generative AI, you are actually training the machines with a huge amount of data so that the machine based on some algorithm, becomes artificially intelligent and start making decisions for you or start doing some creations for you.
Sunil, sorry, since we have, my question was, will what data centers right now look at typically? Will they change dramatically? So a lot of what is riding as opportunity, will it all be there, or because the technology itself will change in terms of how you store data and you don't need these huge things? So I'm just, yeah, go on.
In terms of the capacity, it is being said by various people that whatever capacity which worldwide has been put in for data centers for traditional loads will become at least double, which means AI will present as much more capacity opportunity for data centers. While in India, we are talking about from 3,000 megawatt to, I just now heard from your program that somebody has also talked about 17,000, but nobody is able to actually assess that once this huge number of GPUs and a widespread adoption of AI starts happening in our life, what type of growth data centers will see. But it is very sure that whatever capacity of data centers have been built in India or worldwide, you will see at least double or triple of that capacity coming in purely because of artificial intelligence. Number one. Number two, the type of data centers we are making today, which are essentially on a per unit of a rack cabinet, you are giving, let's say, 6 to 8 kilowatt of power. You will end up giving 50 kilowatt, 100 kilowatt or more power per rack. Essentially, the data center will become very, very dense. The technology, the engineering which we are using to give power to the equipment and also, and more importantly, to cool this equipment will change dramatically. Just to give you an idea, we are using some sort of a cooling called air-based cooling, which will basically change to a water-based cooling where you're taking water right next to the chip, maybe putting water right on the chip or immersing the chip into the water itself or some sort of a liquid, so that the heat can be extracted as early as possible. So the data centers, while as on today, industry worldwide is trying to retrofit the current data centers to handle these chips. But the data centers of tomorrow, which Jensen is calling as AI factories, will be very, very different, which will be purpose-made for the purpose of handling these chips, where the technologies, especially the cooling technologies, will be very, very different from what we are using today.
I got that. And we're talking about coolants, right? Is that we had the management of Gulf Oil lubricants in the morning, and they were telling us that right now it's very small. I mean, it's a new technology, it's emerging, but maybe but you're saying it's an established technology and it's much more efficient as compared to air conditioning, right? That's
No. So for, as I said, that majority of the data center, the widespread, most commercially used technology is still air-based cooling.
Yeah.
There are new technologies which are emerging where you are still taking water right close to the chip, possibly putting some cooling plate and then doing, but you are not actually immersing the chip into the water or some sort of liquid itself. The new technology which you are talking about is where you are dipping the chip into a liquid itself. Now that technology is evolving. People are using proofs of concept. They are doing some pilots. They are putting their CPU servers in that, but NVIDIA is yet to certify putting in their GPU into that liquid. So the chip which is going to use the maximum amount of power and which require most amount of cooling is yet to be certified for those liquids. But what I understand from my discussions with various players, including NVIDIA, that some sort of the certifications and that the testing work is on. My personal feeling is that is the technology which will take over, because to cool that amount of heat generated by GPUs, the best way is to actually dip the chips into that liquid itself, so that the heat can be extracted right then and there.
All right. A lot more questions, but no time. But so what we'll do is we'll make this part one of our discussion on data centers, and we'll have both of you back soon again to talk about this evolving new market. Not new, but evolving market. Sunil and Harshit, great speaking with both of you here. Thank you very much for joining us here on CNBC TV18. Markets are up about 35 points. Mitesh is with us with a quick trading view. Mitesh, how things looking, and what are your trades?
Yeah. So, Prashant, I think, the markets are pretty okay, still sideways. Therefore, I think trading is more stock-specific. SBI Life has just broken into fresh highs, and insurance stocks have been doing well. So, buy here with the stop at 1550 for targets of 1610 to begin with, and maybe then we can see higher level, because this is a historical high for the stock. And the other stock which I have on my list is a sell on Sun Pharma, where some profit-booking signs are visible. I would recommend today's high as the stop loss, which is about 16 or 200 for targets of 1545.
Okay. Thank you very much for that. By the way, HDFC Bank is a bit of a drag, and that's the reason why the Nifty and the Sensex have flattened. They opened up in the green, but now they're flat. We'll slip into a very short break on that note. We'll come back and focus on commodities with Manisha Gupta.
We were getting APM gas, which is at $6.50. From 82%, it has come down to 68%. So there is substantial reduction in the APM gas, which is the domestically available cheap gas. And the LNG prices were earlier down, but now it has started increasing again. So we are constrained to increase 1.5 rupees in the CNG prices. However, still we are the cheapest in the country in terms of CNG prices and PNG prices. Budget is passed and what is included in the budget or not. The other point which we are hearing is maybe the gas can be included in GST, because if that so happens, then excise duty cut will not be required. It will be one tax regime for the gas segment itself.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest running show on startups and entrepreneurship, celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21. Only on CNBC-TV18 and CNBCTV18.com. CNBC-TV18's most comprehensive and award-winning news show, India Business Hour.
Welcome back. So the commodity which has been shining bright is gold. Now, gold has given a return of 14% since the beginning of the year, and it's outpaced the equity return. But the only thing that shines brighter than gold is our birthday girl, Manisha. Manisha, wishing you a very, very happy returns, from the entire team. I hope you have a wonderful day and a wonderful year ahead.
Thank you
so much. And we'll see you every day.
Thank you so much, Nima.
So take it away with gold.
Absolutely. And as you said, it's outpaced and outperformed various asset classes. We are 14% up in the first half, and the second half has started on an even stronger note. We are holding around that $23.50 an ounce for some time now. $24.50 is an all-time high that the gold prices saw in the month of May. And there are various reports suggesting that you could be looking at fresh new all-time highs now in 2025. There are various supportive factors, and I'll take you through them. Well, the major reason that you have seen support continuing is that the central bank buying has been quite strong, and so has been the investor buying. The last 2 years, we've seen record buying from central banks, more than 1,000 tons per year. And this year as well, there are various reports suggesting that we will hit that 1,000 tons mark this time as well. The macroeconomic conditions are quite uneven, and then there are expectation of rate cuts from various central banks, including US Fed, and that would continue to support the gold prices, which is dollar denominated, and that is where the support comes in from as well. Dollar index also trading around that 105, which is a near 2-month lows, also has been supportive. This is what we've seen happen in China, where you did see the first quarter China buying at 189 tons and 137 tons in the second quarter. China actually has been buying quite strongly. And when you look at the overall gold mining globally, China buying to the tune of that is almost at around 25 to 30%. And that is what is expected to continue going forward as well. So strong central bank buying, China buying the most of it, has been a supportive factor there. The other thing really is about on where do you see the prices going on from here. And there have been various reports that have come in for the second half of this year now, reiterating that they are looking at higher gold prices going forward. So this is a report from Citi which says that they're looking at $2,400 to $2,600 an ounce of gold by the time this year ends. Bank of America believes that the gold prices will average around $2,200. We are trading at $2,360 right now. Deutsche Bank is talking about $2,400 as well, so we can go higher from here. JP Morgan talks about $2,300 of an average. Now UBS talks about $2,700. Remember, we're trading at $2,350 right now, so $2,700 by mid-2025. Most of these banks also believe that there will be rate cuts. Inflation is a concern. Central bank buy will continue. And also, it's not just about central banks, but investors, ETFs, physical buying will also pick as we go ahead. So gold clearly in favor.
All right. Thank you very much, Manisha, for that. Well, we'll take a quick commercial break here. Our special segment is the economy coming up next. My colleague Lata will get chatting with Amit Basole, Professor of Economics at Azim Premji Institute, to discuss the recently released surprising employment data by the Reserve Bank. Stay tuned. That's coming up.
On YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhatt.
India Business Hour live on YouTube at CNBC-TV18 weeknights at 7 p.m.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go. Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC-TV18, now streaming live 24/7 on YouTube.
The Indian markets have not just grown, they've broken several records in the last 25 years.
India's contribution to incremental global GDP was as low as 0.2% 25 years ago. And the long table. Welcome to It's the Economy. The employment data released as part of the RBI's CLEMS data, the tables are a bit surprising. As per this data, 42 million jobs were created in FY20 and 31 million jobs in FY21. Remember, both these were peak COVID years. And if you compare it, in the earlier 6 years, that is from FY13 to FY18, when GDP was growing well at about average 7%, the average rise in employment per year is only 500,000 jobs. So 500,000 jobs when you're at 7% and 40 million jobs when you're in COVID. That's surprising. Again, in the latest year, FY24, the year that just ended, 46 million more employment opportunities were created. Now, FY24 was a good GDP year, 8.2%. But private final consumption grew very badly at only 4%. Now, again, this doesn't tie in if so many jobs, 4.6 crore jobs were created. To get a handle on why the employment numbers are not in sync with GDP growth, I have with me Professor Amit Basole of the Azim Premji Institute. Amit specializes in employment studies. Amit, thank you very much for sparing time for us. So, I'll try and request the team to run those numbers. If you looked at the annual rise From FY13 to FY18, 6 years, totally we are creating only about 2 million jobs. And then you come to FY20 and 21, we are creating 30 million and 40 million jobs each year. When, you know, GDP was contracting. Why is this so much not gelling, growth and employment?
Right. So I think to understand this, you know, we need to understand what kind of employment has been generated in recent times. And this is something that has been covered in the previous year or so. There's a debate on this, that a lot of the additional employment we have seen has come in the form of self-employment, own account work, tiny mom and pop kind of enterprises, or unpaid family helpers. And a lot of it is driven by women's workforce participation rate rising, which had been falling earlier. Your viewers may know that between 2004 and about 17 or so, there was a decline in women's participation rate, and then there has been a rise in it. So that kind of both accounts for the weak employment growth before and the strong employment growth subsequently.
Okay. Actually, we'll try and pull out that data also. On own account work, we have actually seen the number of people employed rising from about 21% of the total employment to 30% of total employment in 6 years, as you point out. Again, unpaid work, again, if we can pull that data, total percentage was 27.9 in FY18, and it rises to 33% by the time we come to 22-23. Now, unpaid work obviously is unfortunate, but is it possible that this own account work, formal employment is not rising, but there are more gig workers? People supplying for the Zomatos, Swiggies, or, urban company, people come and clean up houses now. Maybe these are jobs which are giving employment to people who otherwise would have been jobless. To that extent, it's positive?
So some part of it could be the kind of gig work that you're referring to, but we also know that a large part of this additional employment actually has happened in things like agriculture and petty retail and so on. So these are the clearest, surplus labor sectors of the economy where people work if they can't find work anywhere else. So they are sort of falling back into these sectors. I think that is the major story here, that some sort of a process which may include distress, incomes jobs not being available elsewhere, has forced people first back into agriculture, but also back into self-employment, etc. And those are the additional jobs that we are really seeing here.
Okay. Well, I take your point on that, but once again, let us pull up the annual numbers from FY13 to FY23. Those numbers will come up for our viewers. You see a seminal change from around FY19, 17 million jobs, FY20, 41 million jobs, 41.8 million, 22 is 31 million. It's a seminal jump as we come towards FY18 onwards. Maybe this is e-commerce picking up and therefore additional. I take your point that unpaid work also is high. So that must be people going back to rural areas after COVID and settling for, family farms or something. But what about this number, overall number increasing so much? Do you think that's a positive?
I'm afraid I don't think so. And in fact, the CLEMS data itself gives you a clue on this. If you look at the labor productivity numbers from CLEMS, you see a fall in labor productivity at the same time that the rise in employment starts happening. Around the year 18, 19, 1920s, yes, when we start seeing this rise in employment. That's when you see a fall in labor productivity in agriculture. You see a fall in labor productivity in trade. These are, again, those sectors where the crowding in of people is happening, right? So those additional employment is not a result of growth happening. In fact, people are sharing in the same amount of output, if you will, right? Labor productivity is dividing output by employment. And if output doesn't grow as fast as employment grows, the labor productivity falls. And that's what we have seen in these recent years.
No, that point is taken. As we can see, even in FY24, 4.6 crore jobs, 46 million jobs created. Of course, it's a good GDP number, but this is a large number, highest ever single number that we have seen. Now, this is also not gelling with consumption. Like I said in the introduction, GDP, if you divide it between consumption and capital goods, in the year that was, it was capex which pushed GDP up, not consumption. So is that also something that gives away that the job quality is not good?
I think so. And, this is also consistent with another number which came out recently, which is the ASUS, the Annual Survey of Unorganized Sector Enterprises. If you look at that data also, you'll see that the GVA per worker in the unorganized sector, in real terms, actually has declined. So we know that these multiple shocks that have happened over the last few years have affected the unorganized sector badly, and that comes up in these productivity numbers. So all of this, I think, is consistent with each other. That things are not going so well for one part of the economy. People are forced to work in some capacity because they can't remain unemployed, and that transition for women particularly, from out of the workforce to into the workforce, doing some kind of employment, shows up as a very big uptick in employment, but that's not the kind of full-time, regular, productive jobs, if you will, that we really want to see generated.
Okay, that's unfortunate. As you point out, productivity, and there was this excellent report from India Ratings also a day before yesterday, which pointed out that unorganized sector, exactly the as-used data that you point out, took away some 4.3% of GDP from the unorganized sector. But Amit, we are having a budget ahead of us, and already the PMAY, PM Awas Yojana, the government has promised will be expanded, 3 crore more houses. What would a good recipe be to improve labor productivity?
Yeah, I think this is really the main question. And I think, we have to think seriously about an employment policy, at the national level, which kind of coordinates a lot of different things we know need to be done for the labor market. That could include things like skilling, which the government has already been paying a lot of attention to. But even more importantly, I think scale up of the, MSMEs. MSME sector, we know, has not been doing very well. And that's where a lot of the jobs come from. So it is constrained still, we know, by lack of infrastructure, by regulations, many other things going on. That these are not new issues, but we need a comprehensive framework that says, okay, we are going to take the employment issue seriously. It is not solved. The creation of work that we have seen or employment is not the kind we need. So how do we encourage firms to pick up their hiring? To offer this kind of regular wage work, and firms will only hire if they see a promising environment out there in terms of demand, and sales and so forth. So that is really comes back to a macro question of, are we creating the environment where businesses feels like they want to invest, they want to create those jobs?
Okay, what is that environment? If you give subsidies, if you employ more, you may end up just, bloated numbers. How is the government to tackle it? There are some people who argue that state governments giving 200 units of power free may actually be good, because more children will study, more small units will be able to afford because they're not paying for at least some part of their power. Which is the way to go?
Yeah, and here, the fiscal constraint comes up, obviously, when you mention the free power, that a lot of the things that we want governments to do, both at central and state level, are not free things. If you want the government to give subsidies to firms, that's going to cost money. Power is going to cost money. Roads and basic infrastructure is going to cost money. Some of which, of course, this government has been very committed. The capital expenditure part, I don't think anybody can fault, on what has been going on. But somehow that is not translating into a private sentiment to invest. And that's really where I also don't have, the answers to this. But I think until we turn the corner on private investment, and particularly not in the corporate only, but in the non-corporate sector and the MSME sector, until we turn the corner and we get investment, we're really not going to get out of this hole.
Okay, these are hard questions, of course, for economists and policymakers, and we will do that in off-market hours. Thank you very much, Amit Basole, for bringing a very important point. Yes, employment numbers are rising, but labor productivity, according to the same sets of tables, is showing a steep fall, is showing a consistent fall since FY18. So we are creating more gig workers, but we're also pushing back maybe more people into farm labor, which is perhaps not as productive. The numbers are a bit troubling, no doubt about it. We have to wrap up on Bazaar on that slightly somber note, but none of these is affecting markets. At the moment, markets continuing with that slight red tick. Chartbusters will take the action forward.
Over the last 25 years, CNBC-TV18 has closely followed the remarkable ascent of India's pharmaceutical sector.
There was a time 25 years back that it was all about the FIIs. If FIIs would buy, markets would rally. If FIIs would sell, market would fall.
Earlier, we were net importers of steel.
From IT services to SaaS, from consumer electronics to space tech, from mere programming to AI ML.
Cars, two-wheelers, three-wheelers, commercial vehicles have significantly become much more expensive than they were 2 decades ago.
Discounting is high there, but their focus is squarely on the 125cc segment.
Now it is contributing 16% of incremental global GDP.
Now we are looking at exporting the steel that's made here in India.
Welcome to the first ever India Business Leader Awards.
Cars, two-wheelers and vehicles generally being manufactured today are much lower on emissions and much higher on safety.
India's technology industry has been at the forefront of cutting-edge innovation over the last 25 years.
It's the retail which is the driving force for the market right now.
Clearly, we have arrived on the global economic stage.
Great way to celebrate our own 25th year with new milestones being achieved on the Lal Street.
21 years of the Nifty from 1,000 to 10,000 today.
Sensex and Nifty hit a record high.
The Nifty rallying to a record high.
We invite you to join us as we persist in leading coverage of the pharmaceutical and healthcare domain, documenting India's expanding expertise in medicines.
25 years of excellence and unparalleled growth.
CNBC-TV18 embarking on a quarter-century of excellence.
Dr. Sunil, you know, one of the statistics say that only 50% of Indians brush twice a day. Do you think that's simply because of a lack of awareness? Or do you think it's also a cultural issue where, you know, one of the statistics that or reports that I was reading indicated
TCS, the stock trades with minor gains ahead of numbers today. The key thing to watch out for will be dollar revenue growth, which is seen at 1.3% year on year.
Ambuja Cements, that stock is higher in trade after Nomura. Well, they have a buy rating on the stock. They've placed their target price of 780 rupees per share. The key reasons that they give is that capacity addition will outpace the industry. Volume growth will also outpace the industry. And they said that they're perfectly poised to cut their cost going ahead as well.
Shalby Hospitals is up around 5%, now 4%, after it signed a 30-year lease for the Asha Parekh Hospital in Santa Cruz, Mumbai. And also the company sees EPS accretion from some of its acquisitions in this year itself.
IRCTC enables QR code-based ticketing for the Delhi Metro. Tickets now be booked up to around 120 days in advance on IRCTC's website and mobile applications. Hello and welcome to Chartbusters. I'm Nigel D'Souza. Joining me as always is Mangla Malu. Well, as we speak, the Nifty is down a little bit. The mid-cap index still in the green, and the Nifty Bank, that's under some pressure in today's trading session. Hey, Mangla.
Hi, Nigel. You know, good morning. We were looking at the markets opening at right into that resistance band, and that's exactly what has happened. The question is whether we see support or not. Once again, it's a Thursday. It's the Nifty Nifty weekly options expiry. So let's see where we go. We are in the middle of that 24,150 to 24,400 sort of range for the frontline index itself. But let's focus on a lot of individual companies. Savory snack maker, Bikaji in focus. Remember recently there was a Nuvama note as well, which initiated coverage on the company. and spoke about the strong growth potential. Bikaji itself has given a 13 to 15% sort of volume target for this year, with about 0.5% EBITDA margin expansion as well. In the middle of the second quarter now, how is demand? How is the business panned out so far? To give us a bit of a lowdown and an outlook, we have Manoj Verma, who's the COO at the company, joining in. Thanks a lot, Manoj, for joining in. Always a pleasure speaking with you. And that really is the first question. What exactly is the demand situation that you saw in the first quarter? Do you maintain your volume target of 13.5%, revenue target of almost 18% for this year?
First of all, thank you very much and good morning to you all. Now, coming on to the growth, I talk about, so there certainly was some mild slowdown last year, which industry witnessed. But the good thing is that there's an uptick in the quarter one this year, and this is both across rural and urban. With forecast of normal monsoons, this trend is likely to sustain. That's how we look at it. The numbers, what we have done is, from our budgeting perspective, we would go with what we have spoken about. And I'm sure time will tell, and teams would really work hard to if we surpass these numbers.
All right. So early mid-teens growth, early to mid-teens growth is what we should work with in terms of volume growth.
Yeah. So this would certainly be higher than the category growth. That's the internal numbers, how we look at it, basically. So if the category grows even faster, we'll have to further jack it up.
All right. The fear is hopefully the category doesn't grow slower, but it seems people are snacking enough. But while they snack, they'll also be looking at pricing. And we have seen that some input costs have moved up a little bit. Is that, how do you see that panning out? Have you managed to push through some price increases? If yes, could you quantify it?
So if you look at it, last year there was quite a relief which we got. So prices had come down big time, after continued 6 quarters price increase and increase. So what we did was that we passed on these price benefits to the consumer in the form of, say, consumer offers, 10% off, so on and so. And that resulted in, if you look back last year, our volume growth were higher than the value growth. This is one of many years kind of a case which it happened. Now this year in quarter one, what we've done is that we've pulled back or rolled back few of our consumer offers, and which is the kind of a price increase as well. We're managing the pricing very well in terms of the way our purchase teams have done their job. So we don't see price increase as much a challenge. And if time comes, we are ready in terms of passing it to the consumer. But for now, there's not much of a change.
All right. And what about the margins then? Because X of PLI, you had a target of about 0.5% improvement in margins. That would take your margins from last year to this year at around 14%. Is that very well on the cards?
That's what we said, yes.
Okay. What about utilization? I mean, last known number was close to around 40 to 45% of the overall capacity that you had installed. What's your utilization ramp-up target for the next couple of years? And by when do you reach the peak revenue potential of close to 4,500 crores?
So last year, if you look at the kind of volume growth we have delivered, and now we are at about 44-45% capacity utilization. The target for ourselves is about 13 to 15% volume increase year on year, and this would stand for next 2 to 3 years kind of a stuff, which eventually should take these numbers, to about 65-70% utilization. As we hit 80% will be the time wherein we'll start looking for further expansion kind of things.
There was some outstanding amount that you received from the government with regard to PLI, right? Have you received it?
No, so we have already received for 2 years. For third year, we have filed it this year in April. I think in a couple of months' time, we should get that money.
And the quantum was what, 40-45 crores?
That's correct.
All right. What about the overseas market? Currently, it's a very small part of your pie, but say in the next 3 to 5 years, where does this mix go to? I mean, in terms of exports.
So yes, exports market is not a very big pie of our business. It contributes to about 3.5%. Going forward, also the percentage contribution would not move very high because the kind of growth what we are looking for domestic markets as well is more or less in line. But yes, we would look forward in next 3 to 4 years, we should be doubling this the exports business for us.
You know, the acquisition that you made of Bhujial Algae about a year ago, you were looking at revenues of almost 100 crores coming in from their business by FY26. Is that still on the cards? What did FY24 end at for Bhujial Algae? And what is the target for FY25?
So we were looking at 100 crore revenue by 27. That's what was we said 5 years time, right? It's well on track. In fact, now if you look at last year also, they've done well. And in Q1 also, it's the numbers are in line with what the budget we had for this brand. This was a strategic acquisition which Bikaji made to have a brand B strategy, and is working well for us.
All right. And, you know, generally when we speak to you, we also speak through you for the industry. You spoke about the industry growing at a certain rate and you trying to grow faster than that at around 13 to 15% itself. So I just wanted to know, how big are your other unlisted peers? Because, you know, when everyone speaks about the ethnic snacks space, there is a lot of chatter around Haldiram's, etc. So from your understanding, how big do you think their business could be, and the margins that those guys would be, you know, reporting as against you all?
See, this category is very huge, and that's why, you know, it is catching eyes now. That's one. Yes, there are very few listed players and large unlisted players as well. When we talk about the way category is growing, is basically the need some Nielsen data, some industry experts. That's what kind of data we refer to. Talking about the bottom line margins, I think, you know, the companies who are primarily into the Western snacks or high contribution of Western snacks would be a single-digit EBITDA margin. That's what we believe. And the companies who are very well organized would be, say, around 16 plus kind of EBITDA margins. I mean, that's the room wherein, you know, these EBITDA margins would be played.
And what would their revenues be according to you?
Yeah, sorry?
What would their revenues be according to you, Haldiram's?
Sorry, I'll not be able to comment. I would not have, because Haldiram is also in some merger. It's Haldiram Nagpur, Haldiram Delhi entities. Then, you know, they have their QSR business, and also it's not reported as well.
Would they be twice your size at least?
But yes, they're I think multiple times of what we are. Much, much bigger.
All right, final question before we let you go. What's the market share in both your core as well as your focus markets as per your estimate or guesstimate?
So overall, if traditional snacks we talk about, we are about 8.59% market share at a pan-India level, wherein, you know, if we speak about in our core states, it's about 45% market share. And in our focus states, it's much low. It's less than or close to 2%.
All right. You know, just one final question then, because you said that there are multiple of your revenue. Just roughly, is it 4 times? Is it 3.5 times? Just trying to understand, largely because you last year did revenues of close to 2,200 crores and your market cap is roughly $2 billion. The reports that are going around suggest Haldiram's valuation to be around $8 billion. So are they 4 times your revenue to command that sort of valuation?
So they would be around 4 times. That's true. I think this is where our guess is.
All right, take that point. Thank you so much for joining in and giving us an outlook into your business, holding on to your growth numbers as well. And through you, we get to understand or get a snack of what the Indian ethnic snacks market looks like as well. Always a pleasure speaking with you.
Thank you very much.
With that, we'll shift focus to a special segment where we get you ideas for profit coming in from our colleagues at Money Control Pro. And today we have Nitin Agarwal joining in to talk to us about a stock that he's been tracking closely.
The company that I have chosen for today is ZF Commercial Vehicle, which is an auto ancillary company and a leading supplier to major auto OEMs in India and in international market. There are a couple of factors that make us a bit about the company. First, industry outlook is encouraging. The fortunes of ZF series are directly linked to the growth in this commercial vehicle segment, and with the coming back of the government in the center, with the focus more on the construction, mining and infrastructure activity, the demand outlook for commercial vehicle looks very, very positive. Apart from that, in the international market, the company is expecting the muted demand for the commercial vehicle. However, they are expected to outperform the industry growth primarily on the back of the wide product portfolio. In addition to that, the management has indicated that the company is expected to outgrow the industry growth by around more than 10%, primarily on the back of increasing content per vehicle driven by the wider or newer adoption of the newer technologies. Apart from that, the company has been focusing on the sunrise EV sector, which is expected to augur well because this is also expected to increase the content per vehicle. In addition to that, the company has a leadership stature in the auto ancillary space, and it is one of the few auto ancillary company which have bargaining power with the companies across India and in the international market. In terms of valuation, the company is currently trading at around 46.4 times FY26 projected earnings, which is at a discount to its 10% discount to its long-term average, and hence we advise investors to accumulate this stock.
All right, thanks a lot for that. On the other side, we'll get chatting with the management of Kesoram Industries. P. Radhakrishnan, the whole-time director, joins in to discuss their first quarter earnings. Stay tuned for that.
Don't feel the need to brush more than once a day?
It's not a question of need. It is absolutely required. It's a mandate that you should brush twice a day. In the morning, to remove everything that has been lying in your mouth while you're sleeping at night, and the acidogenic bacteria that work on it and create harmful acids, etc., and to generate freshness. And in the evening, of course, to remove all food debris and material that may be going to remain in your mouth through the night. You clean it up, you rinse it, and then you go to sleep.
Okay, but what happens if you don't? If you can just explain to us what are the risks of not doing so?
So what happens is there's a buildup of what is known as a biofilm on the teeth, and the biofilm contains bacteria, especially bacteria like strep mutans, which is what causes cavities. So, and of course, gum disease has different bacteria, but there is a whole bacterial biofilm that happens in the teeth. So if you don't remove that biofilm, then the bacteria will remain there and they will act on the gums and of course on the teeth. And so the gum disease and the dental caries both will be a factor if you don't remove the biofilm. So it's extremely important, especially at night, because when you've just eaten and then you go to sleep and it has time to act.
Is it more of a rural problem? Is it also as prevalent in the urban population?
So I would assume, looking at the stats, that the rural problem would be slightly more because also availability.
Welcome back. Well, the markets are still sitting with a cut of around 60-65 points odd, but a lot of stocks are moving around, and one such stock is Kesoram Industries. Well, that stock is a little bit under pressure. The past quarter's numbers are a little bit subdued. To discuss the quarter gone by, how the industry trends are shaping up, and what about an update on the impending merger with UltraTech Cement? Well, we're joined by Mr. Radhakrishnan, the whole-time director and CEO of Kesoram Industries, who joins us on the show. Hi, Mr. Radhakrishnan. Always good to see you, and thanks a lot for joining in. Well, most of your business is going to be going to UltraTech Cement, but let's understand a couple of aspects. Point number one, by when does this entire, merger with UltraTech take place of your cement asset? I think earlier you were referring to by the middle of this fiscal. Going by the approvals, is that on track?
I would say before December, as things stand today.
Okay, by December, things will come about. Got it. And, the other aspect I wanted to ask you before we get full throttle on the cement businesses, earlier you were saying that the pending business, which is the rayon business, it could be looking at some infusion. And you were optimistic that by the end of this calendar year, you could come up with the money. I think you were scouting for around 150, 200 crores odd. Have you got the right feelers that you can come up with this money? I asked you this because even the past quarter, it went into an EBIT negative number.
Right. So we, first, there are two steps to it. One is the existing debt in rayon, which is about 220 crores, needs to be eliminated. And then fresh infusion of about 45 to 50 crores minimum has to be done, which we are working on. What is critical for this subsidiary to turn positive is scaling up of a transparent paper, which is biodegradable. In India, the transparent paper biodegradable product is yet to catch up as it has caught up in Europe, America, and other parts of Southeast Asia. We are confident it is only a matter of time before it catches up. Meanwhile, our product has to have certain features for us to expand our market globally, catering to this market. Therefore, we are, as you know, it is a public domain too, we are in tie-up with Futomura, the global major in transparent paper.
Okay. You know,
we look at strengthening the relationship and scaling up on the transparent paper. That's where we will move forward.
Okay. So the prospects of the business are very good, Mr. Radhakishan. But first, if you raise the money, right, that 220 crores you want to get done away with, and then you want to put in another 40 crores. So then you're looking at a fund infusion of around 250 crores. So let's not run ahead of ourselves, because the prospects of the business are good, but the initial step is to get the capital. Have you got the right feelers? Will you come up with this 250 crores by December 2024?
We are confident of doing that.
All right. And then the business turns around and starts generating an annual EBITDA number of close to around 60 crores.
Correct.
What about the finance cost? Because you said that you are looking to refinance this debt of 220 crores, right? So obviously, with the larger chunk of the debt going away on your books, what is your existing finance cost, and what would be the refinanced or the renegotiated finance cost on this 220 crore debt?
So currently it is 11.5%. And ideally, our endeavor will be to make it debt-free. Only equity infusion should happen.
Okay, so you are looking at full equity raising and not refinancing.
And only working capital debt of 30-40 crores should be there. It should not have debt beyond that.
So if I look at, 60 crore EBITDA, plus you have around 20-25 crores of finance cost savings coming in, some other income being added, etc. as well, fair to say that this business would be, making profits ex of tax of close to 80 crores?
This is fair, but the key to that is scaling up on the transparent paper. Therefore, infusion, that will have a gestation period of anywhere between 18 months. So this potential, full potential will get realized 18 months from the time this becomes debt-free. Then, and Futomura agreement is taken to the next level.
All right. So 18 months from now, maybe it's an FY27 story. If that is the case, then X of your Civil business, which you said will go out in December itself, what would be the top line of the company, and the bottom line you've given us a sense that could be around 75-80 crores?
So currently it is 300 crores. When it is 75-80 crores EBITDA generation or bottom line generation, the turnover should be in the vicinity of 550 to 600 crores.
Okay. Let's talk then. So we have got an outlook about the company. Let's talk about the business now. And now we get some trends for the cement industry. What was the volume last quarter? If you could give us a sense about that. And also, how did prices change? Between Q1 in comparison to Q4, you have exposure to South as well as West India. And if you could tell us as well, how are prices today in comparison to the first quarter?
So in comparison to the first quarter, prices today are flat.
Okay.
And between fourth quarter and first quarter, prices were off by 200 rupees per metric ton. That's where we were. The prices were flat and the demand was not as usual as the first quarter would be. Of course, the attribution is due to election in the states we operate in. Across the India, it happened, of course. So we did a volume of including some sale of clinker, close to 1.6869 volume we did, million tons, as against 1.9 million ton. But however, we are maintaining we will do 8 million ton for the whole year.
By that time, it will be already in Ultratech's book. So, and the last year itself was quite difficult. every quarter you're revising it downwards. So that's about the cement space. What about the EBITDA per ton? According to your calculations, what was it? I think in quarter 4 it was around 400 rupees.
It is close to, we include other income too, right? 487 is what our EBITDA per ton for the first quarter. Let's say close to 500.
And it compares with what in the in quarter 4? How much lower was it? Quarter 1 versus quarter 4?
Quarter 1 versus quarter 4, it was because the costs were better. 40 rupees we were better, in fact, EBITDA per ton.
Okay, so
the cost reduction was much better in quarter 1 compared to quarter 4.
So 450 has turned into closer to 500.
Yeah.
All right, take that point. Thank you so much for joining in. You had
just one more question, Mr. Radhakrishnan. You know, since we have you with us, a lot of buzz of consolidation. Now, normally we used to put that question to you and then used to say, no, I don't think that anything is happening. But that ultimately did take place. Have you heard of any other assets folding up? I mean that there could be a few of them. Have you heard the same?
I've not. I too read from the papers, a lot of buzz going around. Nothing more.
I'm sure you read from the papers and you read beyond that as well, because there is so much happening in the southern part of the country. Earlier itself, we saw the investment come into India Cements, and now what's happening here? What more?
See, cement is cyclical. Any industry where commodity consolidation happens, probably that's what is happening.
So more is likely to happen?
No, consolidation happens any industry, across industry, be it cement, steel, telecom. So
you must be feeling good, Mr. Radhakrishnan. You must be feeling good. At least now you're not so much in the hot seat. The pressure is eased a little bit. Normally the fire was on you, but anyway, your asset is going to go out. I believe there's going to be some more consolidation. So let's see how that takes place in the next 6 to around 12 months. But we look forward to chatting up with you at the end of this quarter and getting an update from you as well.
All right. Thank you so much for joining in. With that, we'll give you a quick programming note before we slip into a short break. We have a big budget exclusive for you today at 3:30 p.m. The CNBC-TV18 CII Budget Town Hall. It's the entire top brass of the industry body will be in attendance. We will quiz them on their budget expectations. We'll have Sanjeev Puri, Sanjeev Bajaj, Sunil Kant Munjal, R. Mukundan, Chandrajit Banerjee, B. Tyagarajan, Shenu Agarwal, people like Vinod Agarwal, and many, many more who will be speaking exclusively at the town hall for 25 years. CNBC TV18 has been covering the budget, the union budget. So keep it with your budget destination for all the big budget newsmakers, exclusive news breaks, and a lot more. 3:30 p.m. today, the big budget town hall.
Toothbrushes, toothpastes, and other oral health aids is much less than in the urban areas. But awareness, and as Sunil said, awareness and knowledge has to be imparted so that people will be more, able to do what they have to do.
I think it is not euphoria. It is like a stampede in the market. Even here in Ahmedabad, whoever I am meeting who is not at all related to stock market and from different walk of life, different field, business-wise, career-wise, and everybody is talking about stock market only, that they want to trade, they want to make quick money, and they want to break their FD, and they want to. Somebody was telling me yesterday only that he's working in some IT firm and all, and he want to quit and again join stock market and all. So I think that this situation is not. Personally, I may be wrong because I have been proven wrong many times in the past. But I think this will not end well. So SEBI should take very strict action to curb this kind of frenzy in the market or stampede in the market. Now the pricing power is coming with all these telecom service providers, like Jio has already increased the rates, and Bharti also has followed the suit. And same is with Vodafone. Numbers 15 players has shrunk down to only 3 players, and BSNL is 25% player, so 3.5 or whatever you call it. So, and one thing is the for sure. Earlier we used to talk about, in India, roti, kapda or makan. So now this is roti, kapda, makan or mobile. As I always say that even my driver keeps 2 mobile. I keep only 1 mobile, but my driver keeps 2 mobile. So how can you go wrong in all these things in this telecom? I think now since they have started increasing the rate, and so I think best time is ahead of them.
Welcome back. Well, the markets are in the red, as you can see. The mid-cap index, though, that's the flag bearer. That's the only one that's still trading mildly in the green. But otherwise, the markets are actually at the low point of the day. Yesterday as well, at the similar time when we were winding up on the show, the markets were a little bit lower, but we saw a good recovery by the time we wound up. So let's see whether or not the markets can bounce off even in today's trading session. For the time being, we wrap up on this edition of Chartbusters. You stay with us because Trading Hour comes up next.
Getting APM gas, which is at $6.50, from 82% it has come down to 68%. So there is substantial reduction in the APM gas, which is the domestically available cheap gas. And the LNG prices were earlier down, but now it has started increasing again. So we are constrained to increase 1.5 rupees in the CNG prices. However, still we are the cheapest in the country in terms of CNG prices and PNG prices. Budget is passed and what is included in the budget or not. The other point which we are hearing is maybe the gas can be included in GST, because if that so happens, then excise duty cut will not be required. It will be one tax regime for the gas segment itself.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest running show on startups and entrepreneurship, celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21. Only on CNBC-TV18 and CNBCTV18.com. CNBC-TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhatt.
India Business Hour live on YouTube at CNBC-TV18 weeknights at 7 p.m.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go. Create effective strategies with insightful expert opinions on the go.
Good morning. Welcome to Trading Hour. I'm Reema Tendulkar. With me, Surabhi Upadhyay, and she's back. Hi.
Yes. Well, I'm back with the market still around 24,300, 400. I thought by the time I'll come back, it'll be 25,000, the rate at which things are going, right? But I think maybe some nerves as we get closer to the big event, the budget, some consolidation perhaps. And I guess banks continuing to be a bit of a trouble spot.
Oh, absolutely. You know, we started off in the green. There was, you know, a positive handover from the global markets. And Asia still up 1.5%. But right now we are struggling a bit. The Nifty slipped about 150 points from the day's high, in the red now, 65 points lower on the Nifty. The Sensex is down close to about 300 points. The Nifty Bank is down 400 points now. So 3/4 of a percentage point lost in the Nifty Bank. HDFC Bank is the one which is dragging the markets the most. It's the top loser. HDFC Bank down 1.5%. But even ICICI Bank, there is a downgrade by Axis Securities on ICICI Bank. They're saying good growth story, but it's all in the price now. And ICICI Bank too, again, started trade higher, but now it's down nearly 1%. Axis Bank too, down close to about 1%.
Yeah, absolutely. So banks, like I said, are still a bit of the Achilles heel for the market. I mean, they fire up on that one day, but then ever since we had some of those business updates, particularly HDFC Bank's business update, I mean, it's just been sort of a slippery slope. Having said that, there are stocks in the broader market that are reacting quite well to news. One example would be Yes Bank, where there is a improvement in the outlook by one of the rating agencies on the bank securities. So the market's reading that quite well, 4.5% up on that stock. Shalby has acquired another big hospital, and again, the market's giving it a thumbs up. There's about a 3.5% pop on Shalby for what it's worth right now. Tata Elxsi, of course, Rima has been telling us, a little disappointing on the margins front. And again, there's about a 2% cut. So basically, it's a lot of reaction to the earnings that have started trickling in, as well as specific news points. But beyond that, looking at some of the movers and shakers, some of the PSUs are still finding traction. Case in point would be something like an REC, RVNL, which is up about 3.5% as we speak. Coal India is having a very good session today, by the way, 3% up on Coal India, ONGC. So the larger PSUs are actually having a pretty decent day, and that's how it's shaping up for the time.
SCI is the PSU which we should highlight. SCI is up 19%. I think there was an article which came out about, I think yesterday, where SCI and NMDC Steel are in advanced stages of a strategic sale. They're awaiting the nod from the PMO. It's a report. We've not confirmed the story, but that's gotten the stock excited. NMDC Steel is the one we're talking about, and SCI is up nearly 19%.
In fact, even SCI Land and Assets have been 14-15% up over there. So some of these potential strategic moves really powering up PSU stocks. Okay, so let's get going. There's lots lined up on the show today. We're going to get you a full-blown discussion on taxation and what is it that the street is bracing for. Capital gains tax is on everyone's mind. But before we get to that discussion and some of the other stuff that we've lined up, today is a big blockbuster IT day. The season is kicking off with TCS. So Rima, take it away. How's it going to be? Or how could it possibly be?
Better than last quarter. Let's put it like that, right? Dollar revenue growth is seen up 1.5% for TCS on a quarter-on-quarter basis. Remember, Q1 is a seasonally strong quarter. IT companies have been winning large deals. They're executing on that. So all that will flow through. And particularly for TCS, there was this big BSNL deal. So top-line growth is going to be better than what we've seen over the last couple of quarters. Margins for TCS could come under pressure, down 150 basis points because of a wage hike. Now, many IT companies have postponed their wage hike. They've delayed it. But TCS is giving all its employees an increment 1st of April, and that will weigh on the company's margins, down 150 basis points, putting pressure on the company's profits, and that's down nearly 4%. The TCV could be lower on a quarter-on-quarter basis. If you remember, TCV stands for total contract wins, which is your new plus renewals. Last quarter, it was a blockbuster $13.2 billion, but that was boosted by one big insurance Aviva deal. So, analysts are saying that this quarter will also be healthy, maybe $8, $9, $10 billion in line with their quarterly run rate, but lower on a quarter-on-quarter basis. But, the street's not going to focus so much on numbers. It's going to focus on the pace of recovery for the industry. Does it happen in H2? Are we seeing some signs of life? Because expectations are that growth is going to pick up in FY25 a little bit, but more so in FY26. So I've compiled, the expectations for TCS in terms of constant currency revenue growth for this year and next year. And as you can see, largely the street is at 5.5% for this year. which compares with 3.4% last year. So a pickup in growth rate. But the big growth is going to come in FY26, where the street is baking in a recovery in demand. So is that going to play out, or will there be any changes to this? Secondly, even on margins, the street is penciling in that margins will improve over the next 2 years, FY25 and FY26. The reason being that the companies had overhired, attrition was very high, but now hiring has come down. Most companies have, like a company like TCS hasn't increased its bench strength in close to about 3 quarters. So that employee cost will come down, boosting companies' margins. And then again, other things like, competition from captive Gen AI centers, generative AI is going to be a hot topic of discussion, hiring, etc. All those softer aspects.
And it is TCS that 2 quarters back kind of hinted that there's some recovery or green shoots, at least in BFSI, right? They were the first of the block to at least say that there's some hint of recovery.
It didn't really play out last quarter, and I think maybe we also, it took it more than latched on to it as a sign. But they did say last time that FY25 is going to be better than FY24. And that was a given because of the number of large deals they won. You just execute that and you're going to get a bump up in revenues. But, I think the amplitude of recovery is something the street's going to watch.
No, absolutely. And I think TCS is going to set the tone as it's going to be all eyes on earnings season from now on. And that's what our market conversation is all about today. By the way, before we get to that, just a reminder, we'll be speaking to the TCS MD and CEO K. Krithivasan, CFO Samir Seksaria, and Chief Human Resources Officer Milind Lakkad tomorrow at 9:45 a.m. So make sure that's an interview you definitely want to catch. All the action right here on CNBC-TV18. And like I said, since we're talking earnings, let's kick off the market conversation as well. Nuvama Professional is expecting a moderate growth in sales as well as in profits after tax for Nifty companies in the first quarter. They're saying that the key earnings drivers would be perhaps telecom, driven by margin improvement, and a key drag in terms of sectors could be OMCs as well as banks. So let's take this ahead with Sandeep Rana of Nuvama. Sandeep, great to have you on. Thanks for joining in. Let's actually start with IT because, Rima was just pointing out what we can expect from TCS. Now, give us the overall number, what you're expecting from Nifty earnings, and within that, where is IT going to be? Is it going to play the role of a laggard that will pull down the overall average, or maybe it could be a bit of a helping hand this time?
Hi, good morning. So if we just talk about the Nifty earning, yes, we know this time the numbers will be kind of little muted. See, we have to understand the base has been very strong. In the last 2 years, in fact, we have seen very good growth. In fact, if I just see last year, it was around more than 20%. So we can't expect every time that we have, bumper growth. Talking about this time, I think that the growth will be muted. We are targeting maybe 7 to 8% overall growth. And yes, as you rightly said, OMCs will be a drag this time. Now, talking about telecom, I think talking about IT would be moderate. And we have seen that IT has not done too well in the last 1.5 years. What has done well is actually non-IT. Renewables, power, capital goods, they have done very well, defense. But I think IT will be a kind of moderate this time. It will not be a laggard for sure. It will be moderate. And I think mid-cap IT will be a little more interesting than the large-cap ITs that we generally talk about. And talking about TCS, I think TCS, again, we know the numbers, how the numbers will be. They will be kind of, they will be reasonable. I won't be saying it's bad at all.
Okay. What about private sector banks? There is so much opportunity and enthusiasm built into it, but they fail to deliver compared to street expectations. Investors, some of the large investors have sort of shunned the private sector banks, bringing down their holdings. And now some downgrades are coming through. I remember there was a Bank of America downgrade on HDFC Bank. Today, Axis Cap has downgraded ICICI Bank. They're saying it's a consistent performer, but it's getting fairly valued. And therefore, ICICI Bank is now an ad. And they also go on to say that the ROA this year will be lower than what we've seen in last year, or at least Q4 of last year. On private sector bank, do you think some optimism is now getting shaved?
I think banks, again, have not done too well. In fact, in BFSI space, non-banking has done very well. So that part has done exceedingly well, be it on the home finance side or the other side. But banking per se has not done, although the numbers have been very good. So if you see in fact, I was looking at 5-year CAGR of the numbers. They have far exceeded the market cap. They have, the numbers that we see in the market cap. So, of course, based on numbers, also private bank has not done too well. Now we know the big daddy SDFCs and all, they have not performed so well, but ICICI is reasonable. I think numbers also for ICICI are a little far better than most of the other large caps. Excess is also reasonable based on the numbers. But having said that, I think banks should do better than before. What we saw also in last, I think 2 months, bank has actually done very well. I think that should continue going forward also. But more so, non-banking should be far better than the banking. That is what we are taking.
But just to expand on that point, on on banks, would you say, Sandeep, that some of these lackluster expectations, are they already in the price? Because that's the reason why we're not saying a sustained massive bank rally, right? It's 1 step forward, 2 steps back. So is it largely in the price, or could it actually derail things from a stock and price perspective point of view? And what could be the biggest issues that come up with banks this season?
See, one thing that we know that during many companies come out with their operational numbers. So broadly, how the numbers would be. Surprises are less when the actual result comes in. So, you price in most of the things before the results. Like, how the revenue is moving up, except NP and all that, which is not there on those operational numbers. But most of the broader numbers are there. So, how the banks will react when the numbers are, unless there are some drastic change in the NPA and GNPA or in the other things. So, broadly, and that's why you don't see the reactions when the results are there. Having said that, I think private bank will do well, reasonably well. So we are not worried on that.
All right, got it. So let's talk about another big pillar for the market that's not really fired till now, and that's consumer, FMCG, right? Last quarter, I remember, a lot of the numbers had started looking better, at least from extremely low single digit or flat. We started moving towards, mid single digits. And the companies were sounding more positive as well in terms of rural recovery. So what is your expectation from the FMCG universe?
See, I'll tell you, I'll just give you a broad idea of what has happened. See, in market, you have limited money. Okay, I'm just a little digressing the subject. So you have limited money. Now you have to think, where will you put this money? And we know for the fact in last 1.5 years, the sectors which were doing well, which I said before also were capital goods, power, more so renewables. And, so stuff like where defense, infra. So people have to put their money and move out of from the sectors which are not that good. So it's not that FMCG was not doing well. It was doing reasonable, but they're far better sectors that you wanted to put money on. Now the question is, those sectors have become very expensive because we have seen in last 2 years, most of these companies have been 4-5x, multi-baggers. Now, thing is, I think the fund managers or people who are investors are kind of pruning that kind of money in capital goods or defense and getting into sectors like FMCG, which has not done very well, and the numbers are decent. See, numbers were never bad, but yeah, numbers were decent, but the stocks have not done well. So I think some kind of money flow will shift towards these kind of sectors, and I think in this market, sector rotation will happen. Maybe sectors like FMCG, some bit of good pharma companies which are reasonable at reasonable price. So that kind of things will happen, I think, next 1 or 2 months.
Do you want to talk about pharma? You said that some pharma stocks may deliver. Which ones in particular are looking good? Because expectations are quite high from pharma this time.
Right. So as Nuvama, like companies like Lupin and all that, we are pitching. And in that, again, I will again digress and move to mid-cap companies because that is where we specialize in. So in pharma, there are a lot of mid-cap companies that are looking good, like 3D Bio and, Gina, Seco. There are a lot of pharma companies which are looking interesting to us in this space on the mid-cap side. So I think, again, on investing, I think we should look for companies which are growing at 20-25%, and there are many companies. Now, when we look at market, we say, Nifty is looking expensive. You're at 22-23 times FY25 and maybe 19-20 times FY26. So that way it looks expensive. But in those also, there are pockets of sectors and stocks which are looking good, which will grow at 25%, and they're reasonably available at maybe 1 pack. So nothing is cheap, like you're not getting anything a half pack or something, but yeah, 1 pack in this market is a little cheaper. So you will go for those kind of companies. Like in this also themes, if you want to play, like water is a very, very interesting theme still, looks like, and they are at reasonable price. So I'm saying we still in this market have to look for those kind of companies which are, looking interesting, growing at 20-25%, and, we are able to add maybe 1 pack or maybe the same kind of piece.
Thank you, Sandeep, for joining in. Need to get into a break. On the other side, we'll talk commodities with the birthday girl, Manisha Gupta.
grow on the go with CNBC TV18. Now streaming live 24/7 on YouTube.
The Indian markets have not just grown, they've broken several records in the last 25 years.
India's contribution to incremental global GDP was as low as 0.2% 25 years ago.
Over the last 25 years, CNBC-TV18 has closely followed the remarkable ascent of India's pharmaceutical sector.
There was a time 25 years back that it was all about the FIIs. If FIIs would buy, markets would rally. If FIIs would sell, market would fall.
Earlier, we were net importers of steel.
From IT services to SaaS, from consumer electronics to space tech, from mere programming to AI ML.
Cars, two-wheelers, three-wheelers, commercial vehicles have significantly become much more expensive than they were 2 decades ago.
Discounting is high there, but their focus is squarely on the 125cc segment.
Now it is contributing 16% of incremental global GDP.
Now we are looking at exporting the steel that's made here in India.
Welcome to the first ever India Business Leader Awards.
Cars, two-wheelers and vehicles generally being manufactured today are much lower on emissions and much higher on safety.
India's technology industry.
Welcome back. You're with us on Trading Hour, and it's time to talk commodities with the birthday girl. Manisha Gupta is in the house. So, Manisha, it has to be all gold and silver and diamonds today, or maybe even cocoa, chocolate, right? That's what birthdays are made of. Oh, well, yes, they are. But the price. Many happy returns of the day. First of all, to you.
Thank you so much, Survi. Well, I'm talking about the crude oil prices though, because we've seen some support come in for this one as well. Well, commodities for the year have been performing quite well. The first half was good. That is exactly what we saw for various precious metals, base metals and the crude oil prices also, which by the way are up 5.5% in the matter of last 1 month itself. There is support because you're looking at geopolitical tensions. There are climate issues as well. The first hurricane of the season in the Atlantic also has been seen, and this year is being called extraordinary and very dangerous when it comes to hurricane. There are at least 14 named hurricanes that the season would be looking at. A bit of a decline in the US dollar index also has been supportive for the crude oil prices, and there are expectations that we perhaps are looking at a deficit in this quarter. There is a report from EIA suggesting that there is a deficit in the 2025 for sure. Also, when you look at the kind of production and consumption numbers that we are looking at for 2025, as you can see, there is a deficit, and that is what the markets are pricing in at this point in time. The OPEC report also has suggested demand growth in this year and in 2025 as well. That has been supportive for the markets there. The US inflation data is what the street will watch out for today. This would give you direction in sense of US Fed rate cuts expectation for the month of September and December as well. But ahead of that, we've seen support continue into the markets. The first half did see a gain of around 12.5%, and the street does anticipate that the second half of 2024 could perhaps outperform that.
Thank you very much for that news coming in for Indegene about a strategic collaboration with Microsoft. The stock is up close to about 2%, one of the recent listings. Get into a short break, but before that, a quick programming note. Now, will the RBI cut rates this year? Is the RBI worried about a bubble in the stock market? And is India poised for a GDP upgrade? Well, this is the CNBC TV18 mega exclusive, the definitive RBI Governor interview, only on India's most watched business channel, so stay tuned for that. The forefront of cutting-edge innovation over the last 25 years.
It's the retail which is the driving force for the market right now.
Clearly, we have arrived on the global economic stage.
celebrate our own 25th year with new milestones being achieved on the large street.
21 years of the Nifty from 1,000 to 10,000 today.
Sensex and Nifty hit a record high.
The Nifty rallying to a record high.
We invite you to join us as we persist in leading coverage of the pharmaceutical and healthcare domain, documenting India's expanding expertise in medicines.
25 years of excellence and unparalleled growth.
CNBC-TV18, embarking on a quarter-century of excellence.
Dr. Sunil, one of the statistics say that only 50% of Indians brush twice a day. Do you think that's simply because of a lack of awareness? Or do you think it's also a cultural issue where, one of the statistics or reports that I was reading indicated that we just don't feel the need to brush more than once a day?
It's not a question of need. It is absolutely required. It's a mandate that you should brush twice a day. In the morning to remove everything that has been lying in your mouth while you're sleeping at night, and the acidogenic bacteria that work on it and create harmful acids, etc., and to generate freshness. And in the evening, of course, to remove all food debris and material that may be going to remain in your mouth through the night. You clean it up, you rinse it, and then you go to sleep.
Okay, but what happens if you don't? If you can just explain to us what are the risks of not doing so?
So what happens is there's a buildup of what is known as a biofilm on the teeth, and the biofilm contains bacteria, especially bacteria like strep mutans, which is what causes cavities. So, and of course, gum disease has different bacteria, but there is a whole bacterial biofilm that happens in the teeth. So if you don't remove that biofilm, then the bacteria will remain there and they will act on the gums and of course on the teeth. And so the gum disease and the dental caries both will be a factor if you don't remove the biofilm. So it's extremely important, especially at night, because when you've just eaten.
Welcome back. Ambuja Cements is higher in trade after brokerage firm Nomura upgraded the stock to a buy and raised the target price. Nigel joins in with the details. Nigel.
Well, that's right. Nomura has gone ahead and they have upgraded the stock to buy from reduce earlier. The target price moves up to around 780 rupees in comparison to 500 rupees earlier. The key factor that they have considered out here is they've raised the multiple. Earlier, they were giving it 14 times multiple. Now they're giving it at around 19 times multiple. Keep in mind for Ultratech, they assigned a multiple of close to around 17 times on. The four big reasons that they've given. One is in terms of capacity addition. They are saying including Pennar, the total capacity addition for Ambuja Cements will be at around 14% CAGR in the next 2 years. That compares with around 9% for Ultratech Cement and around 6% for the industry on the whole. Now, they've also saying that they are budgeting that by FY26, Ambuja's capacity will go to around 106 million tons, and they've included Pennar in this calculation. The second point is they are foreseeing Ambuja Cements moving into new markets, which is good for them. So they're saying the Pennar's acquisition makes Ambuja Cement the third largest player in South India after Ramco as well as Ultratech Cement. They also go on to state that the two acquisitions that they've done, that is Sanghi as well as Pennar, comes with a lot of limestone. So they have that, that optionality where they can go ahead and add capacity because of this limestone reserves in new geographies as well. Point number 3, they are estimating volume growth for the coming years. That's for the next few years at around 13%. For FY24 to around FY26, they are talking about 13% growth for Ambuja Cements, excluding Pennar, mind you. And that compares with, for Ultratech, they are penciling around 11%, for the industry around 5%. So it will outgrow the industry in volumes. And the final point, which is point number 4, is the cost optimization measures. The management has been talking about domestic coal. They have been talking about alternate fuel, usage, as well as some group synergies. So put all this together, what they are penciling in is that they expect Ambuja to reduce their operating costs by close to 300 rupees per ton. So based on all these factors, Nomura is quite optimistic on the prospects of Ambuja Cements. Back to you.
Thank you very much for that. Let's move on to Yes Bank, because that's surging in trade after Moody's upgraded their outlook on the stock. Abhishek is here to give us the details. Abhishek.
Well, Rima, as you mentioned, Moody's have upgraded the outlook on Yes Bank. Rating has been reaffirmed at BA3 on various instruments in the balance sheet of Yes Bank. So outlook has been raised to positive from stable. Now the change in outlook actually reflects the expectation that has been met with respect to gradual improvement on fundamental basis on Yes Bank that Moody's has seen. So improvement in deposits and lending facilities that can improve the profitability going ahead over the next 12 to 18 months is what Moody's is expecting. They expect cost of funds, to remain higher for Yes Bank versus peers over the next 12 to 18 months as well. And they may upgrade ratings of the bank if they sustain their core profitability along with stable asset quality going ahead. Now, rating upgrade is possible if PPOP, that is operating profit to total asset, is sustained at 1.2% or above. So downgrade of Yes Bank's rating is unlikely over the next 12 to 18 months. That this is the first time that I am seeing that a rating agency is saying that downgrade is not possible for next 12 to 18 months, which is a good sign. Rating could be downgraded if at all CET1 ratio falls below the 10% level, and PPOP, that is operating profit to total asset, if that is sustained at 0.8% or below. Back to you.
Thank you very much for that. Here is a quick programming note. We have a big budget exclusive for you today at 3:30 p.m. The CNBC-TV18 CII Budget Town Hall and the entire top brass of the industry body will be in attendance. We will quiz them on their budget expectations. Sanjeev Puri, Sanjeev Bajaj, Sunil Kant Munjal, R. Mukundan, Chandrajit Banerjee, B. Tyagarajan, Shenu Agarwal, Vinod Agarwal, and many more will be speaking. We have been, speaking exclusively at the town hall for 25 years. CNBC TV18 has been covering the budget, union budget. So keep it with your union, with your budget destination for all the big newsmakers and the exclusive news breaks.
Sleep and it has time to act.
Is it more of a rural problem? Is it also as prevalent in the urban population?
So I would assume, looking at the stats, that the rural problem would be slightly more because also availability of toothbrushes, toothpastes, and other oral health aids is much less than in the urban areas. But awareness, and as Sunil said, awareness and knowledge has to be imparted so that people will be more, able to do what they have to do.
I think it is not euphoria. It is like a stampede in the market. Even here in Ahmedabad, whoever I am meeting who is not at all related to stock market and from different walk of life, different field, business-wise, career-wise, and everybody's talking about stock market only, that they want to trade, they want to make quick money, and they want to, break their FD, and they want to, somebody was telling me yesterday only that he's working in some IT firm and all, and he want to quit and again, join stock market and all. So I think that this situation is not, personally, I may be wrong because I have been proven wrong many times in the past. But I think this will not end well. So SEBI should take very strict action to curb this kind of frenzy in the market or stampede in the market. Now the pricing power is coming with all these telecom service providers like Jio has already increased the rates, and Bharti also has followed the suit. And same is with Vodafone. Numbers 15 players has shrunk down to only 3 players, and BSNL is 25% players, so 3.5 or whatever you call it. So, and one thing is for sure. Now, earlier we used to talk about in India roti, kapda or makan. So now this is roti, kapda, makan or mobile. As I always say that when my driver keeps 2 mobile, I keep only 1 mobile, but my driver keeps 2 mobile. So how can you go wrong in all these things in this telecom? I think now since they have started increasing the rate, and so I think best time is ahead of them.
Welcome back. The CPSE, the PSUs are on fire today. The Nifty CPSE index is up close to about 1%. And I believe the PSE index has finally recovered all the losses that it made on 4th of June. Today, the top gainer on the Nifty is ONGC, or one of the big movers that we've seen. So it's a 2% gain on that. Coal India is up 2.8%. BPCL has a gain of nearly 1.3%. So that's where all the action is. Apurva Sheth, as promised, from Samco Securities is now with us for a quick technical check on the markets. Apurva, morning. Thank you for joining in. How do you read the market? It appears to be very range-bound. And today we had positive global cues, but yet we didn't have the strength and the momentum to climb higher.
Thank you for inviting me on the show. So markets have had a tremendous dream run from the election day lows that we have seen. So from those lows, we are up more than 3,000 points, and Nifty has managed to close above its previous day's lows for 24 days in a row, and this is the longest streak that it has managed. Apart from this, if you look at the last 20 days percentage change on Nifty, it is more than 10%. And if you also plot a Bollinger Band, so then it is already trading close to its 2 standard deviation mark. So looking at all these things, I think that the markets are likely to remain range bound, or so Nifty is currently in no trade zone kind of a thing. And the resistance level for Nifty would be around 24,500. That is like going to be a very crucial resistance level for the Nifty going forward.
Okay. What about stocks, Apurva?
So from the stocks perspective, I believe that mid caps are still having strong momentum. So CDSL is one stock that we have already recommended to our clients, and we believe that there's a lot of potential in the stock going forward from here. So the stop loss for CDSL would be 2268, and the target for CDSL in the short term would be 2540. And another stock would be Midhani. The stop loss for Midhani would be 495, and a target would be 600. Both of these stocks are moving out of consolidations and likely to head higher in the short to medium term.
Okay, thank you very much for that. On the other side is the big discussion on what should we expect on the taxation front. Will the government, will the budget tweak on the capital gains taxation? Will there be some relief on the personal tax front? All those discussions posed with Dinesh Kanabar, Kalpesh Maru and Pranav Saita on the other side.
We were getting APM gas, which is at $6.50. From 82%, it has come down to 68%. So there is substantial reduction in the APM gas, which is the domestically available cheap gas. And the LNG prices were earlier down, but now it has started increasing again. So we are constrained to increase 1.5 rupees in the CNG prices. However, still we are the cheapest in the country in terms of CNG prices and PNG prices. Budget is passed and what is included in the budget or not. The other point which we are hearing is maybe the gas can be included in GST, because if that so happens, then excise duty cut will not be required. It will be one tax regime for the gas segment itself.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest running show on startups and entrepreneurship, celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21. Only on CNBC-TV18 and CNBCTV18.com. CNBC-TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. To get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhat.
India Business Hour.
Welcome back. Let's talk about the taxation. Budget is 7 trading days ahead, and there is a lot of chatter and fear about what if there is some tweaks on the capital gains taxation front. Maybe increase the holding period from the current 1 year, or is there a possibility that the tax rate of 10% goes up? And I think there is fear, right, that if it comes through, there will be panic on the markets. Yeah. You've spoken to a lot of experts. Tell us.
When you said budget is 7 days away, it really made up sit up and take notice. I thought 23rd is still a while away.
Next week there is a holiday.
I don't know that. That's the good news.
That's
okay, we're digressing.
Right? Listen, take that.
But coming back to the point, Rima, I think what you said is right. I think tax is really taking center stage in this budget because the last time was an interim one. It was just a vote on count. And there are sort of long-standing issues. One of them is, of course, one discussion point is going to be whether the government will put more money in the hands of people now that it has a fiscal headroom, and everyone's looking at the personal income tax regime, whether there will be any sweeteners there. But the second bigger perhaps issue from a market perspective is capital gains tax. Will we finally see some rationalization? And by rationalization, I don't necessarily mean a cut. More a simplification and a standardization of the capital gains regime. And that is what I think has the ask has been from the industry perspective, from the individual perspective, from tax experts' perspective, given the regime, which has, of course, multiple rates, multiple asset classes, different holding periods, 1 year, 2 year, 3 years, STT paid, not paid, and whether you get the indexation benefit or not. So can this budget give us the first step towards at least a simplification of what has traditionally been a slightly complicated regime? Well, we have a full house of tax experts joining in to decode this. So let me, of course, welcome our experts in. We have Mr. Dinesh Kanabar, CEO of Dhruva Advisors. We have Kalpesh Maru joining in from KPMG India and Pranav Saita from EY India. Gentlemen, good morning. Great to have you on. It's the usual discussion that we have in the run-up to a budget year after year. But I think the hopes are running a little higher this time around, given that the elections are behind us. Mr. Kanabar, let me throw the floor open to you. Let's deal with capital gains and then we'll deal with the rest of the tax expectations. But on capital gains, what should we, brace ourselves for?
Thank you for having me. And let me begin to say that you mentioned about rationalization, and indeed the entire capital gains tax regime tends to be very, very cumbersome. We have short-term, long-term, listed, unlisted security, residential houses, holding period, resident, non-resident, and we all know that. Sometimes I wonder as to whether when you are asking for rationalization, are you be careful about what you wish for? So, for example, many years ago, we were all talking about dividend distribution tax being paid by the company and being substituted by a dividend tax. And when that happened, people started to complain to say that high net worth individuals are now paying far more than what they were paying. So when you start about talking rationalization, the questions which you put up, which are the usual questions, will we see a 1 year go up? Will we see the rates go up? And I'm no expert. I don't understand markets. I understand taxes. Is there a need for rationalization? Yes. Is there a more important need for a stability? I would say yes. I think both as a part of FICCI and the conversations that I have had with the government, I mean to say that the need to communicate to the world is that India has a stable tax regime, and that is not going to be tinkered year on year on year. On your earlier point as to whether the threshold limits for exemption should go up, probably yes, because there is an inflation and maybe there needs to be an automatic application of an index to take care of the inflation. But insofar as a capital gains tax is concerned, if you go back and talk about rationalization and making it simple, maybe there is a need, but I would say that there is even a greater need to communicate stability, which I think is very important. What has happened is that we have seen huge number of IPOs in the last 1 year. And I think that's very welcome. for the industry. It shows foreign investments coming in. It shows domestic investments coming in. And the last thing which the government should do or would want to do is to really rock that boat, which is settled down and is going very, very well. So from my part, rationalization very welcome. Is this the year? Maybe not.
Mr. Kanabar, I think you're being, careful, and perhaps for good reason. You're not putting numbers out there and specifics, but we're going to come down and, drill you further on that. Let me bring in the others as well. Mr. Saita, if I could come to you. Capital gains rationalization, we all talk about it. We all say we want it. The question is, what could be the right model? The specifics. So let's talk listed. Now, listed equity, the rate is 10% for long term, but the definitions are different. It's only 1 year. If it's unlisted, then it's 2 years. If it's property, then the definition is 2 years, and the rates also vary. So, if at all, you were to recommend to the government a formula to start simplifying and rationalizing this, where would one begin? What are the rates that you would move around?
Okay, thanks so much. So a very quick summary. There are so many different provisions right now that if even a person like me were to be asked a question on capital gains, I would have to go back, refer to the book before being sure what kind of rates, period of holding, and so on would apply. So it does call for some rationalization for sure. At the same time, without compromising, very correctly, as has been pointed out, the stability, predictability, which has been the hallmark of this government, not trying to do minimal tinkering of the laws all the time. That's been the hallmark, and that should continue. But I would feel 2-3 things can be done very simply. One could bracket assets maybe into 3 categories. One is risk-bearing financial assets. The other is other financial assets. And a third is all the other assets whatsoever. Just have these 3 baskets. When I say risk-bearing financial assets, I would normally put within it shares, equity-oriented mutual funds, and maybe REITs, InvIT units. So those are the 3 types of risk-bearing financial assets. All other financial assets I would put separately. And the third bucket would be other than financial assets, which would mostly be in the nature of gold, silver, jewelry, immobile properties, and so on and so forth, the entire rest of the bucket. I would feel the tax rates can be rationalized as, for the long term, 10% on the risk-bearing financial assets, 20% inclusive of the benefit of indexation for the other financial assets, and as well as 20% for the other third bucket. So the second and third bucket might be similar rates of taxation with indexation benefits. And so far as the period of holding is concerned, it could be rationalized as 12 months, or meaning 1 year, for the financial assets in total, whether it is risk-bearing or otherwise. And for all other assets, it could be, for example, 36 months. That, I think, would keep it very simple. The short-term capital gains tax rates could be 15% for the risk-bearing financial assets, and maybe the normal slab rates or whatever the regular rates of income tax might be for all the other categories of assets. That, I think, would be very simple, but at the same time address the need of stability, predictability, and fairness and transparency for all.
Pranav, so just for the sake of clarity, and I think you really simplified it. You're saying just bucket it into 3 separate categories of asset classes: risk-bearing financial assets, other financial assets which are non-risk-bearing, all other types of financial assets, and other assets which are non-financial assets, which is where your gold and perhaps a movable property can come in. You're saying 10% for risk-bearing and 20% each for the others. And in terms of the duration, how much did you say should risk-bearing be? Or should it be continued? Should it continue to be the present regime of 12?
All financial assets 12 months. Okay. Other than financial assets, gold, silver, jewelry, immobile property, 36 months.
36 months. So all financial assets defined short-term as less than 1 year, long-term as above 1 year, and 36 months for the other category. Got it. Thanks very much. So that's the EY take on maybe what could be a new model, which is simpler to deal with. Let's get the KPMG point of view as well. Mr. Maru, you just heard Pranav's recipe or Pranav's model. Would you concur, or if you would like to sort of add or delete or tinker around, what would your model be? Capital gains.
More or less, I would sort of concur with maybe one tweak. really we need less complexity than more. So I would just keep it as two buckets, financial assets, risk-bearing assets, everything which is securities at 12 months, 10% rate, and every other asset at 20% with indexation benefit and 3 years. Most importantly, I would emphasize what Dinesh talked about. Stability is the key. In the search for simplicity, I would urge and request the government to not find a mid path and increase the rate, let's say from 10 to 15, right? Which it goes against the very grain of stability that we've been working. So simplicity is needed, but do it in a manner that doesn't upset the current system. So 10 going up, and there have been some murmurs about it. I would strongly hope that doesn't happen.
Yeah, so the 10% should not go. I think that's the biggest demand from the equity market. Every participant we speak with, first up on their budget wish list is do not change capital gains taxation, the rate or the period, at least from a listed equity point of view. Gentlemen, we need to take a very, very quick break. We have more to discuss beyond capital gains as well. Rima has a lot more questions, especially on personal income tax. Coming back with just that.
I think it is not euphoria. It is like a stampede in the market. Even here in Ahmedabad, whoever I am meeting who is not at all related to stock market and from different walk of life, different field, business-wise, career-wise, and everybody's talking about stock market only, that they want to trade, they want to make quick money, and they want to break their FD, and they want to. Somebody was telling me yesterday only that he's working in some IT firm and all, and he want to quit and again join stock market and all. So I think that this situation is not. Personally, I may be wrong because I have been proven wrong many times in the past. But I think this will not end well. So SEBI should take very strict action to curb this kind of frenzy in the market or stampede in the market. Now the pricing power is coming with all these telecom service providers like Jio has already increased the rates, and Bharti also has followed the suit. And same is with Vodafone. Numbers 15 players has shrunk down to only 3 players, and BSNL is 25% players, so 3.5 or whatever you call it. So, and one thing is the for sure. Now, earlier we used to talk about in India roti kapda or makan. So now this is roti kapda makan or mobile. As I always say that when my driver keeps 2 mobile, I keep only 1 mobile. But my driver keeps 2 mobile. So how can you go wrong in all these things in this telecom? I think now since they have started increasing the rate, and so I think best time is ahead of them.
We were getting APM gas, which is at $6.50. From 82%, it has come down to 68%. So there is substantial reduction in the APM gas, which is the domestically available cheap gas. And the LNG prices were earlier down, but now it has started increasing again. So we are constrained to increase 1.5 rupees in the CNG prices. However, still we are the cheapest in the country in terms of CNG prices and PNG prices. The budget is passed and what is included in the budget or not. The other point which we are hearing is maybe the gas can be included in GST, because if that so happens, then excise duty.
Welcome back. This is the big budget discussion on the taxation front. And will the budget provide any tax relief for the common man? We've been in discussion with all our 3 experts. Mr. Kanabar, coming to you. The government has been trying to move away people to the new tax regime. They threw in a standard deduction of 50,000, but yet we haven't seen that shift away from the old regime to the new regime. Do you think in this budget this time we could see more by way of deductions or any sort of an exemptions for the new tax regime to make it more lucrative to enable that shift? And anything that people who are on the old tax regime, should they be expecting anything?
So if you go back historically to the new tax regime for corporates, It took maybe about 3-4 years. But today, if I may dare say, almost 80-90% of the corporates are on the new tax regime, and rightly so. Because the last thing you want is to talk about deductions, exemptions, litigation surrounding those deductions and exemptions. The new tax regime for individuals has just been a year old, and it takes some time for any regime to settle down. And I would actually very much encourage that people need to move more and more towards the new tax regime. There is, of course, this whole fashionable ask that we need more exemptions and more deductions. I would rather have a far lower rate of tax than the government using tax to promote any of the policies that they need to do otherwise. So as we saw, for example, again, giving a corporate perspective, that instead of having tax deductions and exemptions, you had a PLI, which you put money in people's hand. Similarly, for individuals, we need to move towards a simple, rational regime. I mentioned earlier on, and I might like to sort of re-emphasize that there's need to reset the threshold limit every year. We have inflation. In fact, for capital gains tax, for example, we have cost of the acquisition index. Same thing, really, we need to ensure that we keep on moving the index of exemption up all the time. And I think the government would do very well to promote, do everything and more to promote the new tax regime and to increase the threshold limit. Remember that when the government increases the threshold limit, and I've done some work, shared it with CNBC, a 1 lakh rupee reduction in the threshold limit or other increase in the threshold limit means that the government loses tax revenue by about 1,37,000 crores. We are looking at a point of time when the government's revenues are at a record, whether it is in terms of GST, whether it is in terms of direct tax. A 1,37,000 crore reduction in taxes actually does not mean that, because a lot of that money goes to people who are going to use it for consumption. And when they use it for consumption, you are giving a flip to the FMCG sector, you are increasing your GST collection. So I would be very much in favor of government doing everything and more, A, to increase the threshold limit, and B, to make it more attractive for people to move to the new tax regime where we don't talk of deductions and exemptions.
Okay, got it. So increase the basic income tax exemption threshold. That could be perhaps one big sort of recipe on the personal income tax. And move it all the way up also. Sorry, Mr. Kanabar, if you could say that again.
And move it all the way up also, not just the basic threshold, but really take the limits up all the way up.
And this is for the new regime, the concessional regime.
That's right. That's right.
Okay, and therefore it will get people to finally migrate from the old to the new. Let's see if that comes through or not. Very quickly, gentlemen, we're down to the last 2 minutes on this conversation. Pranav, what else? I know that I think rationalization in the TDS structures has been a long-standing ask. There was earlier this issue of angel tax. Not sure if that has been fully addressed or not. I mean, what would be the other, let's say, 1 or 2 most important issues that you would want the finance minister to consider from a direct tax standpoint?
Right. So I would feel one is there are various anomalies under the 56(2)(10) where shares are acquired by taxpayers and the price moves up between the date of acquisition, the date of the signing of the agreement and acquisition. That needs to be addressed, which is a gift tax provision which applies to acquisition of shares. And in many cases, we have seen that impact transactions and deals where acquisitions of shares are happening. I would feel the government needs to increase the limit for interest on housing loans, which has been at 2 lakhs. I think a minimum increase of from 2 lakhs to 3 lakh is something that might be called for. A good standard deduction increase is again something that has to be considered. Also, long-term capital gains are exempt currently up to 1 lakh. I think that limit also in line with inflation needs to be increased to probably 2 lakhs or so that we invite even more taxpayers into the financial investment space. So these are some of the things that, of course, boosting consumption as much as possible.
Take your point, but I'll tell you, with the current tax regime, you're getting 40,000 crores of retail inflows into the market on a month-on-month basis. So if you give more tax offs, then I don't know what's going to happen. The market's going to maybe explode. But anyway, we're not here to comment on that. Mr. Maru, if you could sort of wrap this up, you have the last word. From a capital market perspective, No change, yes, that is the big demand. But anything else? Anything else which you would want to see?
So I would say from a general deal-making perspective, two asks. One that Pranav specifically talked about on the gift tax. It started as an anti-abuse provision. It has almost becoming like a gift of taxes given the way the section is worded. We need like very, very general safe harbor rules to prevent genuine transactions from coming under this net. That's one. The second thing I would say is on the new tech space, I think our IPO markets are booming thanks to a lot of retail participation, institutional investments. And in particular, our markets are outperforming NASDAQ and many of the other markets. And it's seen a wave of new tech IPOs sort of coming in. What I think would be good for the market is if the government came up with very, very broad-based exemptions allowing companies that have overseas shareholding to migrate their shareholding into India in a tax-free manner. This is not a free lunch. All you're doing is exempting a reorg to bring these companies back to the public markets in India. You could, of course, tax them when the shareholders eventually exit in an IPO. So to my mind, this would be another large thing that you could consider from a capital markets point of view.
Okay, all right, gentlemen, thank you very much. I'm sure we'll have some more rounds of these conversations before we, actually get up to B day. But thanks for your perspective on capital gains and, of course, other important elements of direct taxation. Well, with that, Rima, I guess almost out of time on this conversation on taxes, of course, on the market.
And we're going to take your leave then. Thank you very much for watching the show.
But it will be one tax regime for the gas segment itself.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself as India's longest running show on startups and entrepreneurship. Celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21. Only on CNBC-TV18 and CNBCTV18.com. CNBC-TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros, and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhat.
India Business Hour live on YouTube at CNBC-TV18 weeknights at 7 p.m.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go. Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC TV18, now streaming live 24/7 on YouTube.
The Indian markets have not just grown, they've broken several records in the last 25 years.
India's contribution to incremental global GDP was as low as 0.2% 25 years ago.
Over the last 25 years, CNBC-TV18 has closely followed the remarkable ascent of India's pharmaceutical sector.
There was a time 25 years.
Frontline indices dip further, but some recovery is noted in mid-caps with advances outnumbering declines. Realty and financials are the big losers, even as energy and metals eke out gains.
While TCS is expected to report higher revenue growth and slimmer margins in Q1 following a wage hike, the focus will be on its commentary on demand, hiring and traction on Gen AI when it announces its earnings later today.
After selling 75% stake in Glenmark Life Sciences to Nirma, Glenmark Pharma and promoter Glenn Saldana have now floated an offer for sale for their residual near 8% stake. This move will see Glenmark exiting the life sciences business entirely.
RBI has now permitted all residents to open forex accounts in GIFT City for all purposes. Earlier, such accounts could only be opened to buy securities of overseas companies or for foreign education payments. Hello and welcome to Halftime Report. I'm Ekta Batra and with me is Mangalam Malu. Well, it's turning out to be a session which is a bit sluggish at this point in time. So we have the Bank Nifty, which is down around 0.6%. But what is doing better is the broader markets. The mid-cap index is managing to hold up with a gain of around 0.2% at this point. And the advanced decline ratio is positive as well. So at around 1.24 to 1, or around 2,100 stocks advancing to around 1,700 stocks declining on the Bombay Stock Exchange. Let's see whether that sustains. Besides the TCS numbers, we do have the US CPI data, which will be out today for the month of June. And that's expected to probably see a little bit of softness on a month-on-month basis. And that will set us up to what we can expect from the US Fed when they meet at the end of this month. Hi, Mangalam.
Hi, Ekta. Good afternoon. You know, yesterday we tested the lower end of the range. Today, in the morning itself, we tested the higher end of the range for the Nifty. So, between yesterday's low and today's high, we have 24,150 to 24,400 on the frontline index. We've fallen about 180 points from the highs, but at the same time, we've seen a bit of a recovery from the lows as well. Currently, the Nifty is sitting with a cut of about 100 points. The broader markets, like you pointed out, doing a lot better. What's also interesting is that, you know, a bunch of stocks which are actually doing very well in today's trading session. So we do have, you know, all these energy companies. So we have HPCL, which has moved higher. We have Oil India, which has moved higher. We have some of these power financiers as well. All the PSUs, the ones which actually led the rally on the way up. We have REC, PFC, BHEL, all of them doing extremely well. And apart from that, a couple of these, you know, other companies as well. Case in point, something like a Sun TV, which has crossed the 800 mark, currently sitting at the high point of trade. But let's get in some market opinion. We do have with us Nilesh Shetty, who's joining in, portfolio manager at Quantum Advisors. Good afternoon, Nilesh. Thank you for joining in. You know, all the opinion that we get so far talks about how India is the brightest spot in the world right now, but that is also the most expensive in the world right now. How do you navigate through this, and what is it that you're doing in the markets?
Yeah, I mean, we agree with that. And I mean, India has always been expensive. That is not a surprise. But it looks like it relative to the earnings cycle, the valuations are much above normal right now, especially in the mid cap and small cap space. No matter what earnings growth you want to peg there, I think valuations have moved far away from fundamentals there. I mean, we remain stock specific, and there are pockets of opportunity. I think for us, incrementally, we see more of our capital being deployed in private sector banks, including on the savings side. So we have deployed capital on the insurance side of savings, AMCs, and broking companies. So that is where we found opportunities. But apart from that, generally cash levels in the portfolio have been inching higher as we've been trimming a lot of our other positions in the portfolio.
Okay. Well, Nilesh, hi, welcome to the show. We do have TCS, which will be reporting numbers today. What is your sense in terms of what we can expect when it comes to revenue growth, margins, which is expected to be impacted on account of the wage hike, as well as commentary, especially on demand as well as artificial intelligence?
Yeah, I will not be able to comment on individual stocks, but IT is one of the few places where valuations are not extremely expensive. They're not relatively cheap, but within the context of where we are in the market, it is one of the few places that warrant allocation of capital. Wage hike generally is known. It is not something which every Q1 number is a wage hike quarter for all IT companies. So it's not a surprise as such for the market. But what most people are looking at is, see, most of these companies have picked up large orders, and the order book remains very healthy, which is not translated into revenue as clients keep deferring spends. And most people are waiting to see signs of that order book getting translated to revenue, which may see a pickup in valuations for these companies. AI, I mean, we are still trying to figure out how it impacts. I mean, there is a mixed opinion whether it's an opportunity or a threat. But historically, most of these disruptions in technology have been opportunities for Indian IT services companies to expand their share of wallet from the customer. It may not be that different this time as well, but we'll wait and see. As of now, we sort of sitting on the fence on the disruption that is coming.
Could you tell us what your allocation is right now, what your positioning is, underweight, overweight, equal weight, what sectors, and what are you incrementally doing in the market?
So the portfolio is built bottom up, and the sector allocation is an end reflection of that. But we have about 40% in BFSI, including large private sector banks, insurance companies, and a broking company and asset management companies. We have zero allocation to consumer staples. They are getting interesting for us given the underperformance that has happened over the last 3 years. We have zero allocation to capital goods and infrastructure space. That is where we see the maximum froth in valuation. I mean, they remind us of valuations that we saw in 2006-07 for these companies without the same kind of earnings traction, which tells us that the valuations are far above where they should be. And we've essentially trimmed our allocation in auto, where we had a large allocation a year ago, but we probably halved our allocation now as valuations have become expensive.
So where are you deploying this money that you're getting? Because you have zero exposure to staples, 40% to BFSI, a little on IT, like you said, and then you have a bunch of others. Auto, for instance, you halved your allocation out there. So what exactly are you looking at? Because even cap goods is something that you're finding very expensive.
Yeah, I mean, portfolio is sort of built with a 5-year view, so we have to be patient. Opportunities will come. Like I said, there are pockets where underperformance sort of has emerged over the last 3 years, including consumer staples, including consumer durables, which were growth favorites till, say, 3 years ago. They were the capital goods of the previous bull cycle. And given the valuations, earnings have disappointed. And so we expect that disappointment to continue. And at some point, opportunity might present itself for us to add some of these names to our portfolio.
So what's the cash that you're sitting on right now, and how does that compare to your historic cash levels?
So the cash today is about 15%. Our long-term average has been about 10%, but it has increased over the last 1 year. It has moved up.
Okay. All right. Well, your cash has moved up from 10% to 15%. You did mention autos. You've reduced your reduced your exposure there. You know, autos have been in focus on account of those SUV price cuts which have taken place. M&M has said that it's a part of their annual plan as well. But are you fearing maybe a contraction in demand, softness in demand when it comes to the auto space?
I mean, we try to model long-term growth in demand based on penetration levels, and there could be interim cycles where demand is higher or lower than that. But the worry was valuations. The valuations for us, based on the earnings growth that we were forecasting, were trading above where they should be. And there has been, most of them have doubled over the last 1 year. And earnings growth has been in the range of 25-30%, which has expanded price to earnings multiples quite materially in that bucket. So it's purely a valuation number, not necessarily we have a major view on earnings disappointment in that space.
Okay, so where exactly are valuations looking comfortable for you at this point?
Like I said, the 40% allocation remains in BFSI, which includes private sector banks, includes insurance companies, an asset management company that we picked up last year. And then incrementally, we are sort of observing the consumer durables and consumer staple space closely, which, like I said, is been underperforming for the last 3 years now, and still not cheap enough. We picked up one company there, which has done well for us, but it's a space where I expect more names to come through over the next 12 months.
Okay. Is your portfolio market cap agnostic? What are you looking at in terms of when you say bottom up? Are some mid cap opportunities attractive, or is it just the large caps that you're looking at?
It is market cap agnostic, but we have a liquidity filter given the size of the portfolio. We need at least $1 million a day daily trading volume. And because of that, there is a large cap tilt in the portfolio. But if a liquid mid cap company which meets a corporate governance norms, because we run a integrity screen on corporate governance for most of these companies, if they meet these two criteria and then meet our valuation criteria, we are happy to add them to the portfolio.
So what are you, so based on your criteria, and the filters that you have, what is your exposure within the broader markets? Which are the sectors that you probably lean towards? Or is it more stock specific, story specific?
It is completely stock specific. The end sector rates are just the outcome of individual stocks that we picked up at different points in time. But we don't have a view as such saying that this is the sector we need to increase weight at the moment. So if tomorrow a capital good company meets our filters and comes at a valuation that we are comfortable, despite the view on the overall sector that looks expensive, we are happy to add it to the portfolio.
So what would some of your recent additions be?
So like I said, the most sort of recent addition has been a private sector bank, which we picked up. I may not be able to disclose the names. And before that, there was a consumer durable company, which was sold off quite materially, which we added. That has done really well for us. It's actually virtually doubled from the price that we picked it up in the last 1 year. And then this bank remains a place of interest. And there are other sort of financials that we're tracking right now, where we think more names could come through.
Is this the large private sector bank that everyone keeps talking about, or is it something in the mid or not so small cap space sort of thing?
Top three, one of the top three private sector banks, not the largest. That we already had in the portfolio.
Got it.
Okay. All right. We're going to leave it on that note. Nilesh, thanks very much for joining in and speaking with us. And we'll touch base with you as and when, earnings season progresses. Thanks very much for joining in. We'll take a short break, but a quick programming note. Will the RBI cut rates this year? Is the Reserve Bank of India worried about a bubble in the stock market? Is India poised for a GDP upgrade? Coming up later in the day, a CNBC-TV18 mega exclusive, the definitive RBI Governor interview, only on India's most watched business news channel. Stay tuned.
All about the FIIs. If FIIs would buy, markets would rally. If FIIs would sell, market would fall.
Earlier, we were net importers of steel.
From IT services to SaaS, from consumer electronics to space tech, from mere programming to AI ML.
Cars, two-wheelers, three-wheelers, commercial vehicles have significantly become much more expensive than they were 2 decades ago.
Discounting is high there, but their focus is squarely on the 125cc segment.
Now it is contributing 16% of incremental global GDP.
Now we are looking at exporting the steel that's made here in India.
Welcome to the first ever India Business Leader Awards.
Cars, two-wheelers and vehicles generally being manufactured today are much lower on emissions and much higher on safety.
India's technology industry has been at the forefront of cutting-edge innovation over the last 25 years.
It's the retail which is the driving force for the market right now.
Clearly, we have arrived on the global economic stage.
Great way to celebrate our own 25th year with new milestones being achieved on the Lal Street.
21 years of the Nifty from 1,000 to 10,000 today. Sensex and Nifty hit a record high.
The Nifty rallying to a record high.
We invite you to join us as we persist in leading coverage of the pharmaceutical and healthcare domain, documenting India's expanding expertise in medicines.
25 years of excellence and unparalleled growth.
CNBC-TV18, embarking on a quarter century of excellence.
Dr. Saneen, you know, one of the statistics say that only 50% of Indians brush twice a day. Do you think that's simply because of a lack of awareness? Or do you think it's also a cultural issue where, you know, one of the statistics that or reports that I was reading indicated that we just don't feel the need to brush more than once a day?
It's not a question of need. It is absolutely required.
Welcome back. One of the stocks which is holding up in the green right now is Reliance. Despite a slightly wobbly market, the Nifty is down about 58, 59 points. So when we started the show, the Nifty was down about 100 points. Thereafter, we saw some bit of recovery from the Nifty Bank, which is down 0.7%, is now down about 0.6%. So as you can see, you know, a big decline, and then that was swiftly being bought into, and that mirrors the way the Nifty Bank performed as well. But Reliance is still holding up in the green, and that's because of a note that came in from Jefferies this morning, which says that Jio actually may be listed in this year itself. That's the word coming in from them. What are the scenarios? What are the valuations? Rima joins in with the details of the same. Rima.
Thanks so much for that. So the key thesis by Jefferies is that a Jio IPO is likely in calendar year 2025. Now, Reliance has two ways to go about an IPO. One, do an IPO with Jio remaining as a listed subsidiary, or two, spin it off and list it like they did in the case of Jio Financial Services. Now, in option number one, where Jio remains as a listed subsidiary. Now, Jio can exercise greater control on, Reliance can exercise greater control on Reliance Jio, but there is a holdco discount. And the fair value of Reliance Industries declines if the holdco discount assigned by the market goes up. So, for instance, with a 10% holdco discount, the target price, according to Jefferies, fair value should be 3,473. But if you increase the holdco discount to 30%, then the target price drops by nearly 200 rupees to 3,257. Now, option number two is they spin off the telecom business, Reliance Jio, and then list it, like they did in the case of Jio Financial Services. You do a price discovery, shareholders in Reliance will get proportionate shareholding in Jio. Now, the advantages of this are that there's better price discovery, it's better for minority shareholders. Jio Financial Services has created a lot of value, but for Reliance Industries, and plus there is no holdco discount, but for Reliance Industries, the control comes down because Reliance Industries will now have about a 33% holding in Jio. But in that case, if they decide to spin it off and then list it, then the fair value of Reliance Industries is at 3,580, higher than the previous option scenario, and that's because of the absence of a holdco discount. Back to you.
Okay, all right, Rima, thanks very much for that. So a possibility in terms of IPO for Jio next year. But let's move on now to the cement space. Ambuja Cements is in focus now. The brokerage firm Nomura has upgraded the stock to a buy and also raised the target price. Nigel is here with the details.
Well, that's right. Nomura is sounding quite optimistic on Ambuja Cement's prospects. So from a reduce, they have upgraded the stock to buy, and the target price from 500 rupees has gone to around 780 rupees. What are they factoring in? Firstly, they're giving it a higher multiple. Earlier, they've given it a multiple of around 14 times. Now they're willing to give it the target price a multiple of close to around 19 times. Remember, Ultratech Cement, for them, they're given a multiple of close to around 17 times. Let's break it up into four big reasons. One is they're impressed with their capacity addition. And they're saying over the next few years, that's FY24 to FY26, they're expecting capacity addition at a pace of around 14%. They've included the Penna acquisition as well. And they're saying that will outpace the industry. For the industry, they're expecting the industry to add capacity at around 6%. And for Ultratech Cement, in the same duration, they're expecting to add capacity of around 9% odd. At the end of FY26, they're expecting that Ambuja Cement's capacity goes to around 106 million tons. That's including the Penna acquisition. Next up, the entry into new markets. They're impressed with that. So post the Penna acquisition, they're saying that Ambuja Cements now, on a consolidated basis, becomes the third largest player in South India after Ramco as well as Ultratech Cement. And they're impressed on that front. They also say that the two acquisitions that they've done, Sanghi as well as Penna, both of them have an adequate amount of limestone. So it helps them in case they want to go ahead with brownfield expansion, which is a bit of a trigger as well. Point number three, on the volume growth side as well, they have not factored in any contribution coming in from Penna, but still they believe that Ambuja Cement's volumes, well, it'll grow at around 13%, excluding Penna, and that compares with around 11% for Ultratech Cement and around 5% for the industry. And point number four is a company-specific thing. They're saying the cost optimization measures will start playing out. Remember, the management has been talking about alternate fuel resources, about sourcing coal domestically, and also this synergy benefits for the group on the whole. Put everything together, Nomura is saying that they expect Ambuja's operating cost to reduce by close to around 300 rupees on a per ton basis. So 4 big reasons explains why they've gone ahead and upgraded the stock. Back to you.
All right, Nigel, thanks a lot for that. So that's about Ambuja Cements, the entire cement pack in focus today. This one on the back of the Nomura note. Yesterday, remember the same time we were having a conversation with Shalby's Shanay Shah and now Shanay actually, and now it is up about 5% because immediately after that conversation, I think they went ahead and signed that lease with Asha Parekh Hospital.
Yes, absolutely. Well, we should have probably spoken to them today as compared to yesterday. But yes, the news on Shalby is that they've signed a 30-year lease for the Asha Parekh Hospital in Santa Cruz, Mumbai. And this will be to construct a new healthcare facility of around 175 plus beds. Now, remember that just to reiterate a couple of things that they said to us, which was important, was that remember that they came out with their Q1 numbers. It was a little disappointing on the margin front. And the reason for that is because of the Sanar Hospital acquisition that they made in the north. It broke even on EBITDA, but it was loss-making on the bottom line. So it basically impacted their entire performance this quarter. They expect that Sanar acquisition to be EPS accretive next year. They're expecting around 120 to 150 crores from it. The implant business has grown 50 to 55% and they expect that kind of growth to continue. They expect a possible positive EBITDA this year from the implant business. The RPOPs, they're very positive on. Above 43,000 rupees is what they expect this year. And it's grown around 5 to 6%, which has been something that they could pass on. So interesting that they will be entering, a prime market such as Santa Cruz in Mumbai. But we'll wait by for more details in terms of, what they expect the occupancy level would be, whether it would be a multi-speciality hospital or maybe whether it would just be focused on orthopedics. So interesting times for them. The stock, as you can see, is up around 4.4%.
All right, so that's about Shalby Hospitals. But Ekta, even Zydus Life, that's at a 52-week high. There are multiple news pieces there?
Yes, there are in fact a couple of news pieces with regards to Zydus. So I'll just start with a couple of drug approvals that they've got. So they've received approvals for a particular drug which is Entresto generic, which is used for heart failure from the US FDA. The market size is around 5.5 billion. So it's supposed to be a big opportunity, but let's see which other companies also get approval for the same drug. They've received a tentative approval from the US FDA for Vumetry generic, which is basically used for multiple sclerosis in adults, and that's around $847.4 million. Remember, it's a tentative approval, not a final approval. The company is also in focus because they are barred from selling a cancer biosimilar in the Indian market for now. The Delhi High Court has issued an interim injunction which restrains Zydus from selling the breast cancer drug Sigrima, which is a biosimilar version of Roche's drug Pertuzumab. Now, Zydus had told the court that they had got a conditional approval on April 4th. Then they were given final approval on the 27th of June by the National Institute of Biologics. But, the Delhi High Court has put an interim injunction on it. Even Zydus and Dr. Reddy's had entered into an agreement to co-market this drug in India. So that also is pretty much in limbo at this point in time. So it'll be interesting to see what the developments would be. But as of now, there's an interim injunction on this particular cancer biosimilar for Zydus.
All right, Ekta, thanks a lot for that. So that's about Zydus. Just before we slip into a short break, keep an eye on a couple of these stocks which are buzzing around, and they belong to the shipping / logistics sort of sector. Gateway Distriparks, for instance, is up around 7% right now. A well amount of volume activity out there as well, not too far away from its 52-week high. And the other group company, Snowman Logistics, a stock in which the promoters of Gateway Distriparks themselves are increasing their stake, and they've on record here on CNBC-TV18 said that, will be looking to increase the stake by a further 5% this year as well, after a 5% increase last year. So that's, another pocket which is buzzing around. And Shipping Corp of India, it had seen a big move this morning itself, and now it's only extended its gain, currently locked in that 20% upper circuit with a fair amount of volume activity taking place out there as well. Shipping Corporation, SCI, is the one that should come up for you on your screen right now, currently at the high point of trade, in fact locked in that 20% upper circuit. Along with that, we have GE Shipping as well. So that's SCI and GE Shipping up around 8%. Take a short break, come back, get you more on the markets and a technical technical trading ideas coming in from Nagaraj Shetty, who joins in from HDFC Securities.
Should brush twice a day in the morning to remove everything that has been lying in your mouth while you're sleeping at night, and the acidogenic bacteria that work on it and create harmful acids, etc., and to generate freshness. And in the evening, of course, to remove all food debris and material that may be going to remain in your mouth through the night. You clean it up, you rinse it, and then you go to sleep.
Okay, but what happens if you don't? If you can just explain to us what are the risks of not doing so?
So what happens is there's a buildup of what is known as a biofilm on the teeth, and the biofilm contains bacteria, especially bacteria like strep mutans, which is what causes cavities. So, and of course, gum disease has different bacteria, but there is a whole bacterial biofilm that happens in the teeth. So if you don't remove that biofilm, then the bacteria will remain there and they will act on the gums and of course on the teeth. And so the gum disease and the dental caries both will be a factor if you don't remove the biofilm. So it's extremely important, especially at night, because when you've just eaten and then you go to sleep and it has time to act.
Is it more of a rural problem? Is it also as prevalent in the urban population?
So I would assume, looking at the stats, that the rural problem would be slightly more because also availability of toothbrushes, toothpastes, and other oral health aids is much less than in the urban areas. But awareness, and as Sunil said, awareness and knowledge has to be imparted so that people will be more, able to do what they have to do.
I think it is not euphoria, it is like a stampede in the market. Even here in Ahmedabad, whoever I am meeting who is not at all related to stock market and from different walk of life, different field, business-wise, career-wise, and everybody's talking about stock market only, that they want to trade, they want to make quick money, and they want to, break their FD.
Welcome back. You're watching us here on Halftime Report. Perfect time to get you the FNO update at midday as well as the trade setup is. The Nifty is somewhere in the middle of yesterday's low and today's high itself. And that's exactly where, the range of the Nifty is more or less. So if you just take a look at the levels, yesterday's low was 24,142, which coincided with the July 5th low as well, which was closer to 24,169. And we have today's high, which is 24,402, which is again around 50 points away from a fresh record high as well. So the broad range on the index, 24,150 to around 24,450 is what the street is pinning its hopes on. And the Nifty is consolidating right around that itself. What's good is that the mid-cap index is outperforming, and the broader markets, if you look at the advanced declined lines, you would see that, there are more number of stocks which are advancing as against the number of stocks which are declining in today's trading session. So you have the green line much above the red line all through today's trading session. The other thing that is standing out in today's trading session is that despite the volatility that we're seeing in the market, after a bit of a rise in the last couple of trading sessions, the India VIX has begun to cool off. So mid-caps doing well, India VIX coming down means that maybe the downside for the market seems to be a little more protected. Add to that, as we speak, the mid-cap, rather the put-call ratio on the Nifty 2 is moved towards 0.7, 0.8 from levels of 1.3 yesterday. The Nifty Bank is a concern, down 3% from the highs, led lower by HDFC Bank. From last week's low, a high of almost 1,800 rupees, HDFC Bank is come down to closer to 1,600 rupees. So it's a decline of nearly 10.5%. So what happens in these two indices is something that we will have to monitor going forward as well. For Nifty options expiry today, we're closer to that 24,250 mark. So 24,250 call as well as the 24,250 put. Both of them come up for you. Very active in today's trading session, a combined premium of almost 60 rupees. So those who are writing both the call and the put, which we know as a straddle, are writing it for a premium of 60 rupees and hoping for this range of 24,200 to 24,300 on the expiry itself, 60 points on either side of 24,250 itself. One stock which stands out in terms of an up move today is Sun TV. A lot of long positions being added, upwards of that 800 mark as well. Let's see whether it sustains here or not.
Okay, all right, Mangalam. Thanks very much for that. Nagaraj Shetty, technical research analyst at HDFC Securities, joins in on the show to discuss the technicals now. Nagaraj, welcome to the show. Well, let's start with the bank Nifty, which is under pressure. It's down around 0.5%. What would your approach be towards that index in particular?
Hi, good afternoon. Bank Nifty has been a highly downward correction from the high of around 53, 200, 300 odd levels. I'm not expecting any bigger reversal as of now, though Bank Nifty has placed at the support. There is a possibility of upside bounce from the lower levels. I think 51, 500, 600 is going to be a support for the banking sector. I'm expecting upside bounce from here onwards or from the slightly lower levels.
Okay, all right. And specific stocks, what's your approach today?
Yeah, I have a couple of stocks, especially from mid-cap and other sectors. As we know, sector rotation is happening. I have one stock from a financial side is LIC. If you look at the chart of LICI, it has been a larger consolidation pattern on the weekly chart. It is currently placed at the resistance of around 1050-55, which is a downsloping trend line. I'm expecting the overall chart pattern is indicating that this hurdle is going to be taken out on the upper side. One can look to buy around 1047-48 levels, and the initial target would be around 1105. One can place a stop loss around 1020. I have one more stock, that is Syngene. And Syngene was in a structural movement at the lower levels. 650 has proved to be a good support for the stock and bounce back from the lower levels. Current upside bounce has taken away the resistance of a downtrend line currently placed at the higher levels. Overall chart pattern is looking positive. RSI and volume is also supporting for a further upside for the stock price. Currently trading around 745, one can look to buy at this point of time. And the upside target would be 805 and 720 is going to be the stop loss.
Okay, all right. We're going to leave it on that note. Thanks very much for joining in and giving us all of those stocks in focus. Well, a quick programming note before we slip into a break. We have a big budget exclusive for you today at 3:30 p.m. The CNBC-TV18 CII Budget Town Hall. The entire top brass of the industry body will be in attendance and we'll quiz them on their budget expectations. Sanjeev Puri, Sanjeev Bajaj, Sunilkant Munjal, R. Mukundan, Chandrajit Banerjee, B. Tyagarajan, Shenu Agarwal, Vinod Agarwal and many more will be speaking exclusively at the town hall. For 25 years, CNBC-TV18 has been covering the union budget. So keep it with your budget destination for the big newsmakers and exclusive news breaks.
He was telling me yesterday only that he's working in some IT firm and all, and he want to quit and again, join stock market and all. So I think that this situation is not. Personally, I may be wrong because I have been proven wrong many times in the past. But I think this will not end well. So SEBI should take very strict action to curb this kind of frenzy in the market or stampede in the market. Now the pricing power is coming with all these telecom service providers like Jio has already increased the rates and Bharti also has followed the suit. And same is with Vodafone numbers, 15 players has shrunk down to only 3 players and BSNL is 25% players, so 3.5 or whatever you call it. So, and one thing is the for sure, earlier we used to talk about, in India, roti, kapda or makan. So now this is roti, kapda, makan or mobile. As I always say that when my driver keeps 2 mobile, I keep only 1 mobile, but my driver keeps 2 mobile. So how can you go wrong in all these things in this telecom? I think now since they have started increasing the rate, and so I think best time is ahead of them.
We were getting APM gas, which is at $6.50. From 82%, it has come down to 68%. So there is substantial reduction in the APM gas, which is the domestically available cheap gas. And the LNG prices were earlier down, but now it has started increasing again. So we are constrained to increase 1.5 rupees in the CNG prices. However, still we are the cheapest in the country in terms of CNG prices and PNG prices. The budget is passed and what is included in the budget or not. The other point.
Welcome back. We were speaking about Gateway Industry Parks doing well. Look at the industry leader out there, Container Corp. That's moved to the high point of trade. Alongside that, we are seeing some traction in a lot of these other PSU names as well. Oil India, HPCLs are a couple of stocks that we pointed out at the start of the show itself. Let's look at Petronet LNG. That one too has moved higher. And on the way up, we are also seeing some traction in names like Polycab and Bandhan Bank. Bandhan Bank actually had seen a big gash over the last couple of trading sessions. In fact, this week, despite the up move that we're seeing today, is down about 4%, but currently has moved higher with a gain of almost 2%. Speaking about rail and rail-related companies like Container Corp, etc., this morning we spoke with the management of Texmaco Rail and Engineering. Remember, the stock has seen a 60% gain this year so far, pretty much in line with the kind of gains that we've seen across the railway-related themes. And over the last couple of years as well, it's been a big mover. And earlier today, we asked the company about growth plans for this year, expectations of the union budget. They said that this year they would grow between 40-45% itself. But for the budget, they're absolutely fine even if the government does not increase the allocation, because there is so much headroom available already that it will not, put any, break to the growth that we're seeing in this sector itself. Hear the management out.
As per the interim budget, whatever be the outlay was planned, which was significantly in line with the expenditure which railway did. So we as a stakeholder look at it from a little long-term perspective rather than a year-to-year thing, because we all have seen there is a shift based on a plan in last couple of years. So I will not be astonished if it is being increased a bit in terms of as an impetus to the infrastructure. But even if it is the same, it is good enough to fructify the plan what government has in the near horizon for 5 to 7 years time. It gives enough room for us to play and to grow the way the industry is doing in last couple of years.
Okay, all right. So that's on Texmaco. But the big focus today will be TCS. It will be reporting its first quarter earnings later today. Rima is here to tell us what to expect.
Thanks so much for that. So for TCS, we're expecting a modest improvement in their revenue growth. 1.3% on a quarter-on-quarter basis in dollar terms. Constant currency revenue growth is up 1.5%. Now, typically Q1 is a seasonally strong quarter. There is a ramp-up of large deals like BSNL. All that will aid the top line. And revenue growth this time will be better than what we've seen in the last couple of quarters. Margins will come under pressure, down 150 basis points according to our poll, because of the wage hike, and that puts pressure on the company's profitability. So the CNBC-TV18 poll is seen down close to about 3.5-4%. TCV might be lower. TCV stands for total contract value. That's the deal wins, and that could be down quarter on quarter compared to Q4's bumper number of over $3 billion due to the absence of large deals. Now, what's the street going to track? They're going to track on the pace of recovery. There is hope that things pick up a little bit, at least in the second half of the year, and then accelerate in FY26. Is there anything in the management commentary which gives confidence regarding that? I've compiled what the street expects from TCS in FY25 and FY26 in revenues and margins, and that will come up for you. The street is expecting about a 5.5% revenue growth this year, accelerating to 8-9% next year. Margins too are likely to improve this year and in the following year, because the employee wage bill has been coming down, with the companies hiring less and less and attrition coming under pressure. So the pace of recovery, is there scope for margin improvement over the next 2 years, which the street is hoping for? I think they want evidence of that in this quarter's numbers. Other than that, you will watch for things like hiring, generative AI, the pickup over there, what the pipeline is looking like. And even, if there is any increasing competition coming in from global captive centers. Back to you.
Right, Rima, thanks a lot for that. In fact, stay tuned to CNBC TV18 as we will be speaking to the TCS MD and CEO K. Krithivasan, the CFO Samir Seksaria, and the CHRO Milind Lakar tomorrow at 9:45 a.m.
Maybe the gas can be included in GST, because if that so happens, then excise duty cut will not be required. It will be one tax regime for the gas segment itself.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest running show on startups and entrepreneurship, celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21, only on CNBC TV18 and CNBCTV18.com. CNBC TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhan.
India Business Hour live on YouTube at CNBC TV18 weeknights at 7 p.m.
Welcome back. Well, for the markets, just about seeing a little bit of pressure for the mid-cap index, so just about holding its head above the water, up around 65 odd points. Let's see. It seems as though there's a possibility that it's going to slip into the red. That's the mid-cap index that I'm talking about. But let's see whether there's any kind of buying at lower levels which will come through. But tax increases in the budget may make India less attractive on a post-tax basis, says Samir Arora, founder and fund manager at Helios Capital. He also speaks about STT tax collections and capital gains tax. Listen in to excerpts from that conversation.
You are getting a lot of money on STT, yet STT you are not putting in that same pool, and therefore we keep saying that, oh, the equity guys are getting lower tax relative to the bond guys or the debt guys. But let me say one thing, that if it comes through, then in theory, the biggest beneficiaries will be the banks, relatively. Of course, everything might go badly those days, but relatively it would mean that you are making it easier for the public to, not easier, but you're making the two a little bit more this thing in terms of tax preference and what is the interest of the government, which it must be then that the asset allocation is getting influenced by tax considerations, although they are not transparently counting STT on the equity side and taking that as an aside and then saying the tax rate is low. Actually, it's not that different, I think.
One more thing, which again, this is we don't know if it will happen or not. Is on the debt side now, everything is taxed at the marginal rate except arbitrage.
That's a bit too much.
Arbitrage, and that may also get corrected. I don't know. I mean,
correct. That's possible. But right now, I don't go so deep. I don't think big picture that this is wrong to have remove STT, remove anything which is giving tax, and say no. But excluding that, the tax is low.
So suppose we do get some sort of a tinkering, right? Increase in holding period or increase in the amount, the rate. Markets will fall. Will that fall be a buying opportunity according to you? Or do you think this will really unsettle the markets for a longer period of time?
It will fall according to me very simply about the same as the tax hike. Because let's say going in, you have a pre-budget expectation that you should make X% return. And so if you take 5%, it will fall broadly similar to compensate for the current holders. Then the new holders know that this is the new rate and all that, and then they change. So I think lifelong flows will moderate. As I said, it's a big picture thing. It doesn't mean it's bad or you'll have negative returns. But obviously, why should new allocation come in the same way if the expected returns from the market, instead of being 12%, are 11.4% or whatever, cut whatever. How can it be? I mean, that means these numbers have no meaning, that you can whether your expected returns are 12 or expected returns are 11, it doesn't matter because the models work like that, the thinking works like that, and the differences are only this much. It's not that 12% will become 5% return expected for long term. So obviously it matters when these big guys do their allocations, and you can see what happened in 2018, which was after a good rally, there was a tax hike of 10% effectively because the long term was 0 before that and became 10. Now we can keep saying it is because of COVID, this, that, but if you see the cumulative flows of FIs in India, although they are good, they are not of the same scale as we used to have when we were a much smaller market. And I can tell you direct conversations, of course, these guys being, don't come on TV and tell you directly, but they are most bothered by the tax because there is no set off, because they are tax exempt. For our investors or investors in ETF, there is no set off. They have to pay tax a second time in the US. Because if a guy comes into an ETF for 2 months and goes away, how to link the tax that the ETF paid with that underlying guy? What certificate to give him that this much tax has been deducted on your behalf? That is why the world doesn't take tax from foreign investors, for example. But here we are not saying that there should be a different tax rate for foreign and Indian. You please increase STT a little bit. It'll solve all your problems. You still get the same pool of money. You will also discourage short term. You will also discourage F&O indirectly by increasing that cost. You will get whatever amount you want. Just change the structure of how you collect it. You increase it as much as you want. I don't think any foreigner cares. It is just this. It goes into a basically it's gone without having any. This thing, because you might book and like for example, first quarter is good. So you have accrued a tax. The NAV has become like that. Somebody has come in, somebody has gone out. And then there's a fall in the market. Now there's no tax to be paid. But somebody has redeemed at a low price, high price. All those things are the...
All right. With that, we'll slip into a short break. On the other side, we have our Commodities segment with the birthday girl who's in the studio right now, Manisha, and joining her will be Prabir Bhattacharjee, Secretary General, Tea Association of India.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go. Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC-TV18, now streaming live 24/7 on YouTube.
The Indian markets have not just grown, they've broken several records in the last 25 years.
India's contribution to incremental global GDP was as low as 0.2% 25 years ago.
Over the last 25 years, CNBC-TV18 has closely followed the remarkable ascent of India's pharmaceutical sector.
There was a time 25 years back that it was all about the FIIs. If FIIs would buy, markets would rally. If FIIs would sell, market would fall.
Earlier, we were net importers of steel.
From IT services to SaaS, from consumer electronics to space tech, from mere programming to AI ML.
Cars, two-wheelers, three-wheelers, commercial vehicles have significantly become much more expensive than they were 2 decades ago.
Welcome back. The Nifty is now at 24,300, a firm recovery that we've seen from the lows of today. Some news coming in on data patterns, but no news bigger than the fact that it is Manisha's birthday here on today, and she joins us on the show. Manisha, wish you a very, very happy birthday. The one commodity that I would hope that you have excess of in your life is happiness.
Thank you so much. That is a commodity, and that is something that you always look forward to. Thank you. That's an amazing, amazing wish. Thank you so much for that, Mangalam. But coming to commodities then, and there are various to talk about. But today we have focus on tea, where Prabir Bhattacharjee, he's Secretary General, Tea Association of India, joins us to talk about exactly that. Mr. Bhattacharjee, hi, thank you for your time. First of all, the tea prices have been surging. They're at a multi-year highs. What is your sense? Where do you see the prices going in from here? And when you look at the fundamentals pushing these prices higher, one is, of course, the production that has declined for sure. The export numbers sound good as well. So how do you look at many of these numbers playing out when we go forward from here?
Thank you very much. Good afternoon, Manisha. And first of all, a very happy birthday to you. Now, coming back to the commodity, coming back to the commodity that we are discussing. Yes, you're very correct over here. The prices have noted a surge in the last couple of sales. In fact, if one were to divide the sales part, from the beginning of the year, you see there are 26 sales that has taken place. From first to 16th sale, the prices were not moving at all. But from 16th sale to the 24th or 25th sale that has taken place, the prices have moved. In fact, the average, from 203, it has come to 236. So definitely there has been a surge in the prices. But as you very rightly pointed out, this surge in the prices is riding on the back of the lower production that we had in the month of May and June. Now, Manisha will recollect that, we were, the tea people, we always, crib about, small changes in the weather and all that. You know that in the month of April and May, it was an excessive, the sunlight that we were having over there. The heat was tremendous over there. There was no rainfall at all. In fact, the rainfall had, reduced to 50% of the normal rainfall that we had. But then what come the month of June with the monsoons, the rainfall has surged again over here. There's a surfeit of rainfall that has taken place. Now you see, either of the scenarios affect the production of the tea. And the net result is this: we are still, as on date, 44 to 45 million kgs behind on the production front, compared to the last year. So
okay.
These are the
with 45. Yeah, with 45 million kgs lower than last year, this is until now. But for the rest of the season, going forward from here, what kind of a shortage are you working with?
Manisha, to tell you very frankly, you see, the bulk of the tea is manufactured from the month of July to October. In fact, 50% of the tea, comes in these 4 or 5 months, it comes over there, more than 50%. So now with the weather gods being what it is over here, it is very difficult to make a prediction. But the fact remains over there, to make up any 45 to 50 million kgs is a Herculean task, So the very fact, or if one were to prophesy, then are you going to make it up? That becomes a difficult job, We'll be very happy if it comes at par also to that of the 2023 production.
Okay. Now, with the prices, which are nearly 15% higher as compared to previous year, do you see them stabilizing here? Do you think there is still more upside to this?
I personally feel, the prices should stabilize over there because, there's in perpetuity, there's a shortfall of 45 to 50 million kgs, So that way, one had to, if the basics are to be taken, then there should be, this momentum should be, continued over there. So that way the prices should remain over there. But then you never know, what happens, in tea industry, as you know, it's supposed to be a very delicate commodity. Slight variations here and there, the whole result are changed, accordingly.
All right. Mr. Bhattacharjee, also, how do you see India's demand growth now? We do understand that it's been increasing. The last time I spoke to you, which has been quite some time back, what are the numbers now that you have in hand?
Very frankly, the consumption rates, are not, something which one can boast about. We had a consumption rate around about, under 800 grams, for many years. But now it's settled around to 840 to 850 grams per capita. But that is too low, And very well, I've told there are countries which have for example, Turkey. Turkey has a per capita consumption of 4.4 kgs, UK 2.6 kgs. So compared to that, we are nowhere at all. If there is some incremental growth in the consumption, this is much of the woes of the industry will vanish then.
All right. A final question then, Mr. Bhattacharjee, and this is regarding the budget. We do understand that tea as a sector also has gone through its own set of challenges. Are you anticipating some support, some subsidy, encouragement coming in from this budget?
Yes, Manisha, that's one area, that I wanted to touch upon. First of all, as you know that with the industry, like any other sector, we are going through the climate change. So obviously, certain of the irrigation parts, we do expect some sort of or we do look forward to, if there is a wish list, that we should be looking forward to some concessions on the irrigation part. And most important, is this, that is that road tip, that's the embedded tax part, which has been extended to 30th of September, which is a mere 1.67%. In its previous incarnation, it used to be 6.7%. So that is where, we expect the Ministry of Finance and the Government of India to have a closer look. If that happens, some of the subsidies, this matter a lot in these circumstances.
All right. One thing is what you've asked for, and we hope that one thing is what the Finance Minister definitely does give to you. But thank you so much, Bhattacharjee, as always, for joining us and making sense of the tea sector, where we have seen very huge price volatility and, of course, lower crop that clearly has been supportive of the prices. But with that, it's a wrap on Halftime Report. Business Lunch will take all the action ahead.
Thank you. Thank you. Thank you much.
Discounting is high there, but their focus is squarely on the 125cc segment.
Now it is contributing 16% of incremental global GDP.
Now we are looking at exporting the steel that's made here in India.
Welcome to the first ever India Business Leader Awards.
Cars, two-wheelers and vehicles generally being manufactured today are much lower on emissions and much higher on safety.
India's technology industry has been at the forefront of cutting-edge innovation over the last 25 years.
It's the retail which is the driving force for the market right now.
Clearly, we have arrived on the global economic stage. Great way to celebrate our own 25th year, with new milestones being achieved on the Lal Street.
21 years of the Nifty from 1,000 to 10,000 today.
Sensex and Nifty hit a record high.
The Nifty rallying to a record high.
We invite you to join us as we persist in leading coverage of the pharmaceutical and healthcare domain, documenting India's expanding expertise in medicines.
25 years of excellence and unparalleled growth.
CNBC-TV18, embarking on a quarter century of excellence.
Dr. Sunil, one of the statistics say that only 50% of Indians brush twice a day. Do you think that's simply because of a lack of awareness? Or do you think it's also a cultural issue where, one of the statistics or reports that I was reading indicated that we just don't feel the need to brush more than once a day?
It's not a question of need. It is absolutely required. It's a mandate that you should brush twice a day. In the morning, to remove everything that has been lying in your mouth while you're sleeping at night, and the acidogenic bacteria that work on it and create harmful acids, etc., and to generate freshness. And in the evening, of course, to remove all food debris and material that may be going to remain in your mouth through the night. You clean it up, you rinse it, and then you go to sleep.
Okay, but what happens if you don't? If you can just explain to us, what are the risks of not doing so?
So what happens is there's a buildup of what is known as a biofilm on the teeth, and the biofilm contains bacteria, especially bacteria like strep mutans, which is what causes cavities. So, and of course, gum disease has different bacteria, but there is a whole bacterial biofilm that happens in the teeth. So if you don't remove that biofilm, then the bacteria will remain there and they will act on the gums and of course on the...
Frontline indices dip further, but some recovery is noted in mid-caps, with advances outnumbering the declines. Real estate as well as financials are the big losers today, even as energy and metals eke out gains.
While TCS is expected to report higher revenue growth and slimmer margins in the first quarter following a wage hike, the focus will be on its commentary on demand, hiring and traction on generative AI when it announces its earnings later today.
After selling 75% stake in Glenmark Life Sciences to Nirma, Glenmark Pharma and promoter Glenn Saldana have now floated an offer for sale for their residual 7.85% stake in the company. The move will see Glenmark exiting the life sciences business.
And the RBI has now permitted all residents to open forex accounts in Gift City for all purposes. Earlier, such accounts could only be opened to buy securities of overseas companies or for foreign education payments.
Hello and welcome. You've tuned into Business Lunch. I'm Nisha and with me is Hormaz. And yes, markets have been weak today, but of course, some bit of correction. Profit booking as well as consolidation was probably required. Many global, market experts have stated in the past that India's valuations have been one of the most expensive. Taking stock of market at lunch hour, well, Nifty 50 is at 24,297 levels, just a little shade below and almost touching 24,300 level and down by about 0.1%. It is a fair bit of recovery from the low point of the trading session, but still is down because of a lot of heavyweights, especially coming in from the financials, which are a drag in the market and seeing profit booking. Case in point, HDFC Bank. Now, Sensex 2 is losing 136 points at the moment. Bank Nifty is taking a downward movement of about 0.5%, which is underperforming the other key indices. Mid caps more resilient in the green, 0.1% up in trade, but that is also impacting the advance decline ratio, with advances slightly higher than the declining because of the broader market participation. Some of the consumption companies like Nestle is one of the top loser on Nifty 50, and the PSUs are gaining again. Coal India, ONGC, BPCL are the top gainers in terms of percentage on Nifty 50. Hormaz.
It's following a pattern, the index. Yesterday it made a similar pattern. It made a low and then it recovered from the lows of the day. Even today, it's a 100-point recovery from the lows. 24,193 is the low that the Nifty made, and we are exactly at 24,293 as we speak. So a 100-point recovery coming on the benchmark index. The heavyweights were driving the market lower, and then the heavyweights recover from the lows of the day, and that is driving the recovery in the indices as well. So the Nifty, and it's an all-important last few hours of the trading day because it's also the weekly expiry today, so that will come into play towards the final hour of trade. And as Nisha was highlighting, the PSUs are doing very well for themselves in today's session. The Nifty PSE index, after over a month, has finally recovered the losses that it made on the 4th of June. 11,353 was the high that it had made on the 3rd of June. Then it saw that 16% drop on the Lok Sabha election result day, and now it has recovered from those losses and now making a high towards 11,400 is the Nifty PSE index. REC, BHEL, PFC are some of the top contributors towards that recovery. REC shares are almost up 40% in the last 1 month, and so are the shares of PFC and BHEL, which have gained anywhere between 25 to 30% as well. So good going for the PSUs, but the focus is on earnings season. The Nifty earnings season begins today, and it is the IT bellwether TCS that will be reporting its first quarter results later in the evening. And Rima is joining in to tell us what the street is expecting from the IT bellwether. Rima, over to you.
TCS were expecting a modest improvement in their revenue growth. 1.3% on a quarter-on-quarter basis in dollar terms. Constant currency revenue growth is up 1.5%. Now, typically Q1 is a seasonally strong quarter. There is a ramp-up of large deals like BSNL. All that will aid the top line. And revenue growth this time will be better than what we've seen in the last couple of quarters. Margins will come under pressure, down 150 basis points according to our poll because of the wage hike. And that puts pressure on the company's profitability. So the CNBC-TV18 poll is seen down close to about 3.5–4%. TCV might be low. TCV stands for total contract value. That's the deal wins, and that could be down quarter on quarter compared to Q4's bumper number of over $3 billion due to the absence of large deals. Now, what's the street going to track? They're going to track on the pace of recovery. There is hope that things pick up a little bit at least in the second half of the year and then accelerate in FY26. Is there anything in the management commentary which gives confidence regarding that? I've compiled what the street expects from TCS in FY25 and FY26 in revenues and margins, and that will come up for you. You know, the street is expecting about a 5.5% revenue growth this year, accelerating to 8-9% next year. Margins too are likely to improve this year and in the following year because the employee wage bill has been coming down with the companies hiring less and less and attrition coming under pressure. So the pace of recovery, is there scope for margin improvement over the next 2 years, which the street is hoping for? I think they want evidence of that in this quarter's numbers. Other than that, you will watch for things like hiring, generative AI, the pickup over there, what the pipeline is looking like. And even, you know, if there is any increasing competition coming in from global captive centers.
All right. Thanks so much, Reema, for getting us all the details on what's expected from TCS. But also stay tuned to CNBC TV18. We will be speaking to the entire top management of TCS, MD and CEO, CFO, CHRO, all over here on CNBC TV18 tomorrow at 9:45 a.m. All right, let's focus on the banking stocks then. And Yes Bank is rallying after Moody's upgraded its credit outlook on the stock. And Abhishek Kothari is right here to give us all the details. Tell us, Abhishek.
Moody's have upgraded the outlook on Yes Bank. Rating has been reaffirmed at BA3 on various instruments in the balance sheet of Yes Bank. So outlook has been raised to positive from stable. Now the change in outlook actually reflects the expectation that has been met with respect to gradual improvement on fundamental basis on Yes Bank that Moody's has seen. So improvement in deposits and lending facilities that can improve the profitability going ahead over the next 12 to 18 months is what Moody's is expecting. They expect cost of funds, to remain higher for Yes Bank versus peers over the next 12 to 18 months as well. And they may upgrade ratings of the bank if they sustain their core profitability along with stable asset quality going ahead. Now, rating upgrade is possible if PPOP, that is operating profit to total asset, is sustained at 1.2% or above. So downgrade of Yes Bank's rating is unlikely over the next 12 to 18 months. That this is the first time that I am seeing that a rating agency is saying that downgrade is not possible for next 12 to 18 months, which is a good sign. Rating could be downgraded if at all CET1 ratio falls below the 10% level and PPOP, that is operating profit to total asset, if that is sustained at 0.8% or below. Back to you.
Abhishek, thanks a lot for that. Trading with healthy gains is Yes Bank, almost 5% higher as we speak, but slightly off the highs of the day. At one point was trading with gains of almost 7.5 to 8%. So good day in the office for Yes Bank. But as we slip into a short break, a quick programming note. Will the RBI cut interest rates this year? Is the RBI worried about a bubble in the stock market? Is India poised for a GDP upgrade? Coming up later in the day, a CNBC TV18 mega exclusive, the definitive RBI Governor Interview, only on India's most watched business news channel. Stay tuned. Back on the other side.
And so the gum disease and the dental caries both will be a factor if you don't remove the biofilm. So it's extremely important, especially at night, because when you've just eaten and then you go to sleep and it has time to act.
Is it more of a rural problem? Is it also as prevalent in the urban population?
So I would assume, looking at the stats, that the rural problem would be slightly more because also availability of toothbrushes, toothpastes and other oral health aids is much less than in the urban areas. But awareness, and as Sunil said, awareness and knowledge has to be imparted so that people will be more, able to do what they have to do.
I think it is not euphoria. It is like a stampede in the market. Even here in Ahmedabad, whoever I am meeting who is not at all related to stock market and from different walk of life, different field, business-wise, career-wise, and everybody's talking about stock market only, that they want to trade, they want to make quick money, and they want to, break their FD, and they want to, somebody was telling me yesterday only that he's working in some IT firm and all, and he want to quit and again, join stock market and all. So I think that this situation is not, personally, I may be wrong because I have been proven wrong many times in the past. But I think this will not end well. So SEBI should take very strict action to curb this kind of frenzy in the market or stampede in the market. Now the pricing power is coming with all these telecom service providers like Jio has already increased the rates, and Bharti also has followed the suit. And same is with Vodafone. Numbers 15 players has shrunk down to only 3 players, and BSNL is 25% players, so 3.5 or whatever you call it. So, and one thing is for sure. Now, earlier we used to talk about, in India, roti, kapda or makan. So now this is roti, kapda, makan or mobile. As I always say that when my driver keeps 2 mobile, I keep only 1 mobile, but my driver keeps 2 mobile. So how can you go wrong in all these things in this telecom? I think now since they have started increasing the rate, and so I think best time is ahead of them.
What are the tests that women need to probably undertake when they are approaching perimenopause, physical as well as maybe blood tests? What would you recommend?
See, blood tests in general, like with the whole body checkup.
Back with us here on Business Lunch, and it's time for a CNBC TV18 exclusive. Sources are telling CNBC TV18 that Vedanta is likely to launch a QIP soon. And Sudarshan is here with the details. Sudarshan, what are your sources telling you?
So now in the last 2 sessions, if you see, Vedanta's stock has fallen almost 4%. Now we understand from our sources that Vedanta is expected to launch the QIP soon, and it is expected to be for up to rupees 8,000 crore or say $1 billion. Remember, on June 21, Vedanta shareholders had approved fundraising for up to rupees 8,500 crore, and earlier to that, in the month of May, Vedanta's board had given go-ahead for the fundraising via equity issuance or via other financial instruments. Now with all the approvals are in place, we understand from sources that companies in talks with bankers to launch its QIP at the earliest. Now if this QIP takes place, there will be an equity dilution for the second time in a month. In June, promoter has sold 2.6% equity via block deals at a price of rupees 427 per share, and since then stock has jumped almost 9%, and in this year in 2024 the stock is up more than 73%. CNBC TV18 has reached out to Vedanta, but comments are still awaited regarding the QIP launch.
Thanks so much, Sudarshan, for getting us all those details. And well pointed out, it's going to be the second one in a very short period of time when it comes to equity fundraising. But remember that the requirement for Vedanta's parent company for reducing their debt is huge. And now that the market is giving them the value, it is probably the right time to raise funds. Now, moving on, as Budget 2024 draws closer, Naina Lal Kidwai, the director at Rothschild, spoke to CNBC TV18's Abhimanyu Sharma about her expectations from the upcoming budget. Let's listen in.
Ma'am, thanks for speaking with CNBC TV18. What are the key demands from the upcoming union budget? Of course, it's a new government. It's the first full-term budget for this government. What are the demands of the industry?
You know, so much has been done in the right direction that it's not so much a demand as much as a wish to ensure that the path of progress and economic growth that we have embarked on as a country should continue, maybe with even more zeal than we have seen. If we look at our infrastructure and capex programs as coming from government, superb. Government's ask, in fact, is of the private sector to step up more for capital expenditure. So does the PLI scheme help that? Are there incentives therein that can help the whole capital expenditure space? I think would be important. I think an area which Indian industry needs to step up more to, and which has been disappointing for a variety of reasons, is R&D. And if we look at the focus that China now has on upgrading and upscaling all they're doing in terms of innovation and to be cutting edge in technology, I think it makes our need to do this even more as we look to lower our China dependency. So I would like to see some incentives and some programs which enable companies or encourage them to spend more on R&D, and also to ensure that there is a nexus between the way our institutes of learning, our IITs, our science and technology divisions and government can maybe engage together with industry to ensure that we can have a substantial R&D initiative, whether it's in pharma, whether it's in deep tech, whether it's in IT, and indeed in sustainability and renewable energy agendas as well.
And as the budget draws closer, a quick programming note. We have a big budget exclusive for you today at 3:30 p.m. The CNBC TV18 CII Budget Town Hall. The entire top brass of the industry body will be in attendance and we will quiz them on their budget expectations. Sanjeev Puri, Sanjeev Bajaj, Sunil Kant Munjal, R. Mukundan, Chandrajit Banerjee, B. Tyagarajan, Shenu Agarwal, Vinod Agarwal and many more will be speaking exclusively at the town hall. For 25 years, CNBC TV18 has been covering the union budget, so keep it with your budget destination for all the big newsmakers and the exclusive news breaks.
All eyes would be on the union budget under the new government, so all eyes on that. But moving on to some international development, and NATO's 75th anniversary summit took place in Washington, D.C., where the allied members have committed 40 billion euros to Ukraine in aid by the next year. In fact, NATO's Secretary General will continue to support Ukraine's irreversible path to NATO's membership.
The Security Alliance indicating its intention to provide Ukraine with at least 40 billion euros in military aid within the next year. It stopped short of the multi-year commitment that NATO Secretary General Jens Stoltenberg was hoping for. It also pledged to support Ukraine on an irreversible path towards integration. And during a dinner, President Joe Biden praised the alliance for standing up to tyranny.
75 years ago, when our nations created NATO, former President Truman said, and I quote, what we're about to do here is a neighborly act. A neighborly act. The allies in this room not only share a common language, don't share a common language, we do not share a common border, but we are neighbors. We're neighbors because we all share common beliefs in dignity, equality, democracy, and freedom.
On the question of Ukraine's membership to NATO, the outgoing NATO Secretary General stressed it's not a matter of if, but when.
As Ukraine continues its vital reforms, we will continue to support them on their irreversible path to NATO membership. The work we are doing together now will ensure that when the time is right, Ukraine can join without delay. It is not a question of if, but when.
Time for a short break here on Business Lunch. Up next, we get you a lowdown on the massive data center opportunity presenting itself in India. Stay tuned. Back on the other side.
Especially if they got a family history, will have this blood pressure, diabetes, and all those will be first diagnosed in a blood test. And the symptoms appear very much later. Then if there's a lipid profile is changing, so they can be started on statins now so that the cholesterol does not collect on their arteries, and then they have lesser chances of heart issues later on. Then the bone density is very important because a lot of times the density decreases. It's like a pillar without the concrete inside. So old ladies, especially if they're very frail, if they just fall in the toilet also, the bones break like twigs. That's because the bone depletion. So they will have to get this calcium and iron, or maybe start calcium at 35 years of age and continue for a long time. And then those specific to gynae is, like I told you, mammography or ultrasound. If they're younger than 40, it should be ultrasound of the breast. Or sometimes on the mammography, what happens is they say that the breast tissue is very dense and they cannot see it. Then we have to send them for ultrasound breast. Then the internal examination by the gynecologist. The pap smear, a better form of pap smear is LBC, liquid-based cytology, and HPV vaccination. That has testing and an ultrasound lower abdomen.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest running show on startups and entrepreneurship, celebrating 21 action-packed years of building India's biggest startup community. Young Testing.
Welcome back. You're watching Business Lunch, and yes, market is pacing its recovery with mid-caps really showing much more buying at the lower levels. And to important news, Prime Minister Narendra Modi met with economists ahead of the upcoming budget. Remember, all eyes are on that, and preparations are in full swing ahead of the annual exercise, which is now slotted on 23rd of July. So those are the economists really giving their point of view, suggestions. We know that many industry leaders have been reaching out to even the finance ministry with their wish list, and government agencies are really accounting for all the direction as well as the suggestions coming in from the industry for really showing the roadmap under the new government. So those are the important, moments coming in, the pictures from the Prime Minister's meeting with the economists ahead of the budget.
All eyes on the union budget then on the 23rd of July. But moving on, with a population of over 1 billion people, India generates a massive amount of data. But the capacity to store this data has been lacking, implying that most of the data generated in the country gets stored overseas. Now, with the government keen on storing domestic data in India itself for multiple reasons, and with factors like power costs in favor of setting up such infrastructure, a huge opportunity is opening up in the data center space. Take a look.
India generates about 20% of the global data, but has only 3% of the world's data center capacity. This means that a significant portion of India's data is stored overseas. However, this is set to change as India emerges as a significant player in the global data center market. India is attracting huge investments for data centers, and here's why. Number one, capex cost for setting up a data center in India is about 45% lower versus the world average as per CareEdge. Second is power costs, which account for nearly 80% of operational costs for data centers.
Each of our clicks from our mobiles or laptop or desktop or our smart TV is actually going into a data center, where that data is stored, where it is getting processed, computed and stored and given back to us. 3% of the worldwide energy today is actually being consumed in a couple of thousands of buildings in the world, which are data centers. And this, by the way, is a number higher than the total energy consumed by the entire airline industry of the world.
And guess what? As per former Power Minister R.K. Singh, India has one of the lowest power tariffs in the world. Number 3 is the support from the Indian government. Data centers have been granted infrastructure status by the government during the Union Budget FY23, making it easier to access credit and secure foreign funding.
Data centers and energy storage systems, including dense charging infrastructure and grid-scale battery systems, will be included in the harmonized list of infrastructure. This will facilitate credit availability for digital infrastructure and clean energy storage.
The government's push for data localization through Digital Personal Data Protection Act 2023, RBI guidelines for storage of payment system data also is a major growth driver. Draft Data Center Policy dated November 2020 is also another enabler. Recently, India topped major APAC countries with the highest data center capacity in the Asia-Pacific region, excluding China. According to a CBRE report, as of May 2024, India has 152 data centers with an operational capacity of 1074 megawatt. This capacity is set to double with an additional 1000 megawatts to come up by 2026. The per megawatt cost for setting up data center in India, which was close to 40 to 45 crores, has now risen to 60 to 70 crores per megawatt due to incremental land, equipment and other soft costs. This means an outlay of 60 to 70,000 crores would be needed to set up 1,000 megawatts, out of which 60 to 65% of the cost would be towards mechanical and electrical equipment. This opens up a huge domestic opportunity of 36 to 46,000 crores for suppliers to this ecosystem.
In data consumption, you have data centers where India is one of the hottest market in the Asia Pacific region.
What is the asset owners? The companies which provide the land, and they are the real estate companies which are exposed in there. And second are the companies which kind of provide some nuts and bolts to data centers, which could be gensets, which could be power supply, or some specific type of maybe transformers and areas like that. So these are the few parts of the supply chain of the data center business, which taking exposure to, particularly over the next 3-5 years, could add to good amount of maybe kind of growth or earnings momentum to the portfolio.
Let's look at it on a granular level. Gensets, which ensure that data centers remain operational during power failures, present an opportunity of 3,400 to 4,300 crores. Cummins India and Kirloskar oil engines are the likely beneficiaries. Motors, which are essential for operating various mechanical systems within data centers, would require 7,300 to 9,200 crores of investments, which will drive demand for products from Siemens, ABB, Crompton and Bharat Bijli.
It has emerged as one of the fastest growing segment, and in our assessment, I think it is going to be a multi-year, if not longer, in terms of how this segment is going to play out.
Switchgears, crucial for ensuring efficient and safe power distribution in data centers, presents an opportunity worth 7,700 to 9,800 crores, beneficial for manufacturers like ABB, Siemens, CG Power, Hitachi Energy and Schneider Electric. 2,100 to 2,700 crores worth of investments for transformers and GIS substations will boost order books for Schneider, Bharat Bijli, Voltamp and Transformers and Rectifiers India. HVAC systems essential for preventing overheating in data centers present an opportunity worth 7,700 to 9,750 crore. This bodes well for players like Voltas, Blue Star and Johnson Hitachi. And that's not all. There is a huge runway for growth beyond 2026 as well. Jefferies expects data center capacity to reach 17,000 megawatt by FY30. And this in turn implies a long runway for capital good companies as well.
And with that, it's a wrap on this edition of Business Lunch. From Nisha, me and the team that put this show together, thank you so much for watching. Midcap Radar on the other side.
Only on CNBC TV18 and CNBCTV18.com. CNBC TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhatt.
India Business Hour live on YouTube at CNBC TV18 weeknights at 7 p.m.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go.
Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC TV18, now streaming live 24/7 on YouTube.
have not just grown, they've broken several records in the last 25 years.
India's contribution to incremental global GDP was as low as 0.2% 25 years ago.
Over the last 25 years, CNBC-TV18 has closely followed the remarkable ascent of India's pharmaceutical sector.
There was a time 25 years back that it was all about the FIIs. If FIIs would buy, markets would rally. If FIIs would sell, markets.
Good afternoon. Welcome to Midcap Radar. I'm Sonal Bhutra. With me is Vivek Iyer. Continues to be a down day. It's been quite volatile actually so far, but the midcaps are outperforming. A lot to discuss on the show, so let's get started.
Absolutely right. Like you mentioned, similar to yesterday, post 10 a.m. we did see quite a bit of selling pressure and the sell-off was quite intense. But at this point of time, similar to yesterday, it seems to have abated. But quite a lot lined up on the show. Let's start off with the top headlines. Frontline indices dipped further, but some recovery noted in the mid-cap space. Realty and healthcare are the big losers. Even in oil and gas, along with metal, eke out some gains.
Tata Elxsi under pressure after reporting its Q1 FY25 numbers. Revenue beats street estimates while margin comes in lower. Healthcare vertical is under pressure, fell 4.3% on a sequential basis.
Sona BLW up over 6% in trade after Bernstein issues an outperform rating on the stock with a target price of 780 rupees. Says the company is a beneficiary of transition in mobility and should reverse underperformance this year itself.
Order wins boost HPL Electric and Ahluwalia contracts. HPL Electric bags order worth 2,100 crore rupees for supply of smart meters. The stock is up 20%. Ahluwalia contracts wins order for terminal building construction at Varanasi Airport.
Raymond sees a sharp fall today after trading X of its lifestyle business. Today was the X date for demerger of the lifestyle business.
Okay, all right, those are the top headlines. We'll discuss some of these stocks in greater detail as well. But let's take a look at the markets. The Nifty down 38 points right now. We have the banking index, which is underperforming. That one is down 0.5%. At a point in time, we saw that sharp recovery at around 12:30 p.m. And that so far has sustained at those levels. We do have the media stocks which are doing well. The CPSE index is doing really well today. Some of these oil and gas themes are surging in a weak market like this. Realty and pharma, that has come in for some profit booking today. But it's again down day, one day. Again, we see an up day. That's been the trend.
Volatility, the VIX is the one that we need to keep tracking because VIX continues to spike higher. But this is the show Midcap Radar, and this is our special segment, Midcap Mover. Hormaz is at the wall to take us to the top midcaps that are moving in the session.
Up one day, down the other, maybe, but then there are always plenty of stocks that are moving around in the broader markets, and some of them continuing with the trend. Let's start off with some of the gainers on the gaining side since the broader markets are outperforming. NMDC Steel is one of them, 5.5% higher, near the highest point of the day. MRPL is having a good day today. CDSL is making a comeback after a while, 8% higher now at the highest point of the day. And RVNL continues its record-breaking run, 30 bagger now from its IPO price of 19 rupees. Today it's at 630. Now there are some other stocks that are doing well in today's session. Most of them belong to the shipping space, and those are the ones that Shreyas Shipping in a 20% circuit, Shipping Corporation also in a 20% circuit, Cochin Shipyard is up 5%, and G Shipping also having a good day for itself. You mentioned about order wins, and those are the stocks that have also surged on the back of that. HPL Electric, another 20% circuit. That order is almost 2/3 of its market cap, so big order win there. Ahluwalia Contracts also winning an order, and Kalpataru Projects also won some orders earlier in the day, seeing some gains in today's session. Some stocks doing well on the back of volumes, and Sona BLW, positive brokerage note coming in there, 6.5% higher on strong volumes. PCBL having a good day. Engineers India is having a good day at the highest point of the day now, 10.5% higher, and BSE slightly off the highs but still trading with gains of 3.5%. And lastly, some stocks that are bucking the trend in today's session. And Tube Investments saw a block deal earlier in the days, now 5.5% lower. Brigade Macrotech, real estate is under pressure, and Aegis Logistics also not having a good day in the office today. Back to you.
Okay, all right. Thank you so much, Varmas, for joining us. So those are some stocks which are moving around in the broader markets. Let's welcome Samir Chaman from Angel One for a technical check on the market. Samir, good afternoon. Thank you so much for joining us. Well, what's suggesting the market moves that we've been seeing? There was that sharp recovery we saw around 12:30. It has sustained at those levels, but do you think we'll see more recovery from there, or it could again continue to be a volatile day?
Good afternoon, Sonal. See, market has clearly slipped into a consolidation mode. Now, there are two, key observations, that are warranting some sort of caution here. But since, market, if you see in last 6 odd months, market has been seeing gravity-defying moves, so it would be difficult to, take that call whether this data points would trigger some sort of correction or not. So one being the FIS index long short ratio, which has reached 80%, which is the highest in recent months. So at least this suggests that the upside would be limited. So we are suggesting is in case Nifty again comes back to its recent highs 24,500, 600, that's the time to take some money off the table. And the other key technical data point would be that prices are now deviating far away from the key moving averages. So that is the reason we are not seeing momentum in the upward direction. So some sort of profit booking is happening, but since the overall relative strength is quite high, at low levels some sort of buying trigger happens. So as of now, we are keeping a close on important level 23,900, 24,000, which is the 20-day exponential moving average on daily chart for Nifty. In case Nifty slides and stays below that, then probably we could see some decent correction toward 23,600, 500 before the budget itself. But if that doesn't happen, then Nifty is likely to vacillate within the 500, 600 point, wherein on the higher side 24,500, 24,600, these are the levels to watch out for. And on the lower side, we would see support coming around 23,900, 24,000.
Okay, Samit. Good afternoon, Samit. What are the individual stocks that you have? Any buy or sell recommendations?
See, in tandem with the market mode, we would have mixed bets. One would be on the long side and one would be on the short side. On the long side, we like ONGC. Last 7-8 odd months has been dream run for this particular counter. If you consider its overall behavior in the last decade itself, the stock is now trading at its highest level since 2014. So that suggests this stock is now proving some sort of metal. On the daily chart, it has already confirmed its breakout last Friday. It has been continuing this move. The volume activity has risen substantially in this move, so we expect continuation of this move. With a momentum perspective, the stock is likely to move towards 320, 322. Stop can be kept around 296 for this momentum trade. On the short side, metals are showing some sort of weakness since last reported. So JSW Steel has confirmed the breakout on daily chart. So we suggest going short by keeping strict stop loss around 928 for JSW Steel and target to watch out for around 900, 896.
All right. Okay, Samir, thank you so much for joining us. Those are some technical bets, but with that, we'll slip into a short break. As we do that, a quick programming note. Will the RBI cut rates this year? Is RBI worried about a bubble in stock markets? Is India poised for GDP upgrade? Coming up later in the day, a CNBC-TV18 mega exclusive, the definitive RBI Governor Interview, only on India's most watched business news channel. Stay tuned for that.
Earlier, we were net importers of steel.
From IT services to SaaS, from consumer electronics to space tech, from mere programming to AI ML.
Cars, two-wheelers, three-wheelers, commercial vehicles have significantly become much more expensive than they were 2 decades ago.
Discounting is high there, but their focus is squarely on the 125cc segment.
Now it is contributing 16% of incremental global GDP.
Now we are looking at exporting the steel that's made here in India.
Welcome to the first ever India Business Leader Awards.
Cars, two-wheelers and vehicles generally being manufactured today are much lower on emissions and much higher on safety.
India's technology industry has been at the forefront of cutting-edge innovation over the last 25 years.
It's the retail which is the driving force for the market right now.
Clearly, we have arrived on the global economic stage.
Great way to celebrate our own 25th year with new milestones being achieved on the Lal Street.
21 years of the Nifty from 1,000 to 10,000 today.
Sensex and Nifty hit a record high.
The Nifty rallying to a record high.
We invite you to join us at
Welcome back. You're still tuned into Midcap Radar. Well, there's been an update that we got last evening. Resident Indians can now open foreign currency accounts at Gift City under the liberalized remittances scheme. Forex accounts can be used for all foreign current and capital account transactions as well. What is the impact on you and me? To discuss this and more, Naveen Mathur, Director of Gift City, joins us now to explain this. Mr. Mathur, good afternoon. Thank you so much for joining us. That's the first question, really. What is the impact of this move for any normal resident of the country?
Thank you very much, Sonu. Good afternoon to you and the viewers too. It's a great move, actually. Means till now, what used to happen is that you are remitting money through LRS from your Indian account to the Gift City, and therefore you are only allowed to do the transactions for the equity markets without any derivative transactions. What has actually happened with this particular notification is, now, within the $250,000 limit on the LRS, if you have an FC account or the FCI account, which is a foreign currency account, you can use this particular account, as you rightly said, for the current and the capital account transactions, not just in IFSC, but for the other jurisdictions, the foreign jurisdictions which are outside India. The major change is that apart from equity, now you can use this particular remittance or the account which is held in IFSC jurisdiction. The Gift City IFSC jurisdiction can be used for the wider range of purposes. Now you can leverage, means you can send the gifts to your friends abroad, you can buy the properties, immovable properties, you can buy insurance, even you can do the fixed deposits with your account in the foreign currency. So you actually get benefit with respect to hedge for inflation and particularly with depreciation of the US dollar. So it's a great move, making I would say a step forward for the GIFT IFSC in comparison to the other international financial services center across the world. So it's a great move by the RBI, opening up various avenues for you to use the money held in the Gift City foreign currency account for the purposes as I mentioned earlier. Sunil.
Mr. Naveen, you just mentioned earlier there used to be a limit on what you could actually hold in this particular account. So when you're comparing it to that, right now, is there any limit, or are you free to hold as much as you want? And number two, what are the other key differentiations between what is allowed now versus what was allowed earlier?
See, the major differentiation, I'll come to the second point first. The major differentiation is that you are not just, you can use this particular account not just for the equity purposes. It means the derivatives were not allowed earlier too. And it seems that it is not the case even with the current notification. Still need to read through in detail. But what I would say is that restriction still applies. The benefit is that you are not just limited to equity. You can use that particular money for various products within the Gift City IFSC jurisdiction, and even for the foreign jurisdiction. Foreign jurisdiction means you can use those funds for other countries and the products and financial services for other countries too. As far as the limit is concerned, that still remains at $250,000 through LRS to be used for this particular account, because IFSC, we should all understand, the Gift City IFSC is a foreign jurisdiction. So you need to use the LRS route to transfer the money to the foreign currency account in the IFSC. You can hold the money for 6 months only as what it is. What we understand as of now is that 6 months is the limit where you can use this particular money. Otherwise, it has to be remitted back. So this is the 6 months limitation, I think, still remains. And the purposes, as I mentioned, are all current and the capital account transactions, including the travel and the educational loan purposes, whatever you have taken for your kids to study outside even for the IFSC jurisdiction.
Got it. You actually answered my next question. I was going to ask you, is there again a time period limit? If you don't utilize those funds, do you have to, take it back? But Mr. Mathur, you spoke about how it can be used for education, it can be used for healthcare, for other purposes. The big talking point during budget was that tax collected at source for foreign remittances. Does that still apply to this? What happens to people with high transaction values in foreign accounts?
I think it doesn't speak about, the notification is just 1.5 pages of a notification. It doesn't talk about anything on the taxation. I think so, therefore, it is implicit to understand that the taxation regime still remains the same as it was earlier. Only thing which has changed is the instruments which you can use from that particular account, the financial instruments which you can use from that particular account, which has changed drastically, I would say. And I think it's a great move for the IFSC to be seen as a comparison to the DIFC or the Singapore or the London city of London also.
Mr. Naveen, in terms of convenience, of course, this particular move is very important. Also, do you see any kind of savings, if in terms of actual transaction cost that will transpire in case, there are people who come and, use this particular facility?
I think that won't change too much. I think that doesn't have too much of an implication on it. See, what normally happens is, as an individual, if I want to invest in certain foreign securities through LRS, the money goes from my resident account in India. The LRS purposes are limited. S0001 is the purpose under which you remit money to any transaction which is allowed through LRS. Repeating it again, the maximum permissible limit through LRS for any resident individual still remains $2.5 lakh, $250,000. So anyway, you are transacting or you are converting your Indian rupees to a foreign currency within India itself first, and then that foreign currency goes through LRS to your foreign jurisdiction account. So I think the conversion cost and all those things still remains the same. The only benefit is that if you want to hedge against inflation or you want to use that particular money for various products apart from equity, means that's a great stuff which needs to be looked into from this particular notification. And I think that particular conversion cost and all that still remains the same. It depends upon your relationship with the banker of what spread you get while converting this particular Indian INR into the foreign currency through LRS and use that particular foreign currency account for the various purposes. So I don't think so that has too much of an implication as far as the impact cost is concerned. But yes, what one can understand is, since now you can use this money beyond equities or other financial products, so the volume of transactions can move up. The banking sector might benefit also from having the fixed deposits now made through this particular account within the foreign currency denomination. And at the same time, even the insurance companies will benefit. So if you want to buy, say, for example, in life insurance, why not to buy a life insurance which is available in the foreign jurisdiction or the IFSC through this particular account? So I think the benefits would be multifold. How it come up during the course of time is something to be seen, but it's a great move by the RBI to ensure that IFSC stands at par with the foreign jurisdictions, which is the intention of the government to make India also as a financial global hub.
Okay, makes sense. Thank you so much, Mr. Mathur, for joining us and explaining that to us. So you add more products by this move. You'll be able to transact in those products in different aspects as well. So that's how it would impact you and I when it comes to this change which has come in for GIFT IFSC as well. Thank you so much for joining us today. By the way, before we slip into a short break, you have to look at that some of these stocks. Oil India, which is up 11% now. There's been a sudden sharp surge that we are seeing on these stocks. All these production and exploration stocks are doing really well today. Something like an HOEC that is also into oil and gas production. That one is up around 7%. ONGC also has been higher since the start of the day. So watch out for these names. Big moves that we've been seeing, and that continues to be the case as well. We'll slip into a short break. When we come back, we'll get you more on the stocks and market action. Stay tuned.
In leading coverage of the pharmaceutical and healthcare domain, documenting India's expanding expertise in medicines.
25 years of excellence and unparalleled growth.
CNBC-TV18, embarking on a quarter-century of excellence.
Dr. Sunil, one of the statistics say that only 50% of Indians brush twice a day. Do you think that's simply because of a lack of awareness, or do you think it's also a cultural issue where, one of the statistics or reports that I was reading indicated that we just don't feel the need to brush more than once a day?
It's not a question of need. It is absolutely required. It's a mandate that you should brush twice a day. In the morning, to remove everything that has been lying in your mouth while you're sleeping at night, and the acidogenic bacteria that work on it and create harmful acids, etc., and to generate freshness. And in the evening, of course, to remove all food debris and material that may be going to remain in your mouth through the night. You clean it up, you rinse it, and then you go to sleep.
Okay, but what happens if you don't? If you can just explain to us what are the risks of not doing so?
So what happens is there's a buildup of what is known as a biofilm on the teeth, and the biofilm contains bacteria, especially bacteria like strep mutans, which is what causes cavities. So, and of course, gum disease has different bacteria, but there is a whole bacterial biofilm that happens in the teeth. So if you don't remove that biofilm, then the bacteria will remain there and they will act on the gums and of course on the teeth. And so the gum disease and the dental caries both will be a factor.
Welcome back to Mid-Cap Radar. Well, one particular stock that we are focusing on today, this is part of our segment Mid-Cap Spotlight, is a stock or a company that we don't discuss too often. This particular company is called GMR Power and Urban Infra. This particular company is the demerged entity once there was a demerger that took place or a corporate action that took place between GMR Airports and this particular entity. Why are we discussing this particular stock? Well, there's been a very interesting development that the company has intimated to the exchanges. Remember earlier, the company had raised close to $275 million via the FCCB route, and this particular fundraise was done to Kuwait Investment Authority. Now, what has actually happened is that Kuwait Investment Authority, number one, has gone ahead and split this particular fundraise or the FCCB to two separate entities, both of whom entities are lenders who are, as per what the press release says, are eligible lenders. So both of these companies, one entity named as Synergy has FCCBs worth $154 million, and the other entity known as Gram has received $121 million as part of the FCCB. Now, yesterday, what happened is, what has transpired is that both of these lenders have decided that they would like to go ahead and convert the FCCB into equity shares. And along with that, now this is pre-decided terms and conditions for these FCCB. What happens is that they've also gone ahead and decided to waive off the interest cost. So this is positive, number one, as far as GMR Power and Infra is concerned, given the fact that they will see savings as far as the interest payment is concerned. It's also positive for the lenders, given the fact that these FCCBs were issued when the stock price was a lot lot lower. On the back of that, GMR Power, today is up 5%. Even in this particular year, the stock has done very well, up almost 80%, in 2024 itself, and even in the last year has given very handsome returns. So that's why, Sonal, we've been discussing this particular name, not a name we discuss too often.
Yeah, but it's good to discuss when there is some news update, right? GMR Power up around 5%. The other stock on our radar, Raymond, it is trading ex its lifestyle business today. The first leg of demerger has taken place, and that's why you could see that sharp fall in the stock price. It's not a fall, but the stock trading ex that particular business. Upasna is here with more details on this one. Upasna.
Thanks so much for that. Well, the stock is currently trading around 2,000 per share, which is down about 36% as compared to the previous day closing price. Now, what has exactly happened? The company has undergone its first leg of demerger, as today marks as the record day for the demerger of the lifestyle business. The current traded value of Raymond Limited excludes the lifestyle business, and by the end of August and early September 2024, the shares of lifestyle business are expected to be listed separately as Raymond Lifestyle Limited. The existing shareholders of Raymond would be offered 4 shares of Raymond Lifestyle for every 5 shares of Raymond Limited held. The announcement of demerger of the real estate business is expected to take 12 to 15 months to fructify, and by the end of 12 to 15 months, there will be 3 separate Raymond entities listed on the exchanges, namely Raymond Engineering Business, Raymond Lifestyle Business, and Raymond Real Estate Limited. Well, hence, that's the reason Raymond will be in focus today on the back of this corporate action.
Thanks so much for that, Upasna. It's been a sharp move, and this particular stock too has done quite well as far as the movement is concerned. But that's all the time we have on this edition of Mid Cap Radar Mutual Fund Corner. When we return.
So it's extremely important, especially at night, because when you've just eaten and then you go to sleep and it has time to act.
Is it more of a rural problem? Is it also as prevalent in the urban population?
So I would assume, looking at the stats, that the rural problem would be slightly more, because also availability of toothbrushes, toothpastes, and other oral health aids is much less than in the urban areas. But awareness, and as Sunil said, awareness and knowledge has to be imparted so that people will be more, able to do what they have to do.
I think it is not euphoria. It is like a stampede in the market. Even here in Ahmedabad, whoever I am meeting who is not at all related to stock market and from different walk of life, different field, business-wise, career-wise, and everybody's talking about stock market only, that they want to trade, they want to make quick money, and they want to break their FD, and they want to. Somebody was telling me yesterday only that he's working in some IT firm and all, and he want to quit and again join stock market and all. So I think that this situation is not. Personally, I may be wrong because I have been proven wrong many times in the past. But I think this will not end well. So SEBI should take very strict action to curb this kind of frenzy in the market or stampede in the market. Now the pricing power is coming with all these telecom service providers, like Jio has already increased the rates, and Bharti also has followed the suit. And same is with Vodafone. Numbers 15 players has shrunk down to only 3 players, and BSNL is 25% players, so 3.5 or whatever you call it. So, and one thing is for sure. Earlier we used to talk about in India, roti, kapda or makan. So now this is roti, kapda, makan or mobile. As I always say that when my driver keeps 2 mobile, I keep only 1 mobile, but my driver keeps 2 mobile. So how can you go wrong in all these things in this telecom? I think now since they have started increasing the rate, and so I think best time is ahead of them.
What are the tests that women need to probably undertake when they're approaching perimenopause? Physical as well as maybe blood tests, what would you recommend?
See, blood tests in general, like with the whole body checkup, a lot of people, especially
Hello and welcome to MF Corner. I'm Sonal Bhutra in the Mumbai studio. Today we'll decode what investors should be looking at if they're looking at business cycle funds. Remember, the sectoral funds, they've seen a big surge in terms of inflows. We want to understand the pros and cons of it. Business cycle funds would be a subset here, the returns and more as well. Joining me today is Bhavesh Jain, co-head Hybrid and Solutions, Edelweiss Mutual Fund, and Prableen Bajpai, founder of FinFix Research and Analytics. Bhavesh and Prableen, good afternoon. Thank you so much for joining us today. We're talking about this topic at a time when sectoral, thematic funds, factor-based investing, all of it are the buzzwords as well, right? So, Prableen, let me start with you. Let's talk about the basics first. Can you help us understand what exactly is a business cycle?
Good afternoon, Sonal. Great to be on your show. And I absolutely agree with you. With the huge inflows coming into the thematic and sectoral space, it's exciting as well as scary at the same time. Coming to what a business cycle is, so it's at different layers, basically, Sonal. And it starts with the economy. So an economic cycle or a business cycle has its different phases, where we see the growth of an economy through different phases of expansion, contraction, recession, and so on. And the same thing percolates down to different sectors as well. So, during different phases of an economy, there will be different sectors which behave differently. And then they have their own growth journey through these phases of expansion, peak and contraction and a trough. So a business cycle is essentially this movement, this cyclical pattern which happens in all economies, be it global, be it domestic, all the different sectors. And even companies, they go through this, and the essence of this category is broadly to capture on the information. The fund manager knows what phase are we in an economy, how different sectors are going to perform, what is the phase that a specific sector is in, and of course they don't move in the same pattern at the same time. So let's say if a particular sector is going through an expansion, there may be a peak in the other sector, and this is what is put together, and that is what the business cycle funds are actually trying to capitalize on.
Okay, so does that mean they can change the sectors according to the business cycle? How does that exactly work there, Prableen?
Yes, absolutely, Sonal. So I'll call the business cycle, it's like the flexi caps of the thematic space. Just like a flexi cap fund can move across large caps, small caps, and mid caps. Of course, a business cycle fund will have the flexibility to move across the market caps, but a sectoral fund or a thematic fund has some sort of a commitment to a specific sector. Sectors are, a smaller component. It's a narrow theme. Then we have these regular thematic funds where, let's say, if we are talking about banking and financial services, it's still restrictive. But the business cycle fund is like the flexi cap of these categories. So it has the, mandate to move across different sectors depending on where the fund manager sees the potential. So I would say it's a diversified version of, the sectoral and the thematic category. And I think that is why, we are seeing more and more inflows coming in, Sonal, into this specific segment as well. And I think it's a slightly lower risk version as well as compared to a pure thematic or a sectoral fund.
Okay, all right. We'll discuss about what's happening right now in just a bit as well. And I would like to get Bhavesh into the conversation as well. Bhavesh, there's an Edelweiss business cycle fund. I just want to understand from a fund manager's perspective, is it the right time to launch a business cycle fund? Don't you think we're already at the peak of the cycle for many of the sectors, even if you want to choose one? What's your take here?
Thanks, Sonal. Good afternoon, everyone. Yes, if you will see, as Prableen rightly said, a business cycle fund try to first take that macro call and then select which sectors will move, and then finally comes to stock. But that is one way of looking at business cycle fund. At Edelweiss, as you all know, we are always known for launching, you can say, products which are having similar name, but actually are quite different from what 90% of the industry is doing. So as you rightly said, today when markets are at lifetime high, a lot of sectors are already going through the roof. That question mark will always arise whether this is a good time or not a good time. But for that, first you have to understand that we are launching a business cycle fund which is totally different, where neither we are trying to predict any macro cycles, neither we are trying to predict which sector will do well and whether any particular sector is still cheap or still attractive and all that stuff. We are just going on the other way around. First, we are selecting stock. and then effectively that will get converted into sectors, and then it will become a macro call. So ours will be a bottoms-up approach compared to a top-down approach, which is being followed by, you can say, almost 90% of the funds in the industry. So here we are, you can say, more dependent on factor-based investing, wherein we are, you can say, giving more emphasis to factors like growth, value, quality. But along with that, we are also focusing on momentum. So we think that momentum will help us to navigate from one sector to another sector, and thereby overall, if you will see, it will reduce our volatility compared to the benchmark, and it will help us to generate a decent alpha compared to the benchmark. So we are totally into a different way of managing a business cycle fund compared to any other fund in the industry.
Okay, just a follow-up on what you just said, Bhavesh, since you're saying you are following the bottom-up approach here, then can we say in this kind of a fund, it is not like any sectoral funds because it would not focus on a particular theme and it would not focus on a particular sector? Is that a fair assumption?
Yes, perfectly, you can say you rightly got it. See, right now, the biggest problem with any sectoral fund is entry is very easy. As we are saying, you can say not only flurry, even a tsunami of NFOs on sectoral fund. Entry is very easy. Today, someone is launching, say, a defense fund, or say, for that matter, an energy fund or a tourism fund. You can enter into that particular sector. But what about exit? Neither a manufacturer like MF will give you an exit call, neither the client himself will take an exit call because of taxation, and similar problem with distributors also. So exit has always been a challenge, and we have seen enough data is there. If you stay invested in a sector for a long period of time, chances are you may end up underperforming any benchmark also. So sector allocation or sector fund are purely tactical in nature, and that's why entry and exit both are equally important, and that is where our business cycle funds come handy. Right now, we don't know which sector will perform future, and that's why we keep on navigating from one sector to other as and when momentum will help us to navigate, looking at other factors like growth, quality, and value also.
Okay, I get that point. And considering the kind of inflows we've seen, it's also time to be a little cautious, right? Prableen, your take here. First up, are there any advantages of a business cycle fund according to you? Why is it good to have a fund like this on your portfolio? And at this time, do you think it's the right time to look at this category?
So Sonal, the first part, we are actually seeing that investors are loving the sectoral funds. And of course, that is because of the phenomenal growth that we've seen and the returns which are there on the, already what we've seen in the last 1 year or 2 years. And with 55% of inflows coming into the thematic and sectoral space, out of the total net inflows in the last month, it definitely shows that people want to invest in different themes. And that is because, they are probably trying to move away from the general products that we have, which is the regular large, mid, and small caps. Now, having said that, like Bhavesh mentioned, it's really most of the times what happens is that when investors are entering a sectoral fund, the sector is already peaked, or they've seen the performance, and that is when they invest. And of course, then exiting, or it's if there is a correction, it's a hard fall for them. So I think where the business cycle category or these funds can fit in, I think it's a better way to take exposure to different sectors where, so like a diversified fund will also take exposure to different sectors, but a business cycle fund can take more aggressive calls. For example, there were funds in the business cycle category which had, up to 40% in metals as well. They have, they can have a higher concentration to specific sectors which they feel would continue to perform. So for investors who are looking at multiple sectoral funds in their portfolios and are really not sure, they are just looking at returns and kind of adding those funds to their portfolio, probably business cycle fund offers a solution. It definitely diversifies their exposure within different sectors, but doesn't dilute it too much. They are still concentrated portfolios, and then the fund managers there to look at the economic cycle and what is good in terms of exposure. At the same time, given the current market levels, I think investors need to do their recalculations in terms of whether this category would add value in their portfolio, if they're already placed well in all the other categories of, the diversified categories like the large, mid, and small, or the flexi cap funds, then definitely. But Sonal, having a long-term view is important. And what we've seen in the past, the returns can't be replicated. So it can be an addition for investors who are looking at slightly aggressive bets and are not able to decide, which sector to add, which theme. So at the top is the sectoral funds most concentrated. Then within the sectoral thematic, like I said, are the themes, and then comes the business cycle. So it's a more moderate way to add and take a sectoral exposure.
Okay, take that point. Taking it forward, Bhavesh, this category has seen a pickup since 2021. You helpfully provided us data as well there. At that time, we saw lower valuations, but some trends are still picking up, be it new energy, be it segments of markets which are still seeing valuation comfort, reasonable levels. So are these fundamentals still relevant? What would the constituents of your business cycle fund be in that case?
So if you ask me, our business cycle fund will be more like a balance advantage fund, where in balance advantage fund, a model helps you to dynamically move from equity to debt and debt to equity, because we have always seen that human biasness is not able to take those right decisions which a model driven thing could take. And that's why when it comes to Edelweiss business cycle fund, it is purely a model driven business cycle fund, wherein the model will help us to move from growth to quality to value along with momentum. And this movement of, you can say, sector is more in a rule-based environment. So the biggest problem which we face today is whether valuations are expensive or not, whether we will see a correction or not. If we think from, you can say, purely from, you can say, traditional approach, we will not able to buy a lot of stocks at today's valuation. But when it comes to a model-driven approach, I think this emotional biasness and our belief that market cannot go beyond a particular level are taken care of, and the model itself will help you to navigate from one sector to other. We have seen historically, the biggest fear today is if market corrects from tomorrow, and if the correction is there, all the sectors, all the funds will correct. But when we did backtesting for our business cycle fund over the last 12 years, we have seen 10% plus correction in Nifty 500 TRI index. And when we compared our model-driven portfolio backtested performance in those 9 falls of 10% plus, I think our fall was not different from what index was doing. In fact, we were, you can say, in the range of plus or minus 2% of index fall in all the 9 falls. So if market corrects, all your fund will go down. Along with that, business cycle fund will also go down. But we don't know when market will correct. We have seen historically from last 1 year, a lot of funds in small cap stop taking, you can say, inflows. And that period, small cap index from around 11,000, today is at 19,000. At 11,000 also, we were worried that tomorrow there can be a fall. And at 19,000, we are equally worried that tomorrow there can be a fall. So that's why we don't want to predict. We don't want to, you can say, in a way, try to, you can say, forecast that what will happen in next 3 months, next 6 months, next 1 year, because we have seen individual expert of their, you can say, individual fields are not able to predict what will happen in next 3 months to 6 months. And that's why we also don't want to get into that business of prediction. And we will stick to historical data. That's why we will look at growth score, we will look at value score, we will look at momentum score, all which is dependent on historical data rather than preempting or predicting anything in future. So a rule-based approach will help us to, you can say, bear this volatility as and when it will come. When we look at our backtested performance, again, historical data, Nifty 500 TRI, which is the benchmark for this category, has a standard deviation, or you can say volatility of around 16.5%, whereas our portfolio has a volatility of around 15.5%. If you look at beta of our portfolio, it is again 0.82. So we are taking much lower volatility, much better, you can say, protection on downside, much lower drawdown, and are able to outperform the markets. Then anyways, as I told you, this is not a product for a 6-month or a 1-year investment duration. It is a sectoral fund end of day, and we are trying to move from one sector to other. So ideally, the invest period is minimum 3 year to 5 year. And even in short term, there can be correction, there can be, you can say, pause, there can be some falls or some time correction. But if you take a 5-year view, we don't think that markets are extremely expensive with the 5-year view. In you can say that is the ideal period what we are thinking that one investor should look at when it is looking at any sectoral fund or any business cycle fund.
take that point. It's just the worry is that some of the retail investors, the majority of them who came during COVID, are not looking at those longer term periods. The immediate gain, that theory has gained a lot of popularity, and that's causing the worry that, the experts or anyone has with sectoral funds. We take that point, but we have to get into a quick break. On the other side, we'll continue our discussion with our guests on business cycle funds and more. Stay tuned.
Will have this blood pressure, diabetes, and all those will be first diagnosed in a blood test. And the symptoms appear very much later. Then if there's a lipid profile is changing, so they can be started on statins now, so that the cholesterol does not collect on their arteries, and then they have lesser chances of heart issues later on. Then the bone density is very important, because a lot of times the density decreases. It's like a pillar without the concrete inside. So old ladies, especially if they're very frail, if they just fall in the toilet also, the bones break like twigs. That's because the bone depletion. So they will have to get this calcium and iron, or maybe start calcium at 35 years of age and continue for a long time. And then those specific to gynae is, like I told you, mammography or ultrasound. If they're younger than 40, it should be ultrasound of the breast. Or sometimes on the mammography, what happens is they say that the breast tissue is very dense and they cannot see it. Then we have to send them for ultrasound breast. Then the internal examination by the gynecologist. The pap smear, a better form of pap smear is LBC, liquid-based cytology, and HPV vaccination. That has testing and an ultrasound lower abdomen.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest running show on startups and entrepreneurs.
Welcome back. You're still tuned into MF Corner. We have with us Bhavesh Jain, co-head Hybrid and Solutions, Edelweiss MF, and Prableen Bajpai, founder of Finfix Research and Analytics. And we are continuing our conversation on business cycle funds. Bhavesh, let me come to you. You did speak about there can be ups and downs. But overall, does this category always outperform? There must have been instances of underperformances as well. Can you explain what should an investor be aware of when it comes to cyclicality in this particular category?
Yes, finally, business cycle funds are trying to, move from one sector to other through a model. Now, if there is no trend in any market, or handful stocks are, driving the entire rally in the market, like we have seen in 2018, where 5 or 6 stocks were positive and the entire market was negative. So you will underperform in those kind of environment. Similarly, 2022, where there was no clear leadership, every 3 months, every 6 months, we kept on saying sectors were rotating very aggressively. So there was no big trend in market. Even in that kind of environment, this fund tend to underperform Nifty 500 TRI. But if you will see, underperformance in those years is quite manageable. It is in the range of 2 to 3%. But in the years where we are seeing big trend in market, like what we have seen in last 1 year in capital goods, before that during COVID in pharma and IT, if you are able to identify the right cycle or a right sector at the right point of time, I think there are enough ways to generate reasonable alpha. What we always say is, rather than looking at point-to-point return, you should always look at rolling return. And whenever we look at rolling 3-year and rolling 5-year return of, the back-tested model, it has been able to outperform Nifty 500 TRI anywhere between 5 to 7%. And as I told you, it is almost 95 to 100% of the time that the model is outperforming the benchmark. If you see, finally, it is an equity product. If there is a prolonged bear market like 2008, 2011, or a COVID fall like 2020, when we did again the same similar backtesting, we have seen in a fall of COVID, when the broader markets were down almost 38, 39%. This fund, the model portfolio, would have been down by close to 33%. So the beauty of a factor-based investing or a model-driven portfolio is you can actually go back in time and test your model at that point of time, and you can say generate that NAV series, and you can test what would have been your performance in bull market, bear market, sideways market. And I think in most of the market scenarios, a model-driven approach is able to outperform most of the other categories in the market. When though the name of the fund is business cycle fund, we have also compared our performance with other flexi cap funds in the market or other large and mid cap fund in the market, because our construct also is 50% into large cap and 50% into mid cap. So we have compared with large and mid cap index and large and mid cap, you can say, actively managed fund also. So the results have been quite positive, and then most of the time period we have seen with almost similar amount of volatility what a normal you can say a diversified fund would have. With similar volatility, we are able to, you can say, generate decent alpha, because as I told you, the entire you can say the model is driven through momentum, and that has been doing extremely well for last almost 10 to 12 years, and that is, you can say, our secret source of success.
Okay, I take that point. Prableen, would you say such funds, first-time investors should go for it? How much should it be as a percentage of your overall portfolio if you're starting out or you've been in the markets for some time now?
I believe, Sonal, that it is not a category which is for first-time investors. I think it's better to start with the regular funds which are there, for example, the flexi cap funds or the large cap funds which are available to investors, create their core. Although business cycle, like I said, it is like having a flexi cap in your portfolio, but with more concentrated bets. So, it can be an addition and it can eventually be part of your core portfolio as well. But I don't think, it's the right fund to start off with. Eventually, yes. But I would also say that for funds, for investors who are having a lot of actively managed funds in their portfolios, and for example, the flexi cap and the large cap funds, they'll also have to, see the overlap with any business cycle fund, because as a fund house, I'm sure even in their other funds, the strategies, they are looking at sectors which have the potential to grow in future. So somewhere there may be an overlap. So I think it can be a good combination with passive funds in your portfolio. So I think in an active and passive combination, I think a business cycle can be added. And I think what they need to be careful about is that there will be periods of lag in even such funds. I mean, theoretically, all these categories look great, but I don't think that any sort of rewards can be possible without some sort of pain. And there will be periods of lag. There is high concentration to specific sectors. And of course, your predictions can go wrong in terms of which sectors or, stocks would do well, even in a business cycle fund. So I think if investors are aware about all of that, then definitely to begin with, I don't think this is the fund for people who have been in the markets. Yes, maybe, start off, you can have an SIP or you can have a staggered approach in this fund. And for investors who are, seasoned, can definitely take higher bets as well.
Okay, we get that point. Thank you so much for joining us, Bhavesh and Prableen, for explaining to us, Bhavesh, about the Edelweiss Mutual Fund, Business Cycle Fund, how it is constituted, and Prableen, for your take on the entire category as well. It was a pleasure speaking to the two of you. Okay, with that, we'll take your leave on the show with some data on your screen as well. It'll give you a sense of what the returns have looked like for some of these sectoral funds or business cycle funds. Remember, this category has just picked up in the last 5 years, so we wouldn't have data for a longer time frame. But Tata Mutual Fund around 21%, Mahindra Manulife around 28%, the other names, and the returns will come a few on the screen as well. HSBC MC has been anywhere between 26 to 25%, but for 1 year period it was around 49%. But again, as investors and experts have been talking about it, this is a theme, or sectoral funds, they have been receiving a lot of money, but a lot of them are at their peak in terms of valuations as well. So some sort of caution is advised in this sector. But with that, we'll take your leave on this edition of MF Corner today. Stay tuned for Closing Bell to take you through the last hour of trade.
Celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21. Only on CNBC-TV18 and CNBCTV18.com. CNBC-TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhan.
India Business Hour live on YouTube at CNBC-TV18 weeknights at 7 p.m.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go. Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC-TV18, now streaming live 24/7 on YouTube.
The Indian markets have not just grown, they've broken several records in the last 25 years.
India's contribution to incremental global GDP was as low as 0.2% 25 years ago.
Over the last 25 years, CNBC-TV18 has closely followed the remarkable ascent of India's pharmaceutical sector.
There was a time 25 years back that it was all about the FIIs. If FIIs would buy, markets would rally. If FIIs would sell, market would fall.
Earlier, we were net importers of steel.
From IT services to SaaS, from consumer electronics to space.
Good afternoon. You're with us on Closing Bell. But before we get you more on the market action, let's straight away head across to the CNBC-TV18 Budget Town Hall, where, of course, Shireen is there with a whole host of industry experts. Over to you.
Corporate India feeling about demand, about growth?
So I think the mood is quite positive. It's optimistic, and that's reflected also in the CEO's internal surveys that we do on business confidence. It's in fact significantly higher than what it was the same period last year. So the outlook on growth, on investments and jobs is certainly positive. And it's also, you know, the performance of the economy last year and high frequency indicators are also reflective of this trend. And of course, as you know, that nation building or economic development is always a journey. So there are lots of positives today. And the model of growth of inclusive growth, which is investment-led, empowerment-led, has, I think, certainly been validated. And I think that journey should continue because economic development is always a journey. And of course, there are additional areas that would need to be addressed as we go forward. You know, overall, very optimistic, I would say.
Very optimistic is the mood at this point in time, but specifically as far as consumption is concerned, and I link this to the rural economy as well, Mr. Puri. What's the sense that you get on consumption? I mean, FMCG volume growth, for instance, has not kept pace with the kind of GDP, headline GDP number that we've seen, and that has raised questions on why we're seeing this divergence or dissonance. How do you read that?
No. That is true. As I said, you know, there are still areas to be addressed. And we have to also, when we come to consumption, I think it's also important to step back and look at it from a global perspective. Consequent to COVID, we have seen the cost table, and a lot of it because of external factors has actually gone up. And because of that, there is a challenge on consumption across the world. In many economies, including proximal economies, you will find that it has shrunk and not even come back to pre-COVID levels. In India, well, we are comparatively better off. We are not what we would like it to be, but we are better off. And we are now questioning the rate of growth. The rate of growth is muted. That's the question in our minds. And you're right, that is the reality. So what are the ways to attend to this? I think first of all, as far as rural is concerned, given that cost of everything has gone up, what CII is recommending is that the amounts through direct benefit transfer, the amounts through Manrega and income tax at the lower end, so below 20 lakhs, there should be some relief in, and all the other areas should be increased. As far as infra spends are concerned, we are also talking about, putting greater indexation to spends in the rural area. Then, of course, to solve the rural angle on a more sustainable basis, the issues of both agriculture and empowerment of rural economy through skilling, etc. Which skilling, of course, is a joint responsibility that industry also has a role to play there. I think that has to be addressed. And as far as agriculture is concerned, I think a lot of policies of collectives, technologies, clusters, they're all the right tools. We have to scale this up and very aggressively start working on building resilience, because the biggest culprit at this moment in the recent past on rural incomes has been the weather events, which are of course favorable now. So hopefully it should get much better going forward.
And we're hoping that the monsoon deficit will be bridged. But before I get Sanjeev Bajaj into the conversation, a quick headline number from you. What if you expect that volume growth will pick up? What could the industry-wide, FMCG industry-wide volume growth, average volume growth be in the second half of the year?
No, that's difficult. That's difficult to answer.
That's why I said industry, not pinning you down to ITC.
No, even for the industry to put a number is very difficult. But we do expect that with the monsoons being better and the cumulative impact of all the investments that are already happening in the economy. See, private investment is also happening. Jobs are getting created. Public capex is happening, though during the the election period there's been a little lull, but it's picking up again. So all of this cumulative impact will boost consumption. It will definitely go up, but very difficult to forecast.
Numbers. Sanjeev, let me come to you now as far as growth and demand is concerned. The regulator, the RBI, certainly seems to be concerned about unsecured loans and unsecured lending, and we've seen several measures coming in from the regulator on the back of that. How are you seeing the landscape at this point in time, both in terms of what's happening with credit offtake, and perhaps do you believe that the industry is prepared for more regulatory action?
So the first point is, when you look at non-food bank credit, we are about 16-17%. So that is gradually growing, and that's a positive. Where it comes to small value unsecured loans, we saw a significant growth in this in the last couple of years. And I believe that the RBI has taken the right steps in trying to control that. I believe that associated with it, we've also seen in the F&O market significant increase in small value transactions in the last couple of years, which means part of this money could be used for speculative purposes, and that does not help anybody in the short to medium term. So some of these checks and controls are required, but at the same time, the regulators, we know, have an equal role to support growth as well. Let's hope for a good monsoon. We are starting to see better growth in rural India, at least in our businesses, compared to the last 4 or 5 quarters. The last quarter has been better. But yes, we need to get this cycle of growth, of private capex, of demand and jobs to move to the next level of acceleration.
Any concerns around, what we are seeing, for instance, as far as MFIs are concerned, concerns building around NPAs, around delinquencies, any concerns that NBFCs at this point in time are seeing? Any signs?
At an MFI level, well, our own presence is negligible there, but I don't see or hear of a sector level issue. If it's an individual company issue, it could be.
Okay, so your big expectation from the budget, I know there's a long wish list that's been sent in to the finance minister, but if I were to ask you to taper that down to the top 3, what would those be?
The first, very clearly as India, we are in a position where we have a significant chance over the next 5-10 years to partake in a larger part of the global economy. Our last 5 years have seen the early benefits of schemes like the PLI scheme. There have been some mistakes along the way also which need to be corrected. I hope we see a version 2 of that, and while we know the budget is for the year, but I hope there's a direction for the next 5 years. What industry needs is a clear glide path of what to expect over, say, the next 5, even 10 years, so that they can invest with confidence. Second, around jobs, having jobs and skilling. We were just talking to somebody over lunch, and you can't get people because most people have gone home, and how do you get them back? I think this is another big challenge for industry. Third is around skilling. And I know the government is doing a lot as private sector.
Gone home, meaning gone home for what reason? On account of the elections, or?
Gone home for elections, gone home because...
Or do they not feel, I mean, there is enough opportunity back home and hence they don't feel the need to be here?
So, you know, post-COVID, what has happened is partly the additional amount of money that came into their hands when they needed it at that time, going back and living in those means, we believe that a lot of people have just got used to that. And bringing them back into the city is taking a disproportionate effort. But that needs to be done. How can the government support industry for doing that? We also know that very often for industry there's a gap in skilling between what you learn out of college and what's required at work. Now, each of these are areas where work has been done.
Right.
Question is, how do you turbocharge this to the next level?
Okay, so that's interesting. So you're saying schemes like the free food scheme, etc., are now providing enough of a cushion that people are considering staying back in villages as opposed to coming to cities looking for a job. That's an interesting point that you make, Sanjeev Bajaj. But let me get Mr. Mukundan into the conversation as well, because Sanjeev also alluded to the PLI schemes, and we have 13 PLI schemes in operation. As part of the 100-day agenda, we're given to understand that from a manufacturing perspective, the government could perhaps be looking at even additional schemes, new schemes, not PLI, but things like medical device manufacturing, etc. What would industry be hoping for that this budget takes forward?
So, Shireen, I think rather than get into PLI straight away, let me go to the broader issue which you raised. I think I've traveled to almost 15 cities in the last 1 month, part of CII, met the members. There are 4 issues which comes again and again whenever you go. One is the jobs issue, second is the skill issue, which I think Sanjeev alluded to. And then there's an issue which MSME is raising in terms of, that demand and how do we sort of support them. And while that support is there, I think we need to look at the broader environment and say, how do we link it to our trade policy? How do we enable them to serve the world market? I think that 4 key pivots have to be done. Don't just rely on Indian market demand growth, but rely on our connectivity to the world, become part of the global supply chain. And in that, PLI has a big role.
Right.
I think we got to link it to those sectors which are going to be very, very strategic in becoming part of the global supply chain. Put your money there and then enable the MSME to become part of the value chain. It creates jobs. But of course, the skill issue, the government has done a lot in my view. If you look at the new NCVT guidelines, the credit guidelines which have come out, but they had just come out about a month or 2 before. We need to still operationalize them. So a lot more focus in making them operational. And then getting a focus back on the general good, which is basically to say, don't cut back on your public investment, and hold on one issue which I think maybe will serve as at least for the next 2-3 years, this 15% income tax sunset clause. If you can push it back by another couple of years or maybe give it a 5-year push, I think it's going to play extremely well. The external environment is positive today. If you look at the environment in terms of interest rate, they're going to fall. You go look at the, despite all the trouble in the world, energy costs are almost flat. You can't ask for a better environment, but we now need to capitalize and move forward.
Yeah, it's interesting that you talked about that extension as far as the 15% corporate tax rate is concerned for new manufacturing facilities. And of course, this has been part of the wish list that's been sent in. But I do want to address the issue of jobs, because we heard there from Mr. Puri, we heard from Sanjeev Bajaj, and you said it as well, that industry is feeling confident, industry is buoyant, private investment is picking up, capacity utilization, if I take a look at different sectors, is now 80-85%. So where are we going to start to see the jobs coming in from? Are we now on the cusp of significant additional capacity being set up, or is it continued to be across different sectors in different ways, Mr. Mukundan?
See, the jobs is a general issue you hear anyway when you meet people in the community. But when you meet the industry, they talk about skilled workforce. There's a shortage. So what we are saying is there's a mismatch. We need to bridge the mismatch. And the only way we're going to do that is focusing even more on skill building, that the people who need jobs can get the right skills to come and work productively. I think that's the thing we need to solve for. The framework exists, but how do companies take this up more vigorously, as Sanjeev said, is one of the key issues.
Okay, CB, I want to come to you now and address the issue of what you believe the finance minister is likely to take up, or what is likely, what is feasible. And one of the big concerns, or one of the big questions in everybody's mind, is that whether there will be any change as far as the capital gains tax regime is concerned. I know we have a lot of tax experts here in this room as well, but CB, what's industry's expectation? What's industry's view on this? You just have to put the microphone closer to you.
Yeah, thanks, Shireen. No, I think on capital gains, what we have actually said is basically for simplification. There are a number of rates, it's much complex at this point in time. So our suggestion has been mainly around, a recommendation mainly around simplification. But that's as far as capital gains is concerned. But really speaking, our focus has been much on certain areas, which is taking it on from there. There's a lot being done on decriminalization, a lot being done on ease of doing business, but I think there needs to be much more focus on decrim, especially for the small and the mid-sized companies. That's one. Second, we've also talked about something, which is like an ease of doing business, the national single window scheme, say for instance, that really becoming much more of a single window in terms of the states.
When we've talked about this previously as well, over years and years and years. Does it matter whether you have a central level single window? Because at the end of the day, most of your regulatory approvals, your licenses, etc., come at the state level, and a lot of states have actually moved on single window clearances already.
Yeah. A lot of states have moved on single window clearances, but there are a lot more to be done at the state level, and the issue is state level. And so, therefore, a lot of our reforms today are also at the state level, whether it is power, land, labor. So we've also talked about really this budget giving a roadmap. Much of it cannot be in the budget, but even a sort of a signal on how the GST-like collaborations that has happened with the states could be even taken forward in these areas. These mean a lot for when we hear Mukundan talking about jobs. Jobs are really going to come from the mid-size and the small companies, and unless we make it easier for them to operate, we are always going to see that lag. So lastly, I think staying on the jobs, we have suggested something like you talked about PLI, we've talked about an ELI, an employment linked.
And this is not the first time CII suggested an ELI. So you're hoping that this time around the finance minister will take that forward. But I will come back to the ELI question in just a second. But let me go across to Vinayak Chatterjee because Mr. Mukundan also spoke about how, and Sanjeev spoke about the fact that government capex should continue.
Government capex, private capex, tax stability, and perhaps doing something for the Aam Aadmi, for the common man as well. More money in the hands of people, perhaps better and bigger FMCG sales. That and a lot more. That's a big, big event on ground underway, and we'll keep dipping in and we'll keep getting you more snippets. For now, just back to the markets as well, where there's been an interesting recovery on the banking side of the screen. Otherwise, I mean, the first half of the day looked very, very different. But now banks have found some stability. So the best case is we're at least looking at a flat screen. And that's translated into a recovery on the Nifty as well. Pull up the bank Nifty. And that kind of explains what's going on. But otherwise, folks, it's more about the broader markets. Of course, this is Closing Bell. I have Nigel as well as Manglam with me in the studios today.
Well, that's right. From the broader markets, quite a few stocks are moving around. Just to highlight a few of them, NBCC, the stock saw some kind of profit taking the last couple of days. Now it's bucking the trend yet again. But the two stocks, where you're hoping that there will be an avenue of raising cheaper capital or cheaper cost of borrowing, that will be Hudco as well as IRDA. In the last 1 month or so, both those two stocks are up, I think, 25 to around 30% or thereabouts. So you should just pull both those two up. Today, this one's up to around 3%. IRDA, I recall we had a chat with the management at around 200, early 200 odd. Today, the stock is at 275, all this in a matter of 10 days or so. So it's a big uptake that we're seeing. Today, it's up 12%. Pull up a little wider time horizon, you'll see that stock's doing well. And JTL Industries as well. Earlier today we had highlighted that those numbers in a challenging environment look pretty okay. The stock, remember, has seen a sharp correction from the recent peak, but we'll have to keep an eye out on whether or not they can come up with the money in the QIP, as well as converting some of those borrowings that were taken around 270 rupees. So that one for the time being as well is moving to the high point of the day, Manglam.
Yes, Nigel, I'm just looking at the way there has been a recovery on the Nifty Bank in particular, and there were signs for that as well. The biggest reason why, one was seeing some sort of recovery from the lows on the index towards the expiry is because it is the weekly options expiry. Secondly, in a market which was slightly more volatile, we had the India VIX, which was cooling down in today's trading session. In fact, after a big rally in the earlier 3 days of the week, the India VIX is actually down by about 2.5%. And the mid-caps, all through today's trading session, the mid-caps never gave up. The advanced decline ratio the crisscross lines will come up for you. There was no crissing or crossing today. In fact, the mid-cap index is at the high point of trade, and the distance between the green and the red lines was maintained throughout today's trading session, telling you that there was some support at the lower levels as well. So short point, yesterday's low of close to around 24,150 and today's high of close to around 24,400 is the range that everyone's looking at, and in that range we have a bunch of stocks which are doing well. What's interesting about the Nifty Bank, however, is that this entire recovery has been led without HDFC Bank. So if you look at the stocks which are doing well right now for the Nifty Bank as well, we have ICICI Bank, Kotak Bank has recovered, SBI has been doing well, but HDFC Bank still in the red by about 10 rupees.
HDFC Bank, just one quick point here. The stock has nearly corrected 10% from the peak that we saw, when everyone was talking about that MSCI reaching. So clearly, there was a pre-positioning that was seen out there. Explains why the stock, this is today's chart. You just pull up, say, the last 1 week chart. You'll see it went to a high of closer to around 1,800 rupees. And from there, the stock has corrected close to around 10%. The largest weight on the index with 12% weight. That's seen a sharp decline. How do you position yourself, though, in the final hour of trade? We have Mitesh Thakkar, who joins us to tell us exactly that. Hi, Mitesh. Good afternoon and good to see you. What's your view on the Nifty first up? If you buy those dips on a day-to-day basis, you're making money. Should you square it? Because, the next day, again, you're getting that chance to dip. And it seems they were a bit in a bit of a range. So your trade on the Nifty first.
So, Nigel, two things. One, I think, very clearly, while the dips have been bought and we haven't had any continuation of the declines, I think this time, since at least yesterday, after the dip was bought, we didn't see a new high or even the previous high being attempted. So I think I still believe that this is a market which might be more of sideways and trending. It's already had a good rally, and now I think is the time when it will just consolidate for some time. But the level which has been tested again and again is 24,180-200 zone. As long as that doesn't get violated on an hourly closing basis, it should be okay. But in case we go below that, then I think I'll be worried. On the stock side, Sun TV is something which is making a fresh high after consolidation. So buy here with a stop at about 794 and a target of 835. And the other one is Balrampur Chini. I think is trying to break out. This is a conditional buy above 449, 450 with a stop at 442 for targets of 470.
Big move that we're seeing on Sun TV. But, just before we move on, I want your thoughts on two stocks in particular. One is Polycab. Polycab too has been doing extremely well. Now it's, moved higher at the high point of trade, almost 3.5% up move. And Trent is the other one. Trent continues to move higher today as well at the high point of trade. So do you have any view on these two stocks, Mitesh?
Trent is something, which has done very strong up move in the last many weeks, I think many months. In fact, the trend is still continuing. I don't have any view on Trend in the sense that it's done all the targets which we had last was around 4,900, 5,000 levels. So difficult to take a view. I think once we get a consolidation, we might get a fresh entry point. Polycab is trying to reverse after a decline in the last few days. I think it will face that big gap down which happened, on last week, Friday. I think that will be a very strong supply point. So around 6,800, 6,850, I expect this bounce back to peter out and we will see supply emerge again at those levels.
Okay. Got it, Mitesh. Thank you very much for the trades today. We'll come back to you a little later and get some final calls in as well. For the time being, of course, I think we will have Deven join in the next couple of minutes. We'll talk about, of course, the market fundamentals as well. A couple of stocks in focus. Of course, there's going to be all eyes on TCS in the next few hours, probably less than an hour, around 3:30 to 3:45 is when the results are expected. But before we talk TCS, Tata Elxsi flagged off the season on a bit of a cautious note. Now, this is because while there was top-line growth, the margin performance was not up to the market's expectations. We've got Rima with more analysis around this. Rima.
So Tata Elxsi's reported a mixed quarter. The top-line growth at 2.4% sequentially is better than street expectation, though EBIT margins have come down. EBIT margins have declined by 150 basis points, but that's largely because of a one-off. If you strip that out, the adjusted margins are actually up. This time, growth for the company was driven by the transportation vertical. Media was flat, just about 0.5%. Healthcare vertical was under pressure. But the concern for Tata Elxsi is the valuations. Valuations are high at 47-48 times forward multiple. JP Morgan has also cut earnings estimates post the Q1 numbers. They're saying due to higher tax rate as it's coming out of a tax holiday in some of its SEZ units, they have reiterated their underweight call. Morgan Stanley says high ask rates, premium valuation and limited upside triggers keeps them underweight. So the numbers perhaps are not exciting enough to offset the concerns surrounding high valuation.
Right, Rima, thanks a lot for that. Let's welcome Devin to the show as well. Devin Choksi joins us. Thanks a lot, Devin, for joining in. Good afternoon to you. The IT pack, that's going to be in focus ahead of TCS's results today. Then we have HCL Tech tomorrow. Next week, we'll have Infosys. And Tata Elxsi is what Rima just spoke about right now. What are your thoughts and what are your expectations?
Yeah, good afternoon, Mangalam. Well, on the one side, I think the mainframe IT companies are basically wanting to shift their focus largely to the computing side from the coding side. So that's one narrative I think that we would like to see how it gets played out and how exactly this is being spelled out by the respective companies, be it TCS, be it Infosys, and others. Obvious and important it is that this particular computing side of the activity is going to possibly be a long-term game going forward as well, because majority of the corporates are basically, I think, now positioning themselves for Web3 environment. And as a result of which, I think adoption of the computing environment to the cloud is going to be a major reality. On the other side, I think that adopting the newer technologies like AI, I think is a demand which each and every corporation is basically asking for. So all the clients of the likes of Infosys, likes of Tata consultancy services, or many others, I think they definitely, I think, look for their service providers to have these facilities coming up from them. Maybe one would like to also see the change in the business model that many companies will probably start announcing going forward, wherein the platform as a service, I think, which is going to be the new reality in many IT companies' case. So wait and see how exactly these companies spell out. But as of now, as it reads from the company's numbers, maybe I think around 12 to 15% kind of possible growth that one could see, given the kind of large contracts that these companies are winning. Coming to Tata Elxsi, yes, I agree that I think the risk is on the execution, because on one side you have large potential from each of the verticals, likes of transportations, likes of communication media, or for that matter even healthcare. And in each of these verticals, I think probably the execution part is really, I think, challenging, because at times when your customer is not giving you the orders immediately, probably I think that visibility for execution comes in the way. And then comes, I think, the valuation question mark. Because most of the companies, I think in mid-tier IT segment as well, are putting at a significantly high amount of premium, particularly ER&D companies. So to a greater extent, I think if this premium has to get adjusted, then the growth will have to follow. If growth does not follow, then probably I think the premium valuation will have to come down. So this is what the classic case, I think, which is happening with even company like Tata Elxsi. Nothing wrong fundamentally, as I see, but the fact is that I think the valuation re-rating or de-rating is happening at this point.
Got it. Okay, so that's perhaps Tata Elxsi and the expectations from TCS and Infosys and the like. Devin, good afternoon. I want to talk to you about two titans from the BFSI space, and both seeing very interesting reactions from the market. One is this consistent underperformance of HDFC Bank. Even this FPI headroom news, even that couldn't fire up the stock. Maybe that has something to do with the business update, and we'll discuss that. But the other is Bajaj Finance. Bajaj Finance did show a 30% growth once again, but the stock has not, gone back to its earlier glory above 8,000. How do you look at these two, and specifically how the market's reading into the business now?
Yeah. Good afternoon, Sylvie. Well, I think as I see it, I think both these companies remain fundamentally absolutely very well convincing. HDFC Bank on one side probably I think is talking about growing the size of the AUM from 25 lakh crore to 50 lakh crore in a span of around 4.5 years time, which means I'm assuming about 20% kind of a growth, which is significant. And it would not be very surprising either, because given the kind of force that the economy is assuming today in form of implementation of infrastructure, in form of, I think, implementation of Make in India programs for industry, I would think that I think the demand for credit would be on rise, and likes of SBI, likes of HDFC Bank with a larger balance sheet certainly deserves to be, I think, one which will be approached first for the funding purpose. So I guess I think the fundamentals remain intact. What they probably lack at this point of time is a conviction coming out from the fintech adoption, which is not happening in this company's case, which the investor wants to see. Sooner it happens, maybe I think you will see, I think, a different kind of a rating for HDFC Bank, as my understanding is. Coming to Bajaj Finance, 30% plus kind of a CAGR growth in the AUM continues. However, the stock is remaining neglected, despite of, I think, the value proposition that they are offloading in form of Bajaj Housing Finance. Still, I guess, I think this stock is neglected. But why it is so? I think often it happens when the market participants are busy chasing the narrative and giving crazy values, I think, to those companies which are in short supply. That's where I think the most of the monies have channelized at this point of time. And that is why I think they are neglecting some of the quality names like Bajaj Finance. But it cannot continue for long. Maybe soon the wisdom will prevail. And I think you will see the larger part of the money allocation coming to some of the quality names, I think, which we are talking about.
All right, Devin, thank you so much for joining in, giving us your view on the IT stocks as well as the banking pack right now. That covers a large part of the market itself. So we'll leave it at that, but not before the news that the Nifty banks actually moved into the green. The Nifty bank is now up 100 points and a lot more from the lows of today's trading session, almost 600 points from today's low. And it's been led by Kotak Mahindra Bank. Kotak Mahindra Bank has actually moved to the high point of trade. No other large Nifty bank stock has actually moved into the high point of trade. A lot of them have seen recoveries from lows, but this is the one which is actually leading from the front right now. What we'll do is take a short break, a quick break, but before that, an important programming note. Will the RBI cut rates this year? Is the RBI worried about a bubble in the stock market? Is India poised for a GDP upgrade? All those questions answered later in the day. A mega CNBC TV18 exclusive. The definitive RBI Governor Interview. Only on India's most watched business news channel, CNBC TV18. Stay tuned.
Now the pricing power is coming with all these telecom service providers like Jio has already increased the rates, and Bharti also has followed the suit. And same is with Vodafone. Numbers 15 players has shrunk down to only 3 players, and BSNL is 25% players, so 3.5 or whatever you call it. So, and one thing is the for sure. Now, earlier we used to talk about, in India, roti, kapda or makan. So now this is roti, kapda, makan or mobile. As I always say that when my driver keeps 2 mobile, I keep only 1 mobile, but my driver keeps 2 mobile. So how can you go wrong in all these things in this telecom? I think now since they have started increasing the rate, and so I think best time is ahead of them.
What are the tests that women need to probably undertake when they are approaching perimenopause, physical as well as maybe blood tests? What would you recommend?
See, blood tests in general, like with the whole body checkup, a lot of people, especially if they got a family history, will have this blood pressure, diabetes, and all those will be first diagnosed in a blood test. And the symptoms appear very much later. Then if there's a lipid profile is changing, so they can be started on statins now, so that the cholesterol does not collect on their arteries, and then they have lesser chances of heart issues later on. Then the bone density is very important, because a lot of times the density decreases. It's like a pillar without the concrete inside. So
well, let's get straight then to an exclusive. Sources are telling CNBC TV18 that Vedanta is likely to launch a QIP soon. Sudarshan joins us to fill us in with more details. Well, Sudarshan, it's going to be an interesting one, right? Mr. Agarwal has been negotiating with bankers for the last, I think, 12 months or so. Now he's saying, I don't need you all. Look at the stock price. Let's take advantage of it. Let's do a QIP. Go ahead, fill us in with details.
That's right. So in the last two sessions, if you see, Vedanta's stocks has fallen almost 5%. Now we understand from our sources that Vedanta is looking to launch its QIP, and it's going to be of rupees 8,000 crore, or say $1 billion. Remember, on June 21, Vedanta's shareholders had approved fundraising for up to rupees 8,500 crore. And earlier to that, in the month of May, Vedanta's board had given go-ahead for the fundraising via equity issuance or via other financial instruments. Now, with all the approvals in place, we understand that company is in talks with bankers to launch its QIP, and that will be at the earliest, might be in the next few days. Now, if this QIP takes place, this will be an equity dilution for the second time in last 1 month. In June, promoter had sold 2.6% equity via block deals at a price of rupees 427 per share, and since then, stock has jumped almost 9%. And this year, in 2024, stock has risen more than 73%. And Vedanta, in its reply to CNBC-TV18's query, says, as a company policy, it does not comment on market speculation.
All right, Sudarshan, thanks a lot for that. So we will keep an eye out on this development as it progresses. But we have Sudarshan's news piece as well as the company's announcement to that as well. While Sudarshan was talking, the Nifty moved into the green, and that could be entirely attributed to the up move that we've seen in the Nifty Bank. And alongside that, we have seen some traction in the IT pack as well. Ahead of numbers, we have TCS, which has moved higher. LTI Mindtree is the other one that should come up for you, up around 1.5% from the lows itself. So as you can see, a smidge higher for the IT index, a lot more for the other indices as well. And as a result of which, the Nifty, the Sensex, the mid-cap index, which has been doing well already, the Nifty Bank, all of them doing a lot better, currently near the higher end of today's trading range, back in the green for Nifty. Good time to get in Ronak Onkar, the co-fund manager of equity and head of research at PPFAS Mutual Fund. Ronak, always a pleasure speaking with you. The market's been moving higher. It's very interesting because the kind of frenzy that there is in, people chasing ideas, themes. What do you think? What do you make of what is priced in already, and whether there would be any sort of, expectation of fulfillment of those prices?
So interesting phrasing, Mangalam. Expectations are at a fever pitch. I don't think there is enough earnings growth that can materialize to meet all the expectations in all the sectors. But this is a feature of the market. It happens at times when people get overexcited about various sectors and various themes, and they keep discounting the future growth into the near term. And that's when you have to be more careful in terms of not chasing that narrative. And you have to evaluate every situation independently and see whether the growth expectations can be met, or even whether that is the kind of valuation that the business or the sector deserves from a cyclical point of view also.
Hi, Ronak. Good afternoon and good to see you, Ben. Just to confirm, your cash positions, I think they were at around 15%. It continues to hold around there?
Hi, good afternoon. The cash positions are around 16%. They haven't moved materially. But we have accumulated a bit of cash.
But you'll have?
We have a bit of cash, which is more than what it was last.
All right, little higher. Got it. Ronak, suddenly the regulators turn its attention to the markets. Various soundbites are coming that maybe it's time to be quite rational. Don't get too excited with regard to the party. If that is the case, I'm just looking at some of your, what you'll have in your portfolio. It seems some of these stock market plays, you'll have been reducing some stake. If I look at UTI, AMC, Motilal Oswal as well. Tell us more about that.
So with capital market related entities, the intermediaries like stockbrokers, AMCs, they have tremendous operating leverage if you see the business model. When the market goes up, the volumes go up, and the earnings profile of the business also looks dramatically different from a normal market or even a bear market. So you will see them cyclically high in terms of their cash flow generation, their profit generation. And at that point in time, if there can be a reversal in that trend, then you will see the operating leverage working against them. And you will see that the cost will not grow dramatically, but at the same time, the revenue and the profits can fall quite dramatically. So it's better to be cautious when you're looking at cyclicals which are dependent in capital markets, will depend on the valuations of the market. And that's the reason we have been reducing them. They still hold a little bit of position in the portfolio, but we have not completely sold out.
Okay, got it. Just one more thing. There are a few companies, though, that you'll have gone and added some position. ITC, I recall, we had discussed it long time ago. You all were very early in there. But it seems you'll have come back to the addition phase, because on ITC you'll have added positions are there. And the other one that I've seen, on a month-to-month basis, there is a sizable addition is IGL. Both those two, the CGD companies. So tell us more on that front.
From ITC's point of view, the business model remains the same. It is just a valuation that it became a little bit more reasonable for us to add, and we thought it's a good time to a little bit add since we also have cash. And it's been performing well. The numbers speak for themselves. And in terms of IGL, if you look at the overall adoption of the gas as a source of transportation or even piped natural gas at home, it's been a trend which has been growing for a long period of time. And despite the fact that we are looking at EVs coming in, we are looking at commercial vehicles going towards battery-operated vehicles, it might be a trend which will be slow to be adopted rather than going to happen next year or the next 5 years. It's going to be a long-drawn trend. And meanwhile, you will need alternate fuel sources, the traditional fossil fuel sources. So within that, it seemed reasonable to own a company like IGL, which is a good distribution network in Delhi.
Ronak, hi, great to have you on the show. Coincident, just a couple of hours back, I was reading Neil's tweets, and then I realized you're coming on the show, so I think it's perfect timing, right? I think those tweets have caused a fair amount of flutter on Twitter, on X. We'll put them up in just a bit. For the benefit of viewers, I just want to read this out. Neil Parekh, who's of course, the big boss, the head of PPFAS, has just said, wow, the sheer number of NFOs launched, especially thematic funds, is a bit scary. Be careful, guys. Context, yesterday's inflow of 40,000 crores plus saw over 20,000 crores come in from thematic funds, sectoral funds, and a lot of it is NFOs, because that's the only place where mutual fund houses can innovate and launch new products. Everything else is watertight. Neil then goes on to say, we're staying away from excesses, are mindful of starting valuations, and also have some cash. We're happy to underperform in such markets. Not a bad time to slowly redeem if you need money in the next couple of years. So that's a big statement to make, right? And from the head of an AMC, or maybe from his perspective, he can make that statement. How difficult is it for you to execute it? I mean, underperformance, not deploying 16% cash, starting to sell off these high flyers like the capital market related plays. Just give us, your construct, your thought process around this, and throw in a word on some of these areas like, CapEx, PSUs, defense, etc. as well.
So underperformance is a guarantee. It is not something where you can get away by underperformance. And at different points in time, different styles of investing work. What we have been choosing is more of a value-oriented approach where we will not chase valuations. We'll go where the valuations are reasonable and sensible. And if we don't find them to be sensible, we are happy to stay in cash. And as a result of that, we'll underperform temporarily when the market froth is there. So Neil is absolutely right. We're all in sync about this. And we try to caution our investors not to get too carried away with narratives. Even though they might be good themes or the good sectors to invest in, it's also important to get the entry valuation right. You cannot just chase any story without having any substance behind it. So yeah, from that point of view, the valuations, the portfolio allocation remains the same. You mentioned about PSUs, you mentioned about the power infrastructure companies. All these companies are part of the portfolio because the valuations are reasonable. Despite some companies in that sector have seen stratospheric valuations, these companies have not seen that. And these are more reasonably priced, dividend-generating, cash flow-generating companies, which don't change dramatically overnight. So we might miss a few great opportunities to invest, which is fine, as long as we keep the money safe.
All right, which is what brings us back to where we started. Which parts of the market where you think, the valuations have run up much ahead of the earnings that you believe that they can deliver? And what still seems reasonable if you had to, allocate fresh 84 rupees of the 100 that you're getting right now, because 16 you're holding in cash?
And also, if I could just add to that, Ronak, also, what else are you taking profits from apart from capital markets, where you're thinking the party is over, it's time to get out? So tell us both, where you'll deploy, what you'll buy, and where you'll exit.
So Mangalam's second question is easier to answer because we have been adding some of the IT services companies and banks, private sector banks that we own. Wherever valuations are reasonable, we are adding and topping up the existing positions. Nothing new has been added and nothing new has been sold. So we have been only selling the capital market related entities because bulk of the portfolio, even though the prices have gone up, the earnings have also caught up and the valuations are not extreme. So yeah, we constantly keep a look at the valuation. That's our job. And we make sure that we only trim when the valuations look really frothy and unsustainable from a growth point of view.
All right, and I think the two banks that you were, loading up on was HDFC Bank and Kotak Mahindra Bank, right?
Yes.
And HDFC Bank, it appeared that it's getting ready to fly away, but then suddenly it's pulled back a little bit. I think the stock doesn't like too much of excitement. It's down 10% in the last 1 week or so. But we appreciate you joining in, Ronak. Rational thoughts coming in as always. You have upped your positions in ITC as well as in IGL and Maruti. Taken some profits off the table in capital market plays like Motilal Oswal as well as UTI AMC. And you continue to select ITES as well as private banks. Thanks a lot for joining in and filling us in with that quick take. For the time being, though, we'll slip into a short break with news that the Nifty is back in the red. We're down close to around 25 points. We come back. Nimesh is waiting for us on the other side. He'll tell us what he's picking up in Dealing Room Chatter.
They're very frail. If they just fall in the toilet also, the bones break like twigs. That's because the bone depletion. So they will have to get this calcium and iron, or maybe start calcium at 35 years of age and continue for a long time. And then those specific to gynae is, like I told you, mammography or ultrasound. If they are younger than 40, it should be ultrasound of the breast. Or sometimes on the mammography, what happens is they say that the breast tissue is very dense and they cannot see it. Then we have to send them for ultrasound breast. Then the internal examination by the gynecologist. The pap smear, a better form of pap smear is LBC, liquid-based cytology, and HPV vaccination. That has testing and an ultrasound lower abdomen.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest-running show on startups and entrepreneurship, celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21, only on CNBC-TV18 and CNBCTV18.com. CNBC-TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros, and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhan.
India Business Hour live on YouTube at CNBC-TV18 weeknights at 7 p.m.
Welcome back. As promised, let's get straight to Nimesh. He's standing by to tell us what is he picking up in D-Street Chatter. Nimesh.
Hi, Nigel. A quiet day of trade, pretty much in a narrow range since the morning trade. And even the flow seems to be quite muted as well. The sector of the day clearly is oil and gas stocks. All the OMCs are buzzing in trade. And we spoke about that yesterday as well, that maybe there is a bit of buying interest back ahead of the big NFO, which is going to close next week from a leading domestic mutual fund. So that could be one of the reasons why we're seeing a big traction in those names today. Apart from that, I guess the TCS earnings tonight would be a big trigger to watch out, not only from an earning perspective, but for the overall IT stocks as well. So that's big number to track. But frankly, it's been a quiet day, so to speak, and even the volumes seems to be slightly muted.
All right, then let's get stock specific, Nimesh, because broader markets, there is a fair amount of activity.
Oh, absolutely, and that's where a lot of broader market mid-cap stocks are buzzing in trade. So the first name is MSTC. After a long time, this stock is coming to my charter list. Big buying interest in that particular name, surprisingly from a leading domestic AIF, and that's the reason why we've seen a big move in that name today. So that's the first name. Second, two stocks where there is delivery-based buying, Grasim and Interglobe Aviation. Both are seeing very strong buy flows at the leading FIDs. So it looks like some bit of institutional interest is back, and so expect high delivery volumes in both these names today. The third stock is Ambuja Cement. Nigel has been highlighting the Nomura note since morning. A big upgrade on that name. They've raised the multiples as well. But interestingly, in Ambuja Cement, I understand a leading long-only fund is an active buyer as well. So there is accumulation happening at these levels from a leading FII. And the last is TVS Motors. There were multiple block deals in today's market, so disclosures would be quite interesting. But I understand potentially a leading FII was a likely buyer in today's block. Also, the company has launched some new bikes as well. So that seems to be exciting the stock. So I guess disclosures would be quite interesting in TVS Motors today.
All right, we take that point. Nimesh, thank you so much as always for joining in with some dealing room insights as well as individual stocks. Speaking about individual stocks, a couple of them actually now spiking. GMR Airports, for instance, a big move is what we've seen on that one, has moved higher. Alongside that, Asian Paints continues to do well. Yesterday, in the second half of trade, the street was excited about the paint stocks because there was an increase of 1% in the economy segment of the paints, telling you that there is demand and it's strong enough. And this morning we had a Macquarie note as well saying that one of the reasons why the companies have gone ahead and increased their prices is also perhaps because they would have sized up what competition had to offer in terms of Birla Opus, and more importantly the reviews so far have been mixed. So interesting disclosures, interesting times ahead for this paint space. As of now, up about 1% at the high point for Asian Paints as well. Good to bring Mitesh back in to tell us the tomorrow trade. Mitesh, what does one buy today for a reverse trade tomorrow or otherwise?
My sense is that I think, the overall market will be sideways. Therefore, we've been consistently suggesting to avoid trading the indices and trading stocks. And on the stock list, I have BTST and Voltas with a stop at 1500. Look for targets of 1540 here. And after a long time, there's signs of some correction happening on the charts of KBB. So we'll take a STVT here with a right stop at 85.20 for targets of 8400.
Okay, all right. Thanks a lot for that, Mitesh. Well, let's focus on Ambuja Cements. Nimesh briefly mentioned that one, so let's get straight to the details then. Nomura, they have gone ahead and they have upgraded the stock. Earlier it was reduced, now they're talking about buy. Earlier the target price was 500, now they're giving it a target price of around 780 rupees. How does this happen? Well, obviously they're more confident on the earnings, and they've also upped the multiple. Earlier they were giving it a multiple of around 14 times. Now they're willing to give a multiple of around 19 times. You'll want the reference of the largest player, which is Ultratech Cement. That trades at a multiple. For that one, they've given a multiple of around 17 times. The reasons, I've divided it into 4 big reasons. Point number 1. Aggressive capacity addition. That's what Nomura is quite excited about. They're saying, including the Penna acquisition, well, the capacity addition is likely to be around 14%, which is much higher than Ultratech as well as for the industry, and they'll be around 106 million tons odd by FY26. The entry into new markets, both these two inorganic growth, whether looking at Penna as well as Sanghi, both of them have limestone, and it gives them that option to go ahead and expand capacity as well. Besides that, the volume growth, even without Penna, they're saying that Ambuja has the capability to do close to around 13% volume growth over the next 3 years. That's FY24 to FY26, and that's better than Ultratech as well as the industry. And finally, cost optimization measures. Whether you're talking about, the management has been talking about synergy benefits, getting a higher amount of domestic coal, even alternative fuel resources. Put all that together, they are penciling in that the operating cost comes down by around 300 rupees per ton. And for the time being, the stock is up close to around 2%. And one more record that Hormuz tells me is that for this month, every month, the stock was higher. Till yesterday, it was down close to around 1%. And now it's maintaining its winning streak. So the 7th month in the row that Ambuja Cements is higher for this particular year.
Okay, all right. That's Ambuja Cements doing well throughout the course of the day today. That's Ambuja reacting to news. Let's get back to earnings, and it's going to be all eyes on TCS very, very soon. We are expecting the results to come out anytime after 3:30, between 3:30 and 4. And the IT bellwether is expected to show decent top-line growth, and perhaps growth that will be better than at least the previous couple of quarters. We have Rima with a heads up.
TCS were expecting a modest improvement in their revenue growth, 1.3% on a quarter-on-quarter basis in dollar terms. Constant currency revenue growth is up 1.5%. Now, typically Q1 is a seasonally strong quarter. There is a ramp up of large deals like BSNL. All that will aid the top line. And revenue growth this time will be better than what we've seen in the last couple of quarters. Margins will come under pressure, down 150 basis points according to our poll, because of the wage hike, and that puts pressure on the company's profitability. So the CNBC-TV18 poll is seen down close to about 3.5–4%. TCV might be low. TCV stands for total contract value. That's the deal wins, and that could be down quarter on quarter compared to Q4's bumper number of over $3 billion due to the absence of large deals. Now, what's the street going to track? They're going to track on the pace of recovery. You know, there is hope that things pick up a little bit at least in the second half of the year and then accelerate in FY26. Is there anything in the management commentary which gives confidence regarding that? You know, I've compiled what the street expects from TCS in FY25 and FY26 in revenues and margins, and that will come up for you. You know, the street is expecting about a 5.5% revenue growth this year, accelerating to 8–9% next year. Margins too are likely to improve this year and in the following year because the employee wage bill has been coming down with the companies hiring less and less and attrition coming under pressure. So the pace of recovery, is there scope for margin improvement over the next 2 years, which the street is hoping for? I think they want evidence of that in this quarter's numbers. Other than that, you will watch for things like hiring, generative AI, the pickup over there, what the pipeline is looking like. And even, you know, if there is any increasing competition coming in from global captive centers.
All right, take that point, Rima. Thanks a lot for that. As we slip into that short break, a couple of stocks doing well. Tata Motors has moved higher. BPCL is the other one, which has now moved to the high point of trade. We had HPCL do well all through today's trading session. The Nifty just above that flat line into the green. Take a short break. More market talk on the other side.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go. Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC-TV18, now streaming live 24/7 on YouTube.
The Indian markets have not just grown, they've broken several records in the last 25 years.
India's contribution to incremental global GDP was as low as 0.2% 25 years ago.
Over the last 25 years, CNBC-TV18 has closely followed the remarkable ascent of India's pharmaceutical sector.
There was a time 25 years back that it was all about the FIIs. If FIIs would buy, markets would rally. If FIIs would sell, market would fall.
Earlier, we were net importers of steel.
From IT services to SaaS, from consumer electronics to space tech, from mere programming to AI ML.
Cars, two-wheelers, three-wheelers, commercial vehicles have significantly become much more.
Welcome back. Well, just about 7 minutes to go before the day closes out, and most of the indices are turning green. So let's see if we do get that green close. Well, today we caught up with Samir, Arora, founder and fund manager at Helios Capital. He spoke quite extensively on expectations from the budget with respect to taxation. Take a look.
Market is up this year 18% or something. So they are not subdued, but obviously this is the budget month.
And last month was a strong month. So it's okay for everybody, including us, to wait. F&O side, the thing is that it looks a bit justifiable, because although the only objection somebody can have is this is my money and how does it matter to you? Why are you restricting an individual if he has the money? But this is how systems and regulations work, that even if it's your money, you are guided. For example, if Singapore residents want to go to the casino, they have to pay an entry fee, which is not there for tourists. So somebody can say, I am living in Singapore, I will pay why do I need to pay, and others don't? In everything you can see in life that it is there, because if it is too blatant, too obscene, too different from the world, and looks very speculative, then a little bit of checks and balances, okay. It doesn't matter that it's your money. Many positions we must have trimmed or added, but in the big picture sense, my net exposure, my long short fund used to be 74-75% going into the polls and exit poll and all that. And I want to reduce it, and I have reduced it quite a bit to in the high 60s.
Okay, keep an eye out on the markets. We're seeing some bit of a pullback from the low point of the day. Explains why now we're up close to around 15 points. The Nifty Bank has done well. Your portfolio is feeling good, I'll tell you, because the mid-cap index, that's doing far better. Amrish Palikal joins us to help us out with a couple of ideas. Amrish, you tell us, which is that one pick that you want to give us today?
Hi, Nigel. That pick is Time Technoplast.
Oh.
It's a prominent global player in polymer goods, although it's a small cap, but then it's a global player. They have operations in US, Southeast Asia, North Africa, UAE, as well as India. Nearly 30 locations and 40 production units. And they manufacture composite cylinders, which are used in CNG, LNG, industrial packaging, automotive components, lifestyle and material handling products. The focus now is on the growth. So they're talking of 15% CAGR, at least over the next 3 to 4 years. And the other focus is a reduction of debt. So basically, they want to become debt-free in the next 2 to 3 years. So my expectation for FY26 is about 24 rupees EPS. And with this, my target is 432.
Okay, so Time Techno is the stock on your radar. Amrish, anything else? I know I can't even ask you for a budget pick, right? Because all these picks have been running for over a year now. But anything else? I mean, there's a lot of chatter about perhaps focus on specific areas, R&D, sunrise sectors like green hydrogen, EV, etc. Any individual names that come to mind?
In fact, a budget pick itself, which is Easy Trip Planners, has been my favorite for a while. I mean, we had one good run. We booked some profits. It's come down now back to the levels at which we had gotten. So again, recommending this with a target of 62. Basically, it's the largest, second largest online platform with more than 2 crore customers. And they've also got into offline now. I mean, they have 61,000 agents. They have started their operations in UAE, UK, and Thailand. As far as the offline is concerned, in Pune, they have got a new store recently, about 12 stores totally in India right now, and that should go up. I think the stock had corrected because of the Q4 earnings, where they had a write-off because of the Go Air dues. But then I'm looking at a CAGR of about 30% over the next 3 to 4 years as far as revenue goes. EBITDA CAGR should be about 24%. And from a budget point of view, I think clearly the focus would be on tourism in India. And that should help this company to a large extent. At the same time, I expect some more cash in the hands of the middle class. And typically, when they have more cash in hand, I think nowadays most of the people plan a trip. So this again should be the other benefit as far as EasyMyTrip is concerned. So buy at these levels of 41.
I think even if, Amrish, even if people don't have additional cash in hand, they still, plan a trip. I think that's where all the financiers also come in. But yeah, exactly. I think Nigel and I planned a trip. I didn't have any cash in hand, but I planned one nonetheless. I don't know about Nigel.
I'm still reeling under pressure. I traveled last month and, credit card bill is hurting me now. But anyway, it's, as my wife says, we're going to create memories. So we created that memory. All right, Amrish, I wanted to ask you about these low P, high free cash flow companies. Some of these names, PSUs in particular as well. I believe there's a new fund that's coming out which maybe could be looking at these. Could you explain why in the last few days you have some of these stocks, Coal India, ONGC, Oil India, all of them are doing quite well. Any of them do you like? All of them actually in this week itself have seen a big up move on good volumes.
Yeah, I mean, it's quite difficult to find stocks which have low P in a market like this with good cash flows. So something like a Coal India, yes, I think it's consolidated well and possibly should move to the next level from here. So, I mean, we could see a move of either at least 60 to 80 rupees from the current levels.
Okay, all right. Amrish, I think we'll have to wrap it up on that note today. Shorter chat, but thanks very much. Always good getting some perspective on these individual picks with you. Well, with that, we are almost out of time. So last 2 minutes to go to close out what's actually turned out to be a good session, because now all the indices are in positive territory for what it's worth, including the Nifty. 24 up on that index, and the recovery has happened because there was some repair job on the banking side of the market. Not all, but I mean, the divergence really helped other names like SBI, like Kotak Mahindra Bank. They've done better, even Axis for that matter. They've done better than HDFC Bank, which is where the problem continues to be. So the screen is green. I'll start with the green side. The big PSU boys, ONGC, Coal India, BPCL, they were the big leaders today. Some good buying on Tata Motors, on ITC, on Asian Paints. Already mentioned the gaining banks. And then actually even Hero MotoCorp was up and about Titans. I guess there's quite a bit of buying on the so-called consumer side of the screen today, going beyond FMCG. The losers, FMCG, Pharma was out of favor today. Most of the names like Divi, Cipla on the lower side, and Tata Consumer down about 2%.
Well, there are hopes of divestment getting into the budget and some talk on that front. SCI locked in upper circuit, 20%. I think midway through the trading session, you couldn't trade it because it was locked. SCI landed assets, well, that was up another 15%. IRDA, valuation-wise expensive. Street seems to suggest that maybe there's a bigger story playing out here. Stock up more than 10%. EIL, how do you justify these valuations? Street believes they can. The stock is up closer around 10%. Gujarat Pipavav up closer around 8%. So quite a few of these names did very, very well. And the reason I'm highlighting these stocks is because they moved up on massive volumes in today's trading session. Just a quick word. I think we should get Gokul Das exports in the last 3 minutes or so. Massive block takes place. More than 40 lakh shares getting traded out there. And I think it was at a price around 950. So we'll have to check out to see who were the buyers on this one, who were the seller, but it's going to be an important one out there. And one stock that's come back to life in this week, which we had highlighted earlier this week as well, is ITC. It's moving from strength to strength, playing catch up with some of its peers, and also valuation-wise, still a little bit palatable.
Absolutely. So those were the winners of the day, and largely a good day for the street. With that, it's curtains on this edition of Closing Bell. Thank you very much for watching. But we have a big budget exclusive lined up for you, the CNBC-TV18 Budget Town Hall coming up next.
They were 2 decades ago.
Discounting is high there, but their focus is squarely on the 125cc segment.
Now it is contributing 16% of incremental global GDP.
Now we're looking at exporting the steel that's made here in India.
Welcome to the first ever India Business Leader Awards.
Cars, two-wheelers and vehicles generally being manufactured today are much lower on emissions and much higher on safety.
India's technology industry has been at the forefront of cutting-edge innovation over the last 25 years.
It's the retail which is the driving force for the market right now.
Clearly, we have arrived on the global economic stage.
Great way to celebrate our own 25th year, with new milestones being achieved on the Lal Street.
21 years of the Nifty from 1,000 to 10,000 today.
Sensex and Nifty hit a record high.
The Nifty rallying to a record high.
We invite you to join us as we persist in leading coverage of the pharmaceutical and healthcare domain documenting India's expanding expertise in medicines.
25 years of excellence and unparalleled growth.
CNBC-TV18, embarking on a quarter-century of excellence.
Dr. Saneen, you know, one of the statistics say that only 50% of Indians brush twice a day. Do you think that's simply because of a lack of awareness? Or do you think it's also a cultural issue where, you know, one of the statistics that or reports that I was reading indicated that we just don't feel the need to brush more than once a day?
It's not.
Hello and welcome to the CNBC-TV18 CII Budget Town Hall. I'm Shireen Bhan, and it is our absolute privilege to be here as part of the CII's National Council meeting. If you just see the scenario behind me, and we've got plenty of cameras here focusing on what is going on. You've got a packed house here, CEOs representing different sectors, different industries here to give us a sense of where things stand as far as the economy is concerned, but more importantly, what they believe the budget will deliver on, what the expectations are from a historic budget, ladies and gentlemen. This is going to be the 7th budget that Finance Minister Nirmala Sitharaman presents, and this will be the first for any finance minister, 7 consecutive budgets of history in the making. Will the budget live up to that expectation or not? As the interim budget showed, and it was a very short 56-minute speech that the Finance Minister delivered, the government intends to continue on the path that has already been set out over the last 2 terms. The question now is, will there be any change in track? Will there be a difference in the government's approach as far as priorities are concerned? Well, it's also interesting and important to note that the government goes into this budget with a very comfortable fiscal position. In fact, the CNBC-TV18 analysis shows that approximately 1 lakh crore rupee cushion, if not higher, is available to the government since the interim budget was presented, on account of the fact that you've got a 2.1 lakh crore rupee dividend bonanza that's coming from the Reserve Bank of India, and you've also seen a significant increase as far as tax collections are concerned, 30,000 crore rupees higher than what was the number as far as the interim budget is concerned. But without further ado, let me go across to Sanjeev Puri, the president of CII. Mr. Puri, before we talk about the budget, let's talk about the mood here at CII. As I pointed out, you've got different sectors being represented here. What is the mood as we go into this budget? How buoyant, how optimistic, how confident is corporate India feeling about demand, about growth?
So I think the mood is quite positive, it's optimistic, and that's reflected also in the CEO's internal surveys that we do on business confidence. It's in fact significantly higher than what it was the same period last year. So the outlook on growth, on investments and jobs is certainly positive. And it's also, you know, the performance of the economy last year and high frequency indicators are also reflective of this trend. And of course, as you know, that nation building or economic development is always a journey. So there are lots of positives today. And the model of growth of inclusive growth, which is investment-led, empowerment-led, has, I think, certainly been validated. And I think that journey should continue, because economic development is always a journey. And of course, there are additional areas that would need to be addressed as we go forward. You know, overall, very optimistic, I would say.
Very optimistic is the mood at this point in time, but specifically as far as consumption is concerned, and I link this to the rural economy as well, Mr. Puri. What's the sense that you get on consumption? I mean, FMCG volume growth, for instance, has not kept pace with the kind of GDP, headline GDP number that we've seen, and that has raised questions on why we're seeing this divergence or dissonance. How do you read that?
No. That is true. As I said, you know, there are still areas to be addressed, and we have to also, when we come to consumption, I think it's also important to step back and look at it from a global perspective. Consequent to COVID, we have seen the cost table, and a lot of it, because of external factors, has actually gone up. And because of that, there is a challenge on consumption across the world. In many economies, including proximal economies, you will find that it has shrunk and not even come back to pre-COVID levels. In India, well, we're comparatively better off We are not what we would like it to be, but
Right.
we are better off. And we are now questioning the rate of growth. The rate of growth is muted. That's the question in our minds. And you're right, that is the reality. So what are the ways to attend to this? I think, first of all, as far as rural is concerned, given that cost of everything has gone up, what CII is recommending is that the amounts through direct benefit transfer, the amounts through Manrega and income tax at the lower end, below 20 lakhs, there should be some relief in, and all the other areas should be increased. As far as infra spends are concerned, we are also talking about, putting greater indexation to spends in the rural area. Then, of course, to solve the rural angle on a more sustainable basis, the issues of both agriculture and empowerment of rural economy through skilling, etc. Which skilling, of course, is a joint responsibility that industry also has a role to play there. I think that has to be addressed. And as far as agriculture is concerned, I think a lot of policies of collectives, technologies, clusters, they're all the right tools. We have to scale this up and very aggressively start working on building resilience, because the biggest culprit at this moment in the recent past on rural incomes has been the weather events, which are of course favorable now. So hopefully it should get much better going forward.
And we're hoping that the monsoon deficit will be bridged. But before I get Sanjeev Bajaj into the conversation, a quick headline number from you. What if you expect that volume growth will pick up? What could the industry-wide, FMCG industry-wide volume growth, average volume growth be in the second half of the year?
No, that's difficult. That's difficult to answer.
That's why I said industry, not pinning you down to ITC.
No, even for the industry to put a number is very difficult. But we do expect that with the monsoons being better and the cumulative impact of all the investments that are already happening in the economy. See, private investment is also happening. Jobs are getting created. Public capex is happening, though during the the election period there's been a little lull, but it's picking up again. So all of this cumulative impact will boost consumption. It will definitely go up, but very difficult to forecast.
A number. Sanjeev, let me come to you now as far as growth and demand is concerned. The regulator, the RBI, certainly seems to be concerned about unsecured loans and unsecured lending, and we've seen several measures coming in from the regulator on the back of that. How are you seeing the landscape at this point in time, both in terms of what's happening with credit offtake, and perhaps do you believe that the industry is prepared for more regulatory action?
So the first point is, when you look at non-food bank credit, we are about 16-17%. So that is gradually growing, and that's a positive. Where it comes to small value unsecured loans, we saw a significant growth in this in the last couple of years. And I believe that the RBI has taken the right steps in trying to control that. I believe that associated with it, we've also seen in the F&O market significant increase in small value transactions in the last couple of years, which means part of this money could be used for speculative purposes, and that does not help anybody in the short to medium term. So some of these checks and controls are required, but at the same time, the regulators, we know, have an equal role to support growth as well. Let's hope for a good monsoon. We are starting to see better growth in rural India, at least in our businesses, compared to the last 4 or 5 quarters. The last quarter has been better. But yes, we need to get this cycle of growth, of private capex, of demand and jobs to move to the next level of acceleration.
Any concerns around, what we are seeing, for instance, as far as MFIs are concerned, concerns building around NPAs, around delinquencies, any concerns that NBFCs at this point in time are seeing? Any signs?
At an MFI level, well, our own presence is negligible there, but I don't see or hear of a sector level issue. If it's an individual company issue, it could be.
Okay, so your big expectation from the budget, I know there's a long wish list that's been sent in to the finance minister, but if I were to ask you to taper that down to the top 3, what would those be?
The first, very clearly as India, we are in a position where we have a significant chance over the next 5-10 years to partake in a larger part of the global economy. Our last 5 years have seen the early benefits of schemes like the PLI scheme. There have been some mistakes along the way also which need to be corrected. I hope we see a version 2 of that, and while we know the budget is for the year, but I hope there's a direction for the next 5 years What industry needs is a clear glide path of what to expect over, say, the next 5, even 10 years, so that they can invest with confidence. Second, around jobs, having jobs and skilling. We were just talking to somebody over lunch, and you can't get people because most people have gone home, and how do you get them back? I think this is another big challenge for industry. Third is around skilling. And I know the government is doing a lot as private sector.
Gone home, meaning gone home for what reason? On account of the elections, or?
Gone home for elections, gone home because...
Or do they not feel, I mean, there is enough opportunity back home and hence they don't feel the need to be here?
So, you know, post-COVID, what has happened is partly the additional amount of money that came into their hands when they needed it at that time.
Hello and welcome to CNBC TV18 Earnings Corner. We are live from the TCS house, the headquarters of Tata Consultancy. They've just reported the first quarter of FY25 and prima facie it appears to be slightly ahead of street expectation. We don't have too many details, but the rupee revenue growth has come in at 2.2% sequentially. EBIT margins have fallen by about 130 basis points on a quarter-on-quarter basis. The street expectations were for a 150 basis points decline. The reason for the margin decline is a wage hike effective 1st of April. So this quarter, there is a full quarter impact of the employee increment. And TCS is one of the few companies which has announced a wage hike. Many of them have actually delayed it to the subsequent quarters. Because of this 135 basis points decline in the EBIT margins on a sequential basis, the company's profitability has taken a dip. Profits have come in at 12,040 crore, a decline of 1.6% on a quarter-on-quarter basis, but again, slightly better than the 3.5–4% that the street was anticipating. The net headcount, the key number that we always wait is the constant currency revenue growth on a quarter-on-quarter and on a year-on-year basis. So we still don't have that number, but the expectation was that there will be a little bit of an acceleration. Last quarter, we had a CC revenue growth or a constant currency revenue growth of 1.1%, but this time the expectation was that it will pick up to 1.5% because Q1 is a seasonally strong quarter. The company is executing on that BSNL deal and also some of the other deals that they had won last year. Last year was a bumper year in terms of deal wins. The company won deal wins in excess of $42 billion. So as they execute that, the revenue will accrue to the company in Q1 of FY25 and onwards. So that's the reason why we were expecting a pickup in revenue growth. But the question is, when the revenue number comes in, does it also show some evidence of a pickup or a recovery in discretionary spending? Because that has been lacking. There is a leakage of discretionary projects seen in their revenue quarter after quarter since the slowdown began. Some other internals we're just awaiting. I think this time there is a headcount addition. The headcount has increased by 5,452. So after 3 consecutive successive quarters of the employee base declining for the company, this quarter there is an increase by about 5,500 on a quarter-on-quarter basis, and attrition for the company has further come down to 12.1%. This compares with 12.5%. In fact, it's now been, this would be the 6th consecutive quarter when the 12-month attrition for the company has declined. So that's another important, supply side internal. Some statements coming in from K. Krithivasan, CEO and Managing Director. He says, I'm pleased to report a strong start to the fiscal year with all-round growth across industries and markets. We are continuing to expand our client relations, create new capabilities in emerging tech, invest in innovation, and build a new AI-focused TCS. Samir says, in spite of the usual impact of the annual wage increment in this quarter, we have delivered a strong operating margin, validating our efforts towards operational excellence. We remain focused on making the right investments on talent. Just trying to see if there has been, we still have the details of the constant currency revenue growth so far. Okay, we still don't have that number. Awaiting that. Sandeep is now with us on the show. Sandeep, the rupee numbers appear to be very slightly ahead of street expectations. The fact that the company this time has returned to adding to the employee headcount, there is an increase in the overall, employee bench strength. Does that indicate some pickup in demand?
Yes, good afternoon and thanks for having me on the show. So, Rima, while the numbers of constant currency are not there, but I can tell you based on back calculation of number, it seems that constant currency growth is 1.7 to 1.8% at least, because the impact of cross currency, if you adjust that, then I think they will be reporting 1.7 to 1.8% constant currency growth at least, which is higher than what was anticipated by 40-50 basis points. Secondly, even on the margins, I think there is 10 to 20 basis beat versus street estimate. Remember, this was a wage hike quarter. So if you remember our conversation last week also, I said that this is the quarter where we will start seeing upgrades rather than downgrades. So I think this number, even if we don't have all the details, based on whatever detail we have, I think it is a big beat compared to what estimates were. And because of that, I think at least there will be some positive commentary and also some positive upgrade in analyst numbers from this quarter. That is the way I look at the numbers.
Okay, we have the constant currency year-on-year revenue growth, and that has come in at 4.4%. In the prior quarter, it was a 2.2% annual increase in the constant currency growth rate. This time it stands at 4.4. Don't have the quarter-on-quarter, but Sandeep, as you're saying, it should be at 1.7, 1.8%, doing the rough math. Do you think there will be any upgrades to the FY25 estimates based on what we've seen on the top line and on the margins?
See, Rima, top line, I am not sure whether there will be much upgrades because, it is a very large size company, and even if you upgrade the number by 1 or 2%, it doesn't move the needle. I think the big upgrade should be in the margins, because the attrition is now 12%, which was pre-COVID level. And at that level, your margin will be should be 27%, and we are at 24.7. So I clearly see there will be 2-3% margin upgrade, which will be there on the street. And based on TCS sensitivity of EPS to margin, I see at least 10-12% EPS upgrade for TCS based on these numbers.
Okay. Fine. We also have Prakash Diwan with us on the show now. Prakash, the stock moved up towards the end, ended up with a gain of about 0.5%, and it's done well over the last fortnight, 1 month. Your thoughts on the numbers?
Good afternoon, Deepa. So I think we've gone into earnings with very low expectations as far as TCS is concerned. In fact, the expectation was that there would be some EBITDA softness given the wage hike and utilization levels and all. But what these numbers tell you, at least the first cut, seems that things aren't as bad as what the street was anticipating. And remember, if we are anticipating sequential growth in all the verticals, be it BFSI, and of course BFSI is a big piece, but if the other verticals also kind of start contributing decently enough, then there is an expectation build up that this would be probably the start of a bit of a change. As Sandeep also rightly said, it could build some expectation towards a favorable move. But I would believe the key thing to look at, the key positive that I have seen in this set of numbers that you discussed is the new hiring. I mean, finally, there is a semblance of anticipation of growth that the company probably has. So in spite of the wage hike, which typically this quarter always grapples with, they would be seeing some sort of a build up on utilization levels, and that's probably what they're preparing. And next quarter could probably be even much more higher in terms of quantum. So if that sets a favorable trend, then probably you have a re-rating that the stock would have some upgrades, which would probably give. It'll still be sketchy. I don't think it's a universal upgrade for everybody as yet. People like to wait to see different things. But the upgrade cycle is something which could probably begin if these margins improve, if attrition is low, and if the headcount starts inching higher with all the verticals contributing fairly balanced.
Okay, I'm just got a message that it's about 2.2% constant currency revenue growth, but I'm still trying to, get that confirmed with the company. But 2.2% constant currency revenue growth, if it comes through, it's much, much ahead of what the street was anticipating. This would have been the best that we've seen in the last 4 or 5 quarters, much ahead of street expectations, if indeed the constant currency revenue growth is close to 2.2%. Then there would definitely be upgrades, and it would be a strong start to the company. Sandeep, 2.2% constant currency revenue growth quarter on quarter.
Yeah, it is correct number. Rima, I did the calculation again. It has to be 2.1, 2.2. So because I was taking some little lesser on the rupee front for converting the cross currency, when I do that adjustment, now it is coming to 2.1. So it should be 2.1, something that range. I cannot say 2.2, but it has to be close to 2. And secondly, Rima, the most important thing you see in this number, last year, Q1, there was 23.2% kind of EBIT margin, and it ended at 24, 25, 26%. So from that perspective, if first quarter is 24.7, that is 150 basis point higher, we will definitely end this year at 27.5, 27, because attrition is so low and wage hike is behind. It means that, at least 10-12% EPS upgrade is minimum which should come tomorrow from most of the analysts. That is the way I look at it.
Okay, 10 to 12% EPS upgrade likely for TCS, but a 2.2% constant currency revenue growth means I think the shares are going to skyrocket, and even the rest of the industry, it's sending a very strong signal because no one on the street was anticipating this strong, a more than 2% kind of a revenue growth. 1.5% was pretty much the consensus, going up to 1.8, 1.9%, but a number above 2 is going to instill a lot of confidence in the street about the demand recovery, because the 2.2% constant currency revenue growth doesn't just imply good execution. It's giving you a hint that perhaps discretionary spending or the leakage that we had from discretionary projects, maybe that is coming to an end. But remember, there is also that BSNL deal which they're executing, and it's how much you execute on that BSNL deal in a particular quarter will also determine the kind of revenue inflow. So there is a big, large BSNL deal which the company will be executing over the next 4 quarters. How much of that flows through, how much you ramp up in 1 quarter will determine. But again, much higher than street expectations. There is a slight beat on the margin too. Margin compression at 130 basis points is slightly better than what the street was anticipating. Moshe is also joining in. Moshe, this time we don't have the deal wins. Typically, the press release always gives you the deal wins, the TCV. But this time, I think it's, the press release, at least I can't find it. But give us your initial thoughts on TCS's Q1 numbers.
Hey, Rima, good to be here. I would say one specific thing probably drove this sequential growth uptick. I would say the fact that finally we're starting to hear that the deal flow or the deal wins that we've seen in the past 12 to 18 months are starting to convert more consistently into revenue growth. We've heard that a couple of weeks ago when we spent some time in India. Remember, that was the biggest issue in my view for the industry, was that you had this disparity between deal wins that were very strong and revenue growth was actually pretty weak. And it seems that some of those deals that were signed 12 to 18 months ago maybe took some time to materialize or convert because your typical enterprise company took a second look at those deals and maybe they got tweaked a bit. And maybe some of these started to incorporate Gen AI related productivity improvements. So that took some time. And remember, not every company in the space has that exposure to what we call cost takeout deals. So I think that should favor some of the others that had those large deal wins. And we'll start seeing that sequential growth that we started to see at TCS.
What would be the key questions, Moshe, that you would have when we get chatting with the management at the press conference at 5:30? What would you want to know from them, hear from them?
Yeah. So one, is the discretionary spending actually picking up, or this is predominantly a function of those deals that are starting to convert? That's number one. Number two, hiring, is that maybe reaching trough levels and we should start seeing a pickup there? Other things to focus on, obviously the Gen AI kind of related bookings. How are these impacting demand in general? Are these having a disruptive impact on revenue growth in terms of cannibalization? And there's a lot of questions on whether Gen AI is impacting growth for the space. And then the last thing that I think is also important is, how are we seeing the impact of GCCs on industry growth? Is that also kind of impacting growth, just given the fact that GCCs have grown so much in the past, what I would say 12 months or so in terms of headcount?
Okay. Thank you, gentlemen, for joining in. Sandeep, Prakash and Moshe. TCS has reported their numbers, a slight beat on the revenue and margins. It's a good start to the fiscal year for India's largest IT company, TCS. Also this time, the supply side dynamics are looking better, while attrition continues to moderate and has come in at 12.1%. After 3 quarters, the company has also gone out and hired more than 5,000 employees on a sequential basis, also a positive sign. Okay, we're going to quickly take your leave, but we will continue to pour over the TCS numbers. The press conference with the management is also scheduled at 5:30 p.m. But after the short break is our very special exclusive conversation with the RBI Governor. So don't go anywhere.
Need. It is absolutely required. It's a mandate that you should brush twice a day. In the morning, to remove everything that has been lying in your mouth while you're sleeping at night, and the acidogenic bacteria that work on it and create harmful acids, etc., and to generate freshness. And in the evening, of course, to remove all food debris and material that may be going to remain in your mouth through the night. You clean it up, you rinse it, and then you go to sleep.
Okay, but what happens if you don't? If you can just explain to us what are the risks of not doing so?
So what happens is there's a buildup of what is known as a biofilm on the teeth, and the biofilm contains bacteria, especially bacteria like strep mutans, which is what causes cavities. So, and of course, gum disease has different bacteria, but there is a whole bacterial biofilm that happens in the teeth. So if you don't remove that biofilm, then the bacteria will remain there and they will act on the gums and of course on the teeth. And so the gum disease and the dental caries both will be a factor if you don't remove the biofilm. So it's extremely important, especially at night, because when you've just eaten and then you go to sleep and it has time to act.
Is it more of a rural problem? Is it also as prevalent in the urban population?
So I would assume, looking at the stats, that the rural problem would be slightly more because also availability of toothbrushes, toothpastes, and other oral health aids is much less than in the urban areas. But awareness, and as Sunil said, awareness and knowledge has to be imparted so that people will be more, able to do what they have to do.
Hello and welcome to the most important interview for the economy. I have with me Governor, Reserve Bank of India, Mr. Das. Mr. Das, thank you very much indeed for giving us time. Really grateful for this. Now, everyone, every viewer, and today the viewership is like really teeming, would want to know about interest rate cuts. Please don't tell me aligned to the target, inflation aligned to the target. We heard that. After that, we've had, Powell saying that we cannot keep rates too high. We had an ECB cut. And much more important, domestic core inflation has come below 3%. So what would you guide?
You see, I'll be very forthright. I'll be very straightforward. First of all, good afternoon and namaskar to all your viewers. I'll be very forthright. In fact, it has made my endeavor and effort throughout to be as forthright as possible, and not to sort of try and camouflage the real issues by giving some, some generalized kind of reply. Now, when you talk of interest rate cut, now, of course, everybody always, at any point of time, everybody talks about interest rate cut. There is another whole lot of people who are the depositors, the silent depositors, who are, who would be affected in a different direction. Now, that is one aspect. Now, when the inflation is at 4, our inflation, the last print was 4.7%. And the June inflation is expected to be, out tomorrow. That is also expected to be, as per the surveys done by various wire services, that is likely to be close to 5%. So when we are at 5 and our target is 4, I would feel it is too premature to talk about interest rate cuts. Now, some central banks do some kind of advance guidance saying that, it is not far away or, we are getting close, something like that.
That was my ask.
Yeah, but the issue is the overall economic environment globally, not just in India, globally and in India, it is so uncertain to talk in terms of interest rate cut that I will do it, 1 quarter away or 2 quarters away. You say something and then you have to sort of take back whatever you have said today. So basically it is the uncertainty which is the one aspect. Second thing is the CPI headline inflation continues to be close to 5%. In fact, as I said, according to the surveys done, it's likely to be again expected to be close to 5%. So therefore, from that context, I think it is too early to talk about interest rate cuts. And I would rather not give, any kind of forward guidance, which may, I said it, I think somewhere else. I would not like to give any kind of forward guidance which would lead the market players and the stakeholders and others to board the wrong train.
Okay. Now, I'll look at it this way. See, there were 2 MPC members who spoke about the neutral rate. Now, just a word to our viewers. The Reserve Bank and all central banks look at the difference between the interest rate, repo rate, minus inflation. That gives the real rate. Now, the real rate at the moment is 200 basis points. If you look at your 1 year ahead inflation forecast, 4.5, we are at 6.5. Now, what is the neutral real rate according to you? We thought we will get it in the bulletin. The MPC members think it should be 100 basis points. What do you think?
You see, with regard to neutral rate, let me use the word neutral because that is much more accurate. The neutral rate, first of all, as you know, RBI a few years ago, our research teams had done a study according to which the neutral rate was about 1.6 to 1.8%. Then immediately in the aftermath of the COVID, somewhere in 2021, our research teams in the Reserve Bank, they came out with a number which was 0.9 to 1%. Let's take it as 0.9 or 1%. Now again, our research teams are working. What is what is possibly a neutral rate? The main issue with neutral rate is that it all depends on which period you are looking at. Now, and neutral rate also is subject to so many structural changes which which happen in the economy. Now, let us say in between we had the COVID pandemic. So that had a structural impact on the economy and had an impact on the neutral rate. So neutral rate came down to 1%. The other uncertainty is that neutral rate also depends on what is the potential growth you are assuming. Because that is a very important determinant of the neutral rate. So it is whether your inflation is at target and whether your growth is at potential growth level. That is basically the place where your rates are neutral. Now, so therefore, it is subject to so many uncertainties. It is subject to so many structural changes. We did one analysis immediately after the COVID. Now the next analysis is being done. I think it should be over in the next couple of months or so. Once that is out, once that is completed, we will release the number. Now coming specifically, if I can, answer your other part of your question. Now coming to, this monetary policy decision, etc.
They are saying 1%.
Yeah. You see, at the end of the day, neutral rate is subject to so many uncertainties. It is also a theoretical construct.
Yes.
Policy making in the real life, policy making in the real world has to be driven not by a theoretical construct, an abstract theoretical construct, if I can put it that way, but has to be guided by the actual numbers. And what are the actual numbers? The actual numbers here are inflation at 4, whether we are at 4%, and growth where we are. Today, inflation is at 5%, headline inflation is at 5. We have projected a growth of 7.2. We are still quite a distance away from our target with regard to inflation. Growth is holding, is holding quite well, and growth is 7.2%. So therefore, you have to make, policy making is being made in the real world, and you have to go by observable numbers, not by a theoretical construct.
But would you say the economy is growing faster than potential, or is it growing at potential at this point in time?
You see, economy, when you talk about potential growth, I mean, this question also comes up, that is, what is India's potential growth? I think with regard to growth, what is important is not to look at the number per se, but to look at the direction of growth. I have said elsewhere, and it is just, I have quoted the facts, it's not as if I am saying anything new. The last 3 years GDP growth is an average of about 8.3%. For current year 24-25, we have given a projection of 7.2%. And there are many drivers of our growth which are playing out their role. The momentum of economic activity, the momentum of growth in the Q4 of last financial year, that is January to March, was very strong. And the momentum of economic activity in the in the quarter ending June, that is the first quarter of this year, also continues to be strong. So given this, I think 7.2% which we have given at this point of time, it looks very much achievable. And again, if you look at the, if you look at the growth from demand side or supply side, now supply side would be basically how your industry is doing, how your agriculture is doing, how services are doing. In demand side, if you look at, let us say, how consumption is doing, the private consumption, public consumption, or rural and urban consumption, you look at investment, you look at
that is running weak, no sir?
Sorry?
Consumption is running a little
Consumption, let me tell you, okay, since you are asking me, let me put it this way. So far as the supply side is concerned, agriculture is expected to do well in the current year, good monsoon, and the season is looking good. Agriculture is expected to do well for the current year. So far as industries is concerned, the manufacturing sector is doing very well. The IIP numbers are very much in the expansion zone for a very, for considerable period of time, for past so many months. The latest IIP numbers are also, not IIP, I'm sorry, the PMI numbers. I'm sorry, I mean the PMI numbers. The manufacturing PMI as well as the services PMI have, again, they're remaining, they are higher than what it was in the previous month. And services is doing very well from the supply side. In fact, our service exports have also gone up strongly. Overall, service sector activity at the moment is very strong. Now, coming to the demand side, you asked about consumption. Urban consumption has been quite strong for quite some time, and it is remaining stable. Rural consumption, which was lagging behind, has picked up. In fact, it was out there in the media that the FMCG sales, rural FMCG sales have picked up. And given the fact that we have an expectation of a good monsoon, and incidentally the NREGA demand has also fallen. And considering that we are expecting a good monsoon, and the monsoon is now very much active in many parts of the country, the rural purchasing power, thanks to a good agriculture, will also go up. So urban demand is holding stable, rural demand is picking up and is likely to improve. The third component on the demand side, as you would know, is the net exports. Our exports have picked up.
Yes.
Services exports are very strong. So if you put all these things together, I think what we are looking at is that India is on a trajectory of, higher growth. And I said it elsewhere that I think there is a structural momentum to our growth drivers, and we are moving towards 8% growth. What I have said is that we are moving towards that.
Yeah.
So therefore, I am quite sanguine about India's growth. Coming specifically to the potential growth rate, on potential growth rate, I would like to say it is the direction of growth, which is important, not the exact number, whether it is 7.2 or 7.5 or 7.7.
No, the 3-year average looks good also because the previous was a contraction. So you got 9.7 and therefore the average is high. I took a 10-year average, it comes to 6%. I took a 20-year average, annual is 6.5%. Do you feel in the next 3 years or so, we will be substantially higher than that?
You see, when you look at time horizons, you said 10-year period and 20-year period. In the last 10 years, there were structural breaks.
Yes.
Like COVID pandemic was a major structural break. If you take into account the last 20 years, you had some structural drivers by way of, let us say, reforms like GST, IBC, monetary policy framework, introduction of the MPC framework and all that. So that was a kind of a structurally, they were positive, but structurally negative, where the COVID and the commencement of the war in Ukraine, then sudden squeeze in external sector demand and all that. But now we are getting out of it. So therefore, I think, again, a 10-year average and a 20-year average, you have to discount out these kind of structural idiosyncrasies or impacts, and then look at the growth momentum. So far as our current scenario is concerned, let us say post-COVID also, I think the growth numbers are gradually, the base statistically the base factors, are also gradually evening out. They're gradually evening out. That's why you see current year 7.2%, not 8 point something.
But better than 6.5%, you would say? I mean, since
certainly.
You expect in the next 3 years. Okay.
In fact, I would expect the international agencies and others. I think some of the rating agencies have also revised their growth projections upwards, and some of the internal.
So more upgrades are likely.
More upgrades are likely. Even the international agencies also, which are expected to give their projections in the next maybe few weeks or months. Let us watch what they are saying. But I see clearly the upward growth is on the upward trajectory.
Okay, then let me come back to the interest rate question. Is what one factor holding you back is the asset inflation, the perceived froth in the stock markets? Is that holding you back on rate policy also?
No, not so much. I would not say not so much, but let me say we watch all aspects of the economy, including the stock markets, more from the point of view of financial stability.
Yes.
What kind of spillovers it will cause to the overall economy. So we look at the stock market scenario, whatever is happening in the stock market or whatever is not happening. Basically the stock market scenario, by us, we analyze it from the point of view of, financial stability. Coming to inflation, coming to rate hike or rate cut, coming to monetary policy, we are governed by our inflation growth.
By goods inflation. No, I take your point. What I'm only saying is, does it worry you that you should not cheapen credit when the markets seem frothy?
No, so far as that's what I said. That is, we look at the kind of spillovers, the stock market, or for that matter, any development in any part of the economy, what kind of spillover it will have to the entire financial system and to the entire economy. Whether it is stock markets or the bond markets, or so many components are there, so many segments of the economy. We look at what spillovers they will cause. Now, so far as the banking sector is concerned, we are very closely, we monitor all banking, meaning the credit sector, or the credit growth, all that is, this segment is concerned. We very closely watch this position. In fact, much closely than it was, a few years ago, much more closely than a few years ago. And whenever we see possibility of whenever we see some early signs, or whenever we feel that a few months down the road there could be a problem in this particular sector or subsector, we act. And an example is the unsecured credit, where we took action last year in November. And we increase the risk weights, and the results are there to see.
Okay, that's exactly what I'm saying. See, the F&O volumes was something that troubled government, RBI and SEBI. And SEBI has appointed the Padmanabhan committee on it. So do you have this fear that bank money could be fueling the stock market rally? And therefore, is there a case for higher risk weights, or even to keep the interest rate, on watch?
You see, so far as bank money going to sort of create some, giving some boost to the stock markets, etc., is concerned, the exposure limits of the banks to the stock market, individual borrowings from, let us say, NBFCs, which were very high earlier for participating in IPOs or for going to the stock market, the IPOs or for FPOs, whatever, even there we have put a limit of 1 crore. It was all done some 2 years ago. It's not something we did yesterday. So therefore, at the moment, so far as from the point of view of the credit sector, there are no major concerns.
Okay, you don't think fresh controls are needed?
And in any case, banks have their own, end-use monitoring. Only some amount of, you can say, some amount of unsecured credit may go into the stock market.
Exactly.
May go. But so far as unsecured credit is concerned, we have already come out with, we have provided for additional risk weights, and the overall growth of unsecured credit has started moderating.
So you don't think more is needed?
That I cannot say. As and when something is, because it all depends on the numbers and the future outlook. So we keep on constantly evaluating. As and when some measures are required, I can assure you that the Reserve Bank will be proactive.
Okay. You're not done with risk weights?
Depends on how the situation plays out.
Okay. All right, let me come to the other big story where Reserve Bank grabbed the headlines, the dividend. You gave a very high dividend of 2.1 trillion rupees to the government. You would have some desire as to what you want from the budget. Would you want it to be used for fiscal deficit reduction? What would your best ask be? I mean, it's only a wish.
Well, I will not give you the answer which you want, but I will give my answer. Now, so far as the dividend payment is concerned, we cannot link it to it cannot be linked to our expectation from the budget. It is provided in the RBI Act that the surplus has to be transferred to the government.
Yes.
And the surplus has to be transferred after making all the provisions required. And the surplus has to be transferred now as per the recommendations of the Bimal Jalan Committee. We have an economic capital framework. It is principle based, it is formula based. There is a framework for it. At the end of the year, we just calculate, following the guidelines and the principles laid down, the ECF framework, this economic capital framework laid down by the Bimal Jalan Committee. We follow that and do the calculation. And whatever is the surplus that comes out, that automatically flows to the... Let me complete. So that automatically flows to the government. And so we have, it's not a matter of my discretion or the discretion of the Central Board of the Reserve Bank. It is principle driven, it is formula driven. So therefore, so far expectations from the government is concerned, let the budget be presented.
No, I'll tell you, it is not, I know you're making it sound formulaic, but you know, as a central banker, if inflation were high, you would not print so much money and give it to the government. Because inflation is behaving itself, it has been falling from the highs, you could give, you apply the formula. If inflation was high, you would not have applied the formula. What I'm saying is, when you give 2.1 trillion, you make life difficult for governors coming after you.
No, I disagree.
It becomes a precedent.
I disagree with you when you say if inflation were, lower.
Yeah, if it were higher, you cannot give such a big...
You are saying that we would not apply the formula. The question doesn't arise. You look at this. The Bimal Jalan Committee recommendations came in 2019, in the middle of 2019 calendar year.
Yes.
We applied it for calculation of the surplus transfer for 18-19. For 18-19, the money which was paid in next financial year was 1,76,000 crores. So that was the all-time high at that point of time. Then subsequently, if you look back at the last 5 years, after that there was one occasion, I don't remember, when it was 30,000 crores.
Yes.
It was 30,000, 30.
Yes, I remember that.
So how did that happen? 176 did not create expectations. So after that we gave 30,000 crores.
Yes.
And if I again remember correctly, it went up to something like about 99,000 or 1 lakh crore.
1 lakh crore.
But then again it came down to about 57, 56, around that. So therefore, there have been, ups and downs in the dividend payment. So it is entirely formula driven. Whatever is the number that comes out, and no governor will be under pressure. And in any case, there is no such expectation from the government also. The government is fully on board so far as the economic capital framework is concerned.
I'm still trying to make you say something about the budget.
And in any case, as regards printing of notes, The printing of notes depends on the requirement of the larger economy. We don't print notes only to sort of,
What I'm saying is if the inflation were high,
no, it has well
problem.
settled.
Yeah.
It has the economic
I agree.
capital
I agree
framework
that the precedent may not be.
It has well settled, and the fact that over the last 5 years we have given 176, then 30, again gone up, again come down, it proves my point.
Point taken, sir. But I'm still trying to get something in terms of your wish list from the budget, for the simple reason that deposits are growing by 12%, credit is growing by nearly 16%. There is, a hunt for deposits, and bankers and those who deposit money in banks genuinely feel that equity gets a better tax treatment. There is this capital gains debate that perennially goes on. Do you think that deposits need a better tax treatment?
No, I would not like to speculate on any aspect of the budget. I also would not like to sort of give out what are my expectations from the budget. As I have shared with you earlier and with the media earlier also, whatever suggestions, if at all, whenever we have any suggestions with regard to budget or any other issue, we convey it to the government.
But you don't think depositors,
on the budget, I would not like to, say anything.
Okay, even outside the budget, bank deposits are struggling because money is getting drawn into the stock markets. So there is a crib that we are losing because we have a tax penalty.
See, there is an interesting thing of, that you're losing to stock market. If whatever goes to the stock market ultimately comes back
stays
to,
in the bank.
It comes back to somebody's deposit.
Yes.
If I am selling the shares and you are buying
it remains in the banking system.
It remains in the banking system.
But the time,
so therefore, deposits are not growing. The credit growth is higher. And this is an issue we have been discussing with the banks. Even in my last interaction with the public sector banks and the private sector banks, in fact with the entire banking sector, this issue was discussed in depth between the RBI and the the CEOs of the banks.
Okay.
So the banks will deal with this issue.
Okay. Well, now let me come to yet another issue. Since we're talking about deposits, we have to talk about debt. There is this Indian inclusion into the index, the JPM bond index. There will be a steady flow of money, and even otherwise equity flows are very good. But because of the debt flows, do you think it can be managed in the normal scheme of things, or do you think something extraordinary like an OMO sale or MSS or something will be needed?
No, you see, we have multiple instruments at our disposal to deal with situations of excessive inflows. I mean, there are options of OMOs, there is option of the standing deposit facility, we do the VRRR, variable rate reverse repo operations. So we have multiple instruments at our command, and we will use them as time requires. But specifically about the inclusion in the bond indices, you see, it will happen over a period of time. It is going to happen over a period of about 10 months or so. Over a period of 10 months, it will happen. And I would believe that some of the money which was to come during this period has already come in. Even, once the announcement came, money has started coming in. So therefore, part of it has already happened. Whatever remains will come in a very, will come in periodic, monthly basis it will come. So what
1% every month.
So therefore, that is not something which, worries us. That is something which we have managed in the past and we'll be able to manage it. I don't see any major disruption on that account.
Okay, I'll tell you, one of the things about the way Reserve Bank manages the currency, there are obviously unexpected inflows and outflows, is this terrific stability. In fact, for some months together, it was only moving between 83 and 83.30 for several months, and then of course you allowed it to fall a bit. Doesn't this lead to complacency among importers and exporters? Isn't that a danger that worries you? They don't hedge enough.
Achha, you're talking about hedging.
Yeah.
Now, hedging, so far as ECB...
RBI is hedging on their behalf.
Somebody may think like that. I mean, somebody may think like that. But I don't think it will be like that, because first thing is that so far as the ECBs are concerned, they are fully hedged.
Yeah.
So that component you have to keep out. Then there is whole, automatic or natural hedging. People who who have export income, so they have their inbuilt natural hedging. So far as the overall hedging numbers are concerned, For some time in 23, it looked as if the hedging, the unhedged portions were going up. It did look that way. But from January onwards, from January to March, if you look at the numbers, the unhedged part of forex exposures, the unhedged part has started coming down, and the hedging has gone up. So the businesses and the corporate houses are doing their own assessments, and they are taking a call, and they are doing it, and it is something which we constantly monitor also. Last quarter onwards, sorry, not last quarter, I mean 1st January onwards, for the it has started picking up.
Okay, so you don't worry that RBI keeping it on a tight leash is...
No, we are not keeping it on a tight leash. Believe it. Market perhaps, or some people may think that, we are only keeping it a kind of a range. It is not so.
No, actually, one of the rating agencies even mentioned it, that it is practically a managed...
yeah, I mean, there are... yes, I am aware about it. But look, India has changed. The macroeconomic fundamentals of India are today much stronger than it was a few years ago. Macroeconomic fundamentals are very strong. The growth momentum is very strong. International investor confidence is also very strong. JP Morgan bond index inclusion also means that, the flows will be there. Our huge forex reserves also gives confidence to the international investors to invest in India, that India is in a position to meet its external payment obligations. So you have to look at the so-called, stability of the Indian rupee in this background. So I would say it is more to do with our overall stable, strong fundamentals than anything else. Reserve Bank, I again would like to stress, we only manage excessive volatility.
Okay. But do you think, given exactly the reasons you say, that there is a very good chance of a rating upgrade?
It should have happened even earlier. I would feel it should have happened earlier. But yes, I think
Our
should
deficit
follow.
is higher compared to other countries.
Which deficit?
Our fiscal deficit is higher compared to other countries in the BBB minus.
But it is on a, the government has announced a consolidation, fiscal consolidation path.
Yeah.
And the interim budget gave a fiscal deficit of 5.1. And next year, 25-26, it's supposed to be 4.5, according to the roadmap which government has given. Things appear to be moving in that direction. So I think a rating upgrade, it should happen. Yes.
Okay.
It should have happened earlier, but it should happen. But I think now internationally also, yes, there are some investors who go by the rating, and the cost of borrowing also depends on rating. I am not saying that the rating doesn't play a role, but I think more than that, the large investors internationally today do their own, do their own analysis and take their own call, whether, how much they want to invest.
Yeah, markets are ahead of rating agencies. I
think you have put it very appropriately. Markets are ahead of rating agencies.
Yeah, the companies, corporates tell us when they borrow. Let me come to the unasked part of the monetary policy, the stance. The stance has remained unchanged for a goodish bit. What do you think, and what will make you change it?
You see, the stance has been, we have called it withdrawal of accommodation, and there is a reason for that. Target is 4%. We are nowhere near 4%. We are still around 5%. But the expectation is that it is moderating, and it is indeed moderating.
Yes.
But the pace of moderation is very, very slow. It was 5.1, then I think it became 4.9, then 4.7. So it is moving very slowly. Now, one idiosyncratic development of some monsoon, flooding or some weather-related event can upset things. The vegetable prices can go up. So therefore, and the point is, even today we are still around 5%. So if we want a faster alignment of our inflation with 4% target, the monetary policy should be much tighter.
Okay.
It should be much tighter. It should be much more restrictive. But we have not done it because we do a balancing between growth and inflation. So therefore, we have not done it. We have chosen a calibrated path to aligning the inflation with the target. So therefore, we are still quite a distance away from 4% target. Given the distance that we have, which is currently 70 basis points, which may go to 80 basis points, given this much of gap, I think it is, it will be too early to talk in terms of change of stance. Unless you are somewhere close to 4%. You see, unless you are somewhere there, the question of changing of stance, I think, will be very premature. It is quite possible. Like, the second quarter inflation number is expected to be lower. But then again, it is expected to go up. Annual average, we have said 4.5%. So when we move towards 4% on a kind of a sustained, durable basis, only at that point, we may get a confidence to have a relook. I'm saying to have a relook. Nothing more than that.
Okay. In preparation for this interview and long-awaited interview for me, I read one of those bulletin chapters which speak about the dynamic stochastic model of growth, and they are forecasting 4% inflation in FY26. That model is forecasting. So I was just wondering if you will give me any hint about...
No, I think we have also, MPR has also given a number for 25-26. The Monetary Policy Report has also given a report for next year. So we are still months away from next year. So let's see. Let's see.
All right, fair point, sir. Let me come to some obvious banking issues.
And also let me say with all, with all sincerity, I'm not trying to sort of dodge the reply. Just imagine the kind of uncertainty that we have. So therefore, and we are nowhere near 4%, but yes, we are very optimistic and quite confident that it is moving towards 4%. But it's moving very slowly. So let's see.
Fair point, sir. Fair point. Actually, yeah, tomatoes at 120 rupees, so we have to be careful. It's monsoon. Let me come now to the banking sector questions. The two obvious things that the market is waiting for from you is this project finance provisioning. You have raised it to, you want it raised to 5%, and once the project is completed, even then it is coming only to 2.5%. Standard loans is only 0.4%. So you're really asking for a very big provisioning. Is there any chance it will be softened?
You see, what we have given out is a draft circular.
Yes, it's a draft.
In fact, we are now adopting in our regulations, we are adopting a very, very consultative process.
Yes.
And in fact, in the annual report also, if you recollect, or you may have a look, or your viewers may have a look, in the annual report for, last financial year, there's a separate box item, there's a separate annex, where we have listed out all the regulatory measures which we have taken, the number of regulatory measures which followed a consultation with the stakeholders. So we are now actively consulting. There is a consultative approach for regulation making. So this is also a part of our consultative approach. What we have put out is a draft circular. We have started receiving comments, and based on the comments that are received, we will examine the comments, and then we will come out with a final circular. The purpose of the draft circular is to adopt a consultative approach to get out external inputs and examine them with all seriousness.
See, this is not a discussion paper. This is a draft regulation. It's almost ready to go.
It's a draft circular.
So the fear of the industry is that you won't tweak it much.
It is a draft. We have said it is a draft. So when I say it is a draft, I am not saying that we will not tweak much, or I am not saying we will tweak it so much. It's a draft circular, and our approach is consultative. We take this consultative process very seriously.
What about expected credit loss? The ECL rules. Obviously, there will be pushback from some banks. But
no, that is already, I think we are working on it. It's on the final stages.
So it is something that will come in this financial year, you think?
Financial year? Yeah, of course.
It is coming in the financial year. FY25, you want expected credit loss?
I mean, it has already, the comments have all come. They're in the final stages of
No, actually, the project finance rules, higher provisioning, is almost like expected credit loss for that section. That's why I asked whether you will shelve that to a later part.
No, we are also equally concerned about how it will impact the balance sheet of the banks. And also, in some situations, the banks need to, this is a part of our macroprudential approach. The balance sheet of the bank has to remain strong at all times. There cannot be surprises. So all risks, perceived risks, have to be appropriately and adequately provided for. So therefore, this ECL framework, this expected credit loss or the project finance norms that we have come out, this is only to strengthen the balance sheet of the banks, and we are following a consultative process. We we try to understand what is the point of view on the other side, what are the difficulties they have, and then we'll move forward.
The point of view clearly is that they will pass on the cost to the infrastructure company. So infrastructure financing becomes expensive.
Any financing by a bank has to be sustainable. Okay. You see,
there is competition in the market.
There is competition, and also, you cannot do a financing. The model of financing should not be, should not be subject to any kind of unmanageable, unmitigable risks. Every risk has to be properly assessed, and it has to be provided for. It has to be mitigation measures have to be taken. So therefore, the cost of infrastructure financing also will depend on the perceived risk or the risk assessment. Every bank loan, there is a risk, why do we provide a risk weight? It is based on an assessed risk. So therefore, infrastructure financing also, effort is to see that the risks are appropriately provided for.
Bank investments in technology is becoming huge, especially after UPI. Every other minute, the balancing is a problem. It's a big technological investments. Do you think banks are able to manage? Will they need some help in terms of charging a bit for UPI or something? Are you okay with the bank's technological preparedness?
I think we are now living in an era where banking and technology, they are converging.
Yeah.
Going forward, you will see that there will be more and more of technology in banking. And not just in banking, I think in every sphere of life, technology is playing a bigger and bigger role. So far as the banks are concerned, we have been engaged with the banks for last few years, and constant engagement. As you may be aware, for the sake of your viewers, let me say that in our Department of Supervision of the RBI, we have a C-site team, and the C-site is a full extension of C-site. I am leaving that out. There's a C-site team which does only this IT scrutiny of banks, NBFCs, IT scrutiny of the financial system, the IT audit, if you call it that way. So we are engaged not only through the C-site team, but also at senior levels with the banks on two or three aspects of this IT facility. One is cyber security. Cyber security is a growing challenge internationally, not just in India. So one is greater focus on cyber security. Second is to ensure that timely investments are made in IT infrastructure. And third is to see that the IT infrastructure is keeping pace with the requirements of the growing volume of business of of the individual banks, or for that matter, the NBFCs. The banks, I am happy to say that the investments by the banks in technology, in IT, the kind of sensitivity and the kind of seriousness which the banks have with regard to IT and technology infrastructure has improved quite a lot.
But they have a crib, sir. They have a crib that this UPI, in the process of making it so easy for me to GPay you or something, has made life very expensive for them. There is nothing, no plan at all to ensure that MasterCard, the card payment all over the world.
You are talking about the MDR charges.
MDR.
UPI
there is
MDR.
Nothing on MDR. No MDR on UPI.
I mean, there is zero MDR, and I think
you don't
there is
think
currently
that merits a relook?
there is currently a scheme. Government has a scheme. They are funding the MDR. What the bank should have earned. So there is a kind of subsidization by the government towards these MDR charges. So I think it evens out eventually.
You don't see, this is the start of a new term for the government, so tough decisions can be taken, but you will not.
No, I can't speak on behalf of the government.
No. What I'm saying is,
because the exemption.
Would you be sympathetic to the bank's ask that they should be allowed to some cost of the UPI which they bear, a little more should be reimbursed to them?
So this issue has been discussed with the banks. This issue has been discussed in multiple forums, and that is why the government has given this, this.
Yeah, they are reimbursing
subsidy.
a little bit.
So moving forward, let's see.
Okay. Well, actually, your term has also been seen as a bit strict. I mean, most CEOs have gotten 2 years when the board recommends 3 years. Are you more of a demanding taskmaster?